T-Mobile is out with above consensus earnings and new customer additions. The company also lifted its guidance for operating profits and cash flow. I caught up with T-Mobile CEO Mike Sievert.
You know, we've been saying for years that this company has a unique opportunity to be the first ever in the history of our industry to one day offer the best value simultaneously with the best network. And that day is kind of arriving, and customers are noticing. And it's so huge. I mean, you think about right now, customers are anxious. The economy is full of questions. And what they're looking for is a great value from a brand they trust. And that's T-Mobile.
Mike, I've talked to one of your competitors recently. He said, you know what, Brian, customers are delaying paying their bills. Are you seeing that?
No. In fact, bad debt levels look to us consistent with 2019 pre-pandemic levels. And 2019 was one of our best years ever. So we have seen it creep up from those pandemic levels, but only to one of our best years ever. So we're very interested in this. We're watching involuntary churn. That's when people don't pay and have to leave. We're watching late payments. But so far, we're not seeing it in anything outside the norms. And you saw that in our overall performance being the only one to reduce overall churn to just 0.88, 8 basis points less than a year ago. Because people, when they come to T-Mobile, they're finding what they're looking for.
Mike, you mentioned that consumers are anxious. These are strange times going into year end. Are you seeing them trade down on what packages they spend for T-Mobile?
No, but we are seeing a potential flight to value from other providers. And you know, our competitors, our principal competitors, jacked big price increases onto their customers this summer. While those customers were locked in device repayment plans and could do nothing about it, where we reiterated price lock, the fact that when you come to T-Mobile, only you can change your plan. It's the uncontract. We won't change it for you. And that kind of trust, that bond we have with our customers is really resonating right now. And it's one of the reasons why, you know, this quarter we attracted more postpaid net additions than AT&T and Verizon combined.
This sounds like a classic market share grab.
Well, that's our strategy. For years, you know, our principal growth strategy has been to grow our share methodically and through the power of our brand. The fact that we put customers first, that we love them, that we treat them right, and we give them low prices. And now, combining that with the leading 5G network, there is a real opportunity for us to resonate with a whole new audience of people that actually never gave us a serious look before.
The last time I talked to you, I think you were still getting the 5G up and running. It was in some spots. What is it? Where is it now, and how is it different compared to Verizon and AT&T?
Well, today our broad layer of 5G reaches 97% of Americans, and our ultra capacity 5G reaches 250 million people. If you asked for a comparison, that 250 million is where Verizon publicly stated they hope to be 2 years from now.
Where do you see, what's the next level of 5G? Where else does it roll out, and what else are you working on?
Well, one of the things is putting it to work for all kinds of new use cases. Magenta Max, which is our most popular rate plan, it's actually one of our higher end rate plans, happens to be our most popular because it's the best expression of that 5G network, truly unlimited usage on our network, and customers are using it like never before. But also home broadband. Customers are using our 5G to power the internet in their entire home, and they're tearing out cable and fiber to do it because we charge them $50.00. Our net adds in home broadband on 5G were more than the net adds on broadband for AT&T, Verizon, Comcast, and Charter combined.
Did you leave anyone out?
Well, you know, it's interesting. You know, we're comparing ourselves to everyone in the industry, and what we're really interested in are net promoter scores, whether or not when those people come to us, whether they like what they have. We're 30 points higher than cable, and our net promoter scores are even higher than fiber.
You also raised and we've had this discussion in the past, the amount of synergies from the Sprint transaction. Where are these synergies coming from, and when does it peak out?
Well, the principal place they come from is the network, and we achieved a massive milestone in Q3, the substantial shutdown of the entirety of the Sprint network targeted sites. So that is behind us now, and the run rate synergies we increased in our guidance yet again as a result, because that network shutdown happened more than a year ahead of schedule. There's still some room to run into next year, but as we finish 2022, most of those run rate synergies are now in the run rate.
Every analyst I talked to on the street, Mike, they mentioned T-Mobile's about ready to do a large share buyback Someone I talked to highlighted $60 billion potential from 2023 to 2025. Are you still on that track?
Well, that's what we said in our 2021 Analyst Day. And yeah, our cash flow production has continued to come in line with expectations ever since then. And so not only did we get that program started with a $14 billion buyback, but we started it early. And so in 2022, we're actively buying right now with a $3 billion program this year and an $11 billion program in 2023. And that's an expression of the confidence of our management and our board in the future.
Before I let you go, speaking of confidence, you struck an upbeat tone on the metaverse on your earnings call. Now, it was a tough day for Meta. Stock got slammed. Tough quarter. A lot of focus on the metaverse, on what it may be and what it may not be. How do you see it? Is it a big deal? Do you care about it?
We do, and it's not all about one company either, even though they renamed their name to Meta. It's about every company starting to live in the digital 3D world. I just came from a CEO conference last week where I heard all kinds of companies making digital twins in manufacturing environments and training their employees in the metaverse while they're producing their actual factories so that employees can walk into that factory when the doors open, having lived in its digital twin for weeks during training. That's metaverse. So applications are here today in the enterprise and in the consumer side in gaming that are 3D digital imagery. And that's fundamentally what the metaverse is all about. And it requires massive connectivity and low latency, exactly what T-Mobile's unique 5G network delivers.
So that's my last question. How does T-Mobile make money off the metaverse? Is it through charging consumers in businesses?
Well, a few ways. One is our most popular plan right now, Magenta Max, also happens to be one of our higher end plans. So customers, unlike slamming them with price increases like our competitors, our customers are self-selecting up our rate card to get access to more and more of what we offer. That's a win for us, but it's also a win for them because it's the best expression of the best 5G network.
I thought Mike's comments, guys, on the metaverse were very interesting, and maybe adds another red flag to what Meta is building out. It's not just Meta's metaverse, and they're investing billions of dollars to roll out this metaverse, and other companies could probably make money off it. And it has nothing per se necessarily to do with what Meta's doing.
Right. It has a larger implication around the technology that's actually going to be used, the hardware that's going to be necessary for the metaverse. Is it hardware that we already have? Is it an app-based solution like Roblox, or is it actually via a VR headset? And it comes back down to what the consumer wants in that experience. If you ask that to Bill McDermott, actually we did yesterday, and he believes that, yeah, there's opportunity for the metaverse. All the companies are saying the same thing, I might add too, where, of course, Mike was just saying, and it runs on us, and Bill was saying, and ServiceNow will be there. There's this larger question of the user experience and what that will be, from watching a fashion show or watching a concert in the metaverse, all the way through to conversion and shopping activity that could also take place.
And all the digital twin stuff, which is something that NVIDIA has talked about as well, because there's lots of applications on the chip side too. I mean, do you think the other companies are a little annoyed with Meta for naming itself Meta when they're all also in the metaverse business?
Maybe. Oh, we actually we have to get our producer Connor to string all these comments together on the metaverse. We got a mental note for next week. Connor, I know you're listening in, so just
Can I ask you one more thing though, Saz? When T-Mobile touts itself as having improved its network and is stealing customers from the others, for a while there we are still seeing it to some extent, this real promotion wars between the telecom companies. It's costing them though. I mean, in the case of T-Mobile, what's its outlay look like? What do its margins look like right now as it is trying to get those new customers to join, because it's trying to offer that value proposition?
Well, they've been the only telecom, I would say, over the past year and a half to consistently raise their profit outlook because their revenue continues to come up to the upside, and they also continue to see billions of dollars of cost takeout, or they're reducing costs in those legacy Sprint assets. So that's what we heard from T-Mobile last night. They see almost $3 billion of cost cutting in those legacy Sprint operations coming into the year. Maybe they were around $2 billion or so. I mean, that's huge upside for this company.
Interesting, yeah. All right, coming up on the other side, meme stock mania, huh?
Oh yeah, S3 Partners Bob Sloan will give us his take on volatile stocks next. Well, looky here. We got stocks at the highs of the session. The S&P 500 now up about 1.2%. The Dow up some 500 points. The NASDAQ, though, probably the real surprise here, given the big disappointment from Amazon in particular, that it's managing to eke out a gain. And something else perhaps surprising here is that as we have seen stocks on the rise, guess what? They're selling in bonds. That's not something that we have seen too much this year. They have mostly been moving in tandem. That selling, by the way, pushing the yields up higher a little bit here to nearly 4% on the 10-year yield. So kind of interesting that what we had been seeing, now we have been seeing stocks go up and yields go down this week, so buying in both on the weekly basis. But today, they have reasserted their traditional relationship, as it were. I was just talking about the NASDAQ and how sort of surprising it is with NASDAQ, with Amazon down by 9%. But if you take a look at the equal weight NASDAQ 100 here, most of the components are in the green. We've got Apple, of course, that is certainly helping matters. It's at its highs of the session now, up by nearly 7% after what looked like an initially mixed quarter, and was a mixed quarter, but it looks like investors are looking at the bright side here this morning when it comes to those shares. Let's also talk about some of the stocks that we were talking about a lot more earlier in the year. We're talking about meme stocks. Our next guest was one of the few who saw last year's short squeeze of GameStop coming before it happened. And with this company's data analytics can help investors avoid surprises from market structure and hopefully find the next big short squeeze. For more, we welcome in Bob Sloan, S3 Partners CEO and Managing Partner. Bob, thanks for being here. And just because a company has high short interest doesn't mean there's going to be a squeeze. But what are some of the conditions, if you will, that make a company or a sector or a collection of companies ripe for action like that?
That's a terrific question. The main ingredient to a short squeeze is not the flawed short interest that you will see published on Google. The main ingredient of a short squeeze is how much are short sellers losing and what's the upward momentum price action of the stock. As they lose more money and you see the price action go higher, that is what causes a short squeeze. That is what S3 calculates. And that's why we're one of the most popular data sets in the world when it comes to measuring short interest, float, and financing rates.
Is there enough short activity right now or short volume or float that's in the market right now to cause anything near the type of scale that we saw at the beginning of 2021?
If you look at GME, I think there's still $1.2 billion short in the stock. If the stock goes past $30, you could see something parabolic.
Bob, I would say one of the conditions for the height of the meme stock rally, a lot of people were home during the COVID pandemic. If we get a recession next year, do you think that sets the condition for increased trading activity?
You know, one of the things that I mentioned on the Netflix special that was done on GameStop, a lot of people have seen that, is this idea of Kardashian economics. If you look at the arc, the Kardashians are still here. If you look at the arc of that, apply it to socially mobilized investing and think that's going to go away, I don't think so.
Okay, so for some of the other industries that are kind of further out bets and based on some of the more innovative technology, there's been, more of the, how can we say, the arc trade, if you will. How do you look at some of the sector-based or even the innovation-based trades right now, and considering that there's an alternative trade to even that in the short positions that have flowed in?
So there's also selling of long positions, which is, you could argue, the equivalent of a short position. And one of the things that we have as a new product is looking at market structure, and particularly on the long side. And if you look at our new product, you'll see that Meta is the second most popular holding amongst the hedge fund community. What will that do in returns over the next quarter? I think we know the answer already. So those types of stocks where you see persistency in holding over time and you see a downdraft in the marketplace, you're going to see losses. And that will affect where money moves. It affects how different strategies are composed. And one of the things that really caught our attention was when David Einhorn came out and said value investing is dead. For us, that's like a prophet coming down from the mountain and throwing away the tablets. It's just heresy, right? So, but what he's saying is that markets evolve. Market structure is very important, and it's not just the short side, it's the long side too, and our new products solve for that.
Bob, I want to go back to what you just said about Meta. I see Amazon is also one of the most, has the most long positions next to Meta. Spell that out for us a little bit more, what you were alluding to, that even after that sharp decline, the 25% drop in Meta on a single day basis, even after the 10% or so drop that we're seeing in Amazon today, is what you're saying, does that imply that we could see more people get caught holding the bag and more selling exacerbated going forward?
Yes, that's exactly what we're saying. Persistency of long positions quarter over quarter are quite high. So it is reasonable to assume that since if you look at the hedge fund cohort and see what the largest holdings are, it is very reasonable to assume that there are severe losses in portfolios today, right now, as we speak.
Bob, thanks so much for taking the time here with us today. We really appreciate breaking it down and looking through some of the data that you're also tracking.
Thank you very much.
Absolutely. Guys, coming up, we're going to take a deeper dive into some more earnings reports from Deckers. We've got Colgate-Palmolive and Gilead Sciences. Exciting. That's nice. Welcome back, everyone. It is time for Cut for Time. 3 stories, 1 minute each. We start with this today. We are watching Deckers Outdoor. After it released a conservative forecast alongside earnings, the footwear maker, which owns brands like UGG boots, Hoka, seeing its stock move despite a quarterly profit beat. They're taking a look at shares down a little more than 5% right now. They said in this quarter that net sales actually increased 21.3% compared to last year. And then additionally in their wholesale net sales, that actually increased by about 16.7% here as well, with DTC up 35%.
When I saw that sales gain, I'm like, wow, maybe they're trying some new stuff. I went right to the UGG page, and they have these moon boots. I haven't seen stuff like this in a while. $320 a pop, but it looks like a new innovation burst over at UGGs. No more necessarily those brown shoes and some PSLs, and you go out and walk around the mall.
I like these.
Have you not seen what these shoes look like before? The
I mean,
brown shoes?
They didn't look
Uggs?
like this.
No, but
they
UGG,
look like that. Yeah.
UGG has been making
UGG's been
a lot
around.
of
I mean, I go back to
different-
high school. That was my.
Yeah, but
jam.
they've already
Wore Uggs and
innovated.
I know where Uggs.
Well,
Everybody
and the
else did.
Hoka brand has been
Tom Brady wore
on
Uggs.
fire
That's
for
true.
them, right? It's not just about Uggs. Hoka net sales approaching that of Uggs, $333 million for Hoka. $476.5 million for UGG. So they're getting up there here. It does seem really the disappointment was from that they did not raise their expectations.
All right, sticking with earnings, Colgate-Palmolive panned by investors after the consumer packaged goods company reported a sales miss despite raising prices. This is inflation and a cloudy economic outlook continue. Probably one of the more disappointing quarters from a consumer packaged goods company, but still another company I think is doing some pretty innovative things. The Colgate whitening pen. Overnight whitening pen, it just works. I tried it recently. It works, yeah.
All right, I gotta give me one of those.
So isn't it just like whiting out
And then
your
you sleep
teeth?
with it. It took a little while to get used to it. I started
Just paint your teeth?
Yeah,
chemicals.
yeah, all very healthy.
Yeah.
I'm sure.
I mean, it comes down to how they're moving inventory continuously into some of the storefronts that are the most massive retailers as well, Target, Walmart, and where consumers are also leaning into some of those household name brands versus, perhaps trying out some of, even in the trade down, trying out some of the homegrown brands that a Target or a Walmart might have.
But the difference here between some of the other consumer brand companies we've heard from, like the Procter & Gamble's of the world, is they raised prices enough to offset any volume declines or, if not declines, in volume slowdown. And that doesn't seem to have succeeded enough to the same extent in Colgate-Palmolive. So one other company to discuss in our little earnings roundup here is Gilead, the drug maker. It is moving to the upside 10% after reporting better than expected profit from demand for its HIV and cancer drugs. That offset lower sales of the pharmaceutical's COVID-19 antiviral drug, as well as acquisition costs. So this represents a pretty impressive move upward here for Gilead because, it's been having some rocky times in terms of its stock performance.
Yeah, Big Tarvy putting the team on its back. Sales increased 22% year over year, but oncology sales, 79%, as you were talking about there a moment ago here. And then additionally going forward here for Gilead, given that they had placed so much of the research and development as well in the novel coronavirus pandemic around some of the treatments, it's going to be interesting to see where some of those patents are able to be leveraged into some of the other treatments moving forward too.
Yeah, it's just good to see a positive reaction to an earnings report and what has been really a challenging week, notably in the tech space.
Yeah, so this move upward, it looks like the stock is also at the highest I'm looking at the 1 year, it's definitely the highest over the past year, probably the highest going back to about mid-2020 for these Gilead shares here. And actually now on the 1 year chart, up 15%. Interesting here. So as we take a step back, take a little breath here after this busy week of earnings, really we have focused a lot on the technology earnings. And so as we look back over the week, it really felt like a tough week that really defied some expectations that some of these big tech firms would be more resilient. I think people expected the bad Meta quarter. Yeah. But aside from that, I think really Amazon, Microsoft, Alphabet, all of them really disappointing investors.
Yeah, I was just saying, I think investors were shell-shocked. I mean, this is really the second straight quarter for Meta that wasn't just disappointing. It was just really, really bad. Just not good. Any line item in the report, not good.
Even with this week's earnings that we saw, I'm actually glad that we ended with Gilead Sciences there a moment ago, because if you look at some of the year-to-date performers that have actually not just outpaced the market performance, but actually maintained a positive move over the course of this year, it's companies like Merck. It's some of the United Healthcares as well that are actually positive over the course of the year. So as much attention as we give big tech, and for a great reason, it's in the palm of our hands, it's on our screens every single day, it's the different devices that we operate with. It still comes back to what are some of the core elements right now in this economy that people are still going to engage with. It's your energy, it's your health, and then it's all of these other products layered on as well. And that's where the real demand equation and the necessity of communication services, as referenced through all of our conversations with AT&T, with T-Mobile and as well with Verizon.
Excited to play golf tomorrow? I'm so excited to
hyped.
play with you guys. Me, you, Dave Briggs, senior columnist Rick Newman. We're hitting the links. This is pumped. I'm pumped.
I was looking at the interactive.
Oh, I didn't know.
There's a lot of green on there, too.
Green, yeah,
There's a
green.
lot. Well, I
Hey.
was looking at the drug stock that you were just talking about. See, there you have it. The year-to-date drug action here. Gilead among them, up 6.8% in the year. Eli Lilly up 30.8% here. So that was really interesting too. I was also looking at the sectors on the week here. Communication services, right? That's the big loser. That includes a Meta. Consumer staples, XLP in the upper left there, up 5.9%. So interesting, the weekly action that we have seen.
Yeah, report of the week for me, I'll just quickly add McDonald's. Oh, wow. What a quarter for McDonald's. Coming off October tracking up close to 20%, all because of these adult Happy Meals. Wow. Big.
Yeah, between McDonald's and Chipotle, we got the food space covered. Different consumers as well that they're going after, clearly. All
right, we got to go, you guys. We'll play golf already. Kiko Fujita and Nespresso are going to do a deeper dive into those earnings from Apple, which Citi's Jim Suva. That's next.
Welcome to Yahoo Finance Live. It is 11 a.m. here in New York City. I'm Akiko Fujita along with Inez Ferre. Here's what we're watching at this hour. Twitter takeover. Elon Musk officially taking ownership of the social media platform and firing top executives right along the way here. Is the saga really over? We're going to discuss in just a bit. It's a tale of two mega caps. Apple extending its streak of earnings beats. The company posting record revenue even as iPhone sales came in lighter than expected. But a different story for Amazon as the e-commerce giant prepares to, quote, tighten its belt after disappointing results. And we are all about energy on this Friday. The earnings parade continues with oil giants Chevron and Exxon raking in record profits and higher energy prices. We're going to break down those results and then continue our energy chat. We're talking specifically green energy with Plug Power's chief executive about alternative solutions. First, let's check in on the market action. Things looking good so far, 90 minutes into the trading day, with the Dow up 622 points. Take a look at that, up nearly 2%, looking to extend its streak of wins to 4 straight weeks. The S&P 500 up 62, and the Nasdaq up 193 there, despite some of those disappointing results we were talking about coming through this week. Well, the big story of the morning, Elon Musk is officially taking control of Twitter, completing his $44 billion takeover of the social media giant, tweeting out, "The bird is freed," to mark the start of his ownership of the company. And that start reportedly includes several executives, such as CEO Parag Agrawal and CFO Ned Siegel, being let go. Joining us to discuss is Yahoo Finance's Alexis Keenan. And Alexis, let's start with the shakeups here that have happened already. Not entirely unexpected.
Right.
But what does this look like moving forward? We're taking a look at the potential payouts that could come, what this could mean for the company.
Yes. So these top executives so far are entitled to compensation under the merger agreement. They get accelerated compensation. So they're seeing a big payday here. Let's go through what those are. CEO Parag Agrawal and CFO Ned Siegel also being let go. Head of legal policy Vijaya Gadde, she's the one who was controversial for banning President Trump, also banning political ads on Twitter, and also had banned that New York Post story saying that Hunter Biden had arranged a meeting between his father and Ukrainian businessmen. So these big shifts, they're going to cost the company some money. I've read up to $200 million. The numbers are a little bit shaky, but we do know that those 3 executives together, they own 1.2 million shares in Twitter worth $65 million. Also under the merger agreement, a golden parachute for accelerated vesting of stock worth $119.6 million. They also get 1 year of salary and benefits. Each of those executives making $600,000 a year plus base salary. So big ticket items here.
And now it's interesting that the big executives, right, they're out, but we don't feel that sorry for maybe the big ones that get quite a bit of a payout there. But what about the employees? Because there had been headlines that 75% of the employees were going to be cut. Then Elon Musk says no. So what happens to the employees, the majority of them at Twitter?
So there are reports that Elon Musk did, in fact, this is the New York Times saying that he did, in fact, agree to pay the vesting that was coming for the rank and file employees. Now, that date is November 1st. So Tuesday, a big part of Twitter's workforce was set for a big payday. Estimates are that that payment, if Musk does make it, will cost approximately $100 million. And there's some concern, some employees have expressed concern that he won't, in fact, make those payments because under the language of the agreement, going back to the merger agreement language again, it says that you have to still be employed at the company in order to get those payouts. So that's something to watch. Also,
benefits them financially to fire them, right? I mean,
yeah, it absolutely does. And look, Twitter's ranks have swelled to 7,500 employees over between 2020 and 2021. That was the year-end number as of December. And so the company has been adding to its workforce over the past 5 years. Certainly with that incentive, it might be something that he wants to take a close look at, getting rid of more employees.
And finally, there are questions here about what this business structure is going to look like. I mean, Elon Musk has floated a number of ideas since this offer was first made back in April of this year. Subscription model, sort of getting rid of a number of features. At the end of the day, the business as it stands gets more than 80% of its revenue from ad dollars. So what's going to change there?
Yeah, so TBD, right? But what we can know is what was tweeted between Elon Musk and his associates, some of them being friends, some of them business partners, investors, in the tweets that we saw, his personal tweets that we got through the litigation in discovery that was supposed to happen with Twitter if this deal didn't go through. He had talked a lot about, shifting users, also the amount of content, the type of content that would be permitted on the platform. So certainly we can expect some more wide-ranging speech allowed on the platform. That's something that he has long said he wants to do. He also says he wants to be able to have it as a forum that does that without inciting violence. Also, that tweet that he tweeted out directly to his advertisers yesterday, he said this: Twitter obviously cannot become a free-for-all hellscape where anything can be said with no consequences. He went on to say that he aspires to make it one of the most respected advertising platforms in the world. So definitely giving a nod to the fact that just anything can't go on Twitter.
TBD, as usual, with this deal with Twitter. Thanks so much, Alexis Keenan. And let's turn now to the latest round of big tech earnings, starting with Amazon. Shares taking a hit following a revenue miss in its latest quarter and weaker than expected results from its Amazon Web Services segment. Amazon also forecasting lackluster fourth quarter revenue, which doesn't bode well for the holiday shopping period. And this is something interesting that we've watched with Amazon, right? AWS, a little bit lighter than expected. Also warning about that slowdown. That is significant. A slowdown with consumers going into the holiday season where the sales expected to grow from 2 to 8%, but that's the lowest in the company's history. I think that it's important to pay attention to what Amazon is saying about the health of the consumer as we go into the fourth quarter.
Yeah, I mean, you could argue that forecast is really what weighed on the stock yesterday. We saw it down significantly after the results, after the bell, falling below that $1 trillion mark, which is pretty incredible when you think about a company that has grown so quickly and significantly, especially during the pandemic. A few comments to note here. I mean, you talked about the slowdown that's expected in the holiday quarter. Obviously, from an investor perspective, a little concerning when you think that's supposed to be one of the strongest times of year. CFO Brian Olsavsky saying the company is taking steps to, in his words, tighten its belts. That includes pulling back on CapEx, pausing hiring in some businesses, winding down some products and services. So when you think about where Amazon has been since the pandemic began, it really has been about grow, grow, grow. Adding more staffing, adding or expanding their facilities and all that. And it feels like things might slow down a bit there, take a bit of a pause because of what they're seeing, especially on their e-commerce side of things.
And which is what also we have seen with other companies related to tech as well, where they just take a pause, perhaps a pause with hiring, a pause with perhaps more investments. Also, just want to note, Amazon still has 55 buy ratings and 2 hold, 1 sell. So you have a lot of analysts that have lowered their price target on the stock, but you still have analysts that consider it a buy.
Yeah, and when you look at $101, a lot of people may be saying, well, considering where it's been trading, that may not actually be a bad price to get in on. On a more upbeat note, Apple shares are trading higher after it topped estimates for the fourth quarter, but future guidance for the December quarter looking dim as Apple expects a deceleration in year-over-year revenue. And this is one of those things, and as when you think about what preceded these results, Apple did just well enough to sort of add some optimism to investors who are a little concerned about things. But when you think about iPhone sales, I mean, the company touted new revenue records for the quarter in iPhone, services, wearables, home accessories, but they didn't come in a little softer than what is expected. iPhone revenue up 10% year on year. No surprise here, something we were trying to flag yesterday. The dollar strength, a significant headwind for the company. They did flag that yet again, saying in the September quarter revenue was up 8%, but the company faced 600 basis points of negative foreign exchange impact. And that's another thing to continue watching as we see the dollar strength.
Yeah, and that's something that other companies, multinationals, have also talked about, is that dollar strength. But what I found also interesting was the other products category, including Apple Watch, AirPods. That saw increases, that beat Wall Street expectations. But it'll be interesting to see what happens with these types of products if consumers pull back on discretionary spending on these products that may not be as necessary, let's say, as if they were to need an iPhone.
Let's bring in another voice into the conversation. We've got Jim Suva, City Managing Director in Equity Research, specializing in technology. Jim, good to talk to you. Let's try to move the conversation forward because we are in that quarter where Apple traditionally has seen the most strength, especially during the holidays. Based on what you heard yesterday, how optimistic are you about what they're likely to see in this quarter, especially with consumers being weighed down by higher prices?
Well, Akiko, it's great to see you again, my friend. And I got to tell you, that's a very smart question. As we approach the holidays, there's a little bit of a headwind happening here of consumers have less discretionary income. Their rent is more expensive. Gasoline prices are more expensive. More and more things are expensive. And so we are also seeing a challenge with foreign exchange. when you translate those dollars from the pound or the euro or the yen back to the US dollar, it's a big headwind of about 10% to Apple. That being said, we still do expect growth next quarter, probably in the neighborhood of about 4% year-over-year growth. Now, that seems a little subdued, but when you have 10% of your sale or 10% of your growth being taken away by FX, you add that back, that's actually 14% growth year-over-year. That's remarkable in this situation, especially in a world where a lot of mega tech right now is seeing a lot of pressure. We're very positive on Apple. We think that the platform continues to grow and a lot of new and exciting things in the future, Akiko.
And Jim, speaking of the consumer, what about the other products? What about Apple Watch? What about AirPods? Those beat expectations. But if we go into a recession, if the consumer pulls back on discretionary items, are you going to see some weakness there?
So, Inez, that's a good observation point. But I got to point out that when people break their iPhone, they find a way to replace them. They may reduce the amount that they're spending on food and beverage or delay some clothing purchases. But Inez, I can also tell you that people will replace their iPhones. Also, remember, Apple caters to the part of the market that is not necessarily the emerging markets where people are living a lot more frugal lifestyle. They tend to cater to people who want a premium experience. And it's where that software and hardware come together in a wonderful experience that people are willing to pay a premium for it. So Apple would not be immune, but what they do have is a tremendous amount of cash flow where they could buy back a lot of stock. And we're seeing that other tech companies, if we enter a big downturn, they don't have the cash flow generation that Apple does. So you've got a valuation support that could help out Apple should things get really bad next year. And we're positive on the stock.
Speaking of positive, you've got a price target of $175 a share. We're just under that right now. I think I saw 156 there. What do you think is going to be the big catalyst that gets you there? And the other question we haven't really tackled yet, how big of a weight will China be as we see things slowing down over there?
Well, some of the big catalysts we see is a foldable iPhone or iPad in 2024. But next year's 2023. But people will be looking forward next year to the following year, and that will start to get people pretty excited. Also, the services. We believe that their services are going to start to accelerate in 2023 as we lap these difficult foreign exchange comparisons. And as they put in price increases, it should help them. So we actually do see these as positive catalysts for 2023, foldable phones in 2024, and a platform that's growing. You'd mentioned Apple Watch. That's very important. Now people are using it more and more in healthcare, and we expect that to continue to grow. We see them getting more and more involved with the enterprise. Simply put, the platform of Apple, which we view Apple as a platform company, not just a hardware company, continues to expand and grow its addressable market. We see a lot of positive things ahead for the company.
Yeah, a lot more tentacles there, allowing the company to pull some levers. Jim Suva, as always, great to have you on. City Managing Director in Equity Research, specializing in technology. Well, another tech stock we're watching this morning. Cost reductions at Intel are helping lift the stock today. It's up more than 10%. This coming despite slumping sales in Q3 and disappointing guidance. The chipmaker saw revenue decline 20% to $15.3 billion in the most recent quarter as demand for PCs softened. The company now expects a revenue of $14 to $15 billion in the current quarter. That is below Wall Street estimates, but it did pledge to slash costs aggressively throughout layoffs and through slower spending on new plans. Intel is now aiming to reduce costs by $3 billion next year, adding up to an annual savings of $10 billion by the end of 2025, and that helping lift the stock today up 10%. Well, coming up, big profits for big oil. Chevron and Exxon both reaping in record profits amid a global energy crunch. We're going to dive into the oil giants' results and discuss the energy sector with Truist Securities' Neil Dingman after the break.
And let's take a quick look at the markets this morning with personal consumption expenditures data out this morning. That metric closely watched by the Fed. Here with more, Yahoo Finance's Jared Blickery. Jared.
Yes, I'm ashamed I didn't get the memo. No pink on me. But let's get to the markets here. I want to check the S&P 500 futures here because I'm going to talk about the inflation readings we got this morning, some of the economic data. Here was that 8:30 release. We got a brief spike up and retracement, but then it was off to the races. Was it because of the below than expected reading in inflation? Probably not. Other things at play here, but I do want to point out the currency situation. U.S. dollar is advancing once again. This is intraday. Let me put this on a 3-month basis, and you can see this is a second day of gains, evidenced by these 2 green candlesticks here, and we are hovering by what are 20-year highs here, basically going back to 2001. You put a max chart, basically going back to this area here where we saw a 120 high in the DXY. Now, composed of this, we have the U.S. dollar advancing again with respect to the Japanese yen, and that comes on the heels of their rate decision where they largely stood pat here, nothing big, no big surprises. But this was the intervention that we got last Friday, and you can see barely having extended, we're still at the bottom of that range. Now, when we had this before in September, in 2 weeks, we were right back up there. So I don't think any of these pressures have eased. We got to look to the calendar next week because we do have an FOMC decision. That's going to come out next Wednesday. After that, we have the labor market. We have non-farm payrolls on Friday. That's a big monthly report. A couple weeks after that, we got CPI. So these are the big things that are moving the market right now. And I haven't even touched on the mega cap earnings, which are also in view here. But I do want to end on something that's affected by currencies. That's the dollar. Excuse me, that is crude oil here. And WTI, you can see, is down about 1.5%. We do have ExxonMobil earnings and Chevron earnings looking at almost record profits for both. Exxon, definitely the case there. We're going to talk about that in a second, guys.
Yeah, let's pick up right there. Thanks so much for that, Jared. Chevron and Exxon, as Jared reported earnings this morning. And it's no surprise here, the world's largest oil companies crushed analysts' expectations. Exxon posted almost $20 billion in profit. That is the best result ever for the company. Rival Chevron reported its second largest profit amid increased demand for natural gas. Joining us now to discuss these results is Truist Managing Director for Energy Research, Neil Dingman. You know, Neil, I feel like every quarter we're saying, are we at peak oil? And here we are talking about record profits again. Is this as good as it gets?
No, I think the simple answer is no. I mean, to call these companies cash cows is probably an understatement. I think I'd call them cash bulls. You all mentioned the earnings of the profit. We simply, I think the big factor being free cash flow. Chevron had a new quarterly record, almost $11 billion in free cash flow. Exxon was just a touch under its record last quarter, still generated over $17 billion in free cash flow. And what's unique about these companies is that they're getting the majority of this from the upstream while having some growth, unlike most of my independents that are basically seeing no growth.
And Neil, this energy crunch that we've seen, so many people talk about it as being something really structural, that this is going to go on for years, countries trying to figure out where they're getting their energy from. So if this continues like this, are we going to be seeing more gains for these companies?
Yes, I think especially for these companies that are not just purely domestic, like obviously the two majors, that if they can open up, Exxon talked about a new record amount of new LNG production they're talking about. They talked about new carbon ventures. There's just a lot of things that they're going to start doing that, again, my smaller companies are not going to be afforded to as they sort of keep production flat. But the simple answer, I think, is absolutely that they will try to expand. But the simple answer is domestically as international, especially Europe, the supply is just, when it comes to infrastructure, is simply too tight. So that not the upstream is going to remain the challenge, the midstream.
Neil, it's worth pointing out this number that I thought was pretty incredible here. Exxon in this current quarter is forecast to post full year profit in excess of $50 billion. So if you look at that, that's more than Amazon, Procter & Gamble, and Tesla combined, right? I mean, what a difference a few years makes when you think about where Exxon was before. This is a company, and not just Exxon, but Chevron too, obviously that is exposed to these cyclical swings. And obviously they have had a huge year. But when you think about where they're putting their money, you talked about some investments. They're also reiterating their share buyback. I mean, is that a smart use of money when you think about where the lows have been for these oil giants and how far they've had to climb back up?
Right. I think the simple answer is that they have two choices. You can either expend it externally or as you said, either some sort of shareholder return. And most of them, even including the majors, just say, okay, what would it cost me to go buy anything on the upstream, midstream infrastructure, new venture side? And on an asset value, what do my shares still trade for? As you said, even with all of the shares like Exxon are basically at an all-time high. The simple answer is still a lot of them that their shares are still trading at a significant discount on an asset value. So I still think it does. Let me say though, they're not buying back near as much shares and paying near as much dividends as some of the independents, which are paying upwards of 75, 85, and 90% of their free cash flow out. So the majors do keep a much more optionality to do other things.
And Neil, Kiko mentioned how these companies have really had to climb from the lows. I mean, back in 2020, you had oil negative. And it's hard to imagine that Chevron, ExxonMobil now have a bigger market cap than Meta. So right now we're watching year to date, ExxonMobil is up 78%. Chevron's up 52% year to date. If investors didn't get into the stock earlier this year, is it too late, or how do you see this in the next 3 to 6 months, especially if the economy goes into a recession?
Simple answer is no, it's not too late. And why I say that is I've been talking to a lot of investors, and to me, out on the street right now, the biggest variable or the biggest sort of, when you're looking at stocks, I think, is free cash flow yield. And right now, the energy group, even these two stocks today, dominate all their sector. I think right now in the S&P 500, of the top 10 stocks in the five, that 7 are E&P companies as far as having the highest free cash flow yield. So I'm definitely aware of the run that all of them had, even Chevron, Exxon included. But again, to me, it comes down to what the free cash flow yield, what you're able to do with that. And right now, the energy sector still dominates all other sectors in that aspect.
Truist Managing Director for Research or Energy Research, Neil Dingman. Good to talk to you on this Friday. Well, coming up with the Fed expected to raise rates again next week. Will the move trigger a global recession? And how can investors position their portfolios in a world of 5% interest rates? We're going to discuss after the break. Wall Street is preparing for another 75 basis point rate hike coming in the next month. Now, a new survey out of Bloomberg is showing economists expect interest rates to hit 5% by March of 2023. Joining us to discuss further, we've got Brian Relling, Wells Fargo Investment Institute Head of Global Fixed Income Strategy. Good to have you in studio today. Feels like the 75 basis points is largely baked in for next week. The question is what happens come December?
Yeah, that's the big question in the market. And I think it's 50-50 come December, whether they stay with 75 or they downshift to 50. I don't think the Fed's going to commit one way or the other next week. It's really going to come down to that data post-Fed meeting, both the jobs report and most importantly, the inflation data we get around mid-November.
Talk to us a little bit about, we were talking during the break, some concerns about liquidity in the bond market, which I've been following as far as the dollar has gotten higher, has risen, even though it's pulled back a little bit. Other countries perhaps not buying as many U.S. treasuries or selling their treasuries to back their currencies. Exactly. So is this a concern that you're watching?
It is a concern. Both we're seeing, as you mentioned, the impact of other central banks, but also our own central bank doing their quantitative tightening, bringing liquidity out of the market. And it's becoming more and more over time, right? So it takes its toll. But liquidity typically isn't a problem until it is a problem. So, I think the Fed will take the steps necessary to make sure the gears continue to run. So if there is just a complete liquidity drain somewhere, I think we can count on the Fed to step in and make sure things at least function properly. But yes, it is a concern, something we're watching pretty closely. And we've seen it at times in the high yield market. There was a short period of time where deals were having difficulty getting sold, as you mentioned. We've seen it other pockets, other places, but it's nothing at this point that's overly alarming, but there are some things to watch out for there, yes.
What does that suggest in terms of where you think Treasury yields are likely to move? The 10-year yield now below 4%. We've seen a bit of a pullback there. Where do you expect it to go?
Yep, so I expect that we're kind of in a process here over the next month or two as we wait for the Fed to downshift, where rates are probably hitting their highest levels that we're going to see. Have we hit the highs yet? It's hard to say for sure, but I do think we're going to hit them if we haven't already at some point over the next month or two. So I do think this is a time for investors to think about maybe locking in some of these rates for a longer period of time. As eventually we head into a recession, inflation moderates, I think we'll get to a point where rates start coming down. So locking some of those levels in now could be attractive over an intermediate term.
And which treasuries would you say?
The longer term, right? So, we've had a lot of investors. There's been a lot of focus on the short end because there's been so much yield there we haven't seen for a long time. But I would start moving some of that longer, start to buy some 7, 8, 9, 10, maybe even longer maturities just to lock in these rates. Because I do think as we move into a recession, inflation comes down, that these rates will look attractive over, like I said, an intermediate time period.
Thank you so much, Brian Relling, Wells Fargo Investment Institute Head of Global Fixed Income Strategy. Thanks for joining us.
Yeah, thanks for having me.
And the bird's freed, or so says Elon Musk, who is now officially in charge of Twitter. But is the Musk Twitter saga really over? We'll get one expert's takeaways on the other side of the break. Elon Musk's purchase of Twitter now sinking in. His first order of business, cleaning house. The new Twitter owner reportedly fired 4 top executives, including CEO Parag Agrawal. Meanwhile, Twitter's stock is suspended and an official delisting is set for Tuesday. What's next for the company and its investors? Columbia University's professor of law Eric Talley joins us now to weigh in. Professor Talley, this has been a saga, to say the least. What do you think is Elon Musk's first order of business and challenge as he takes reins of this company?
Well, he's got a cash flow problem he eventually has to solve. His probably first challenge is sort of a big meet and greet. Remember, he spent 6 months being sort of an adversary to everyone at Twitter, sometimes scaring away employees. And a lot of the employees right now are pretty unsure whether they're even going to have a job next week. So I think that's probably the first mission of damage control or mitigation. But ultimately, he's got to turn this company into a little bit more of a revenue generating entity.
Let's talk about that potential of cuts at Twitter, because there were reports last week that he could potentially cut 75% of the workforce, and obviously Elon Musk sort of came out and walked that back. But there's a financial calculation that's happening here, right? I mean, he has just taken over this company, as you point out, that has struggled. We had our legal reporter Alexis Keenan on earlier saying in some ways it benefits Twitter to fire employees because then you don't necessarily have to pay out the stock compensation that's not vested. Can you kind of break that down for us?
Yeah, the employees at Twitter, just like many of the senior executives, have some of their compensation in terms of stock and bonuses and options and so forth. There is a coming payment for many of the employees that's coming next week. And some have speculated, and I'm relatively confident, at least it's a conversation on the table as to whether if there's going to be a reduction in staff, it would predate the date at which that payment has to be made. It's a little perilous, however, because while the courts in California will let you let go of at-will employees, if you do so merely to avoid having to pay them compensation for services already rendered, that can be a problem. So there is a little bit of a legal sticking point here, as well as a morale sticking point. You don't necessarily want to hand the pink slips to a bunch of your employees while simultaneously stiffing them. That's not going to leave behind a lot of happy campers.
I'm wondering if Elon Musk has put himself between a rock and a hard place when it comes to this Twitter acquisition, basically, or buying this company. And because of this, if Twitter, for example, which is blocked in China, he has Tesla, which operates in China. If a country doesn't like what's being said on Twitter, is he putting himself in a difficult situation?
Well, maybe. I mean, one of the things that is definitely extraordinary about Mr. Musk is that his personality seems to permeate almost everything that he's associated with. Now, it's important to remember that he is not the majority shareholder of Tesla, but he is the most significant shareholder of Tesla. And even earlier reports suggest that they are exploring different ways that Twitter and Tesla might be able to cooperate with one another. I think that that's going to be an issue that they're going to have to deal with going forward. One of the ways to do it is simply to try to ring fence the two companies away from one another. But once you've moved deliberately into sort of the open global marketplace of ideas, that global marketplace of ideas is also going to be part of your own reputational capital. So it's probably something to be concerned about. I don't think it ever really would have been a deal killer, but part of that's going to hinge on how he makes decisions on what the platform looks like in the next 8 to 12 months.
How do you ring fence those companies, though? I mean, can you do that so long as Elon Musk is running both? If we're talking just Tesla, we haven't even talked about SpaceX, but if he's running Tesla and Twitter.
It's a hard thing to do. And that's been an issue that he has faced in a bunch of other companies, not just Tesla and SpaceX, but also Solar City beforehand. So it would be a difficult maneuver, but people do it. It is one of the things that sort of corporate structures are reasonably good at accommodating.
I have to say, I've enjoyed your Twitter thread here that you put out in terms of lessons learned from this. But point number 9, where you say J screwed, by the way, clever use of the J. Crew logo. You say there may be more fun and games in store. Musk could soon decide to refloat minority public shares with his, as you describe it, fanboys bidding up prices Talk to me about that scenario.
Yeah, there's a couple scenarios that could take place from here, and those are two distinct ones. One is, even though now Twitter, as of today, it's no longer a public company, that doesn't have to be permanently the case. It really is caught up with all of its filings with the SEC. It wouldn't be as big of a lift to try to roll out maybe a small fraction of shares. There are a lot of people out there that just are desperate to own anything that Elon Musk is affiliated with. And so putting out that small fraction of shares could give rise to a pretty good price, which then if you triangulate that against the rest of the stock might generate at least what appears to be a very, very valuable company, which would help Elon Musk in raising capital elsewhere. The other thing is that, while he's trying to increase revenues, he's definitely going to want to try to decrease costs. And one of those big costs that he's going to be facing is the interest payments that is due to his brand new creditors that helped him finance this purchase. The J. Crew, reference was really meant to refer to a whole bunch of different companies that in the last 5 or 6 years have tried to restructure their debt commitments, often in very aggressive ways that sometimes lead to severe conflict between the companies and their creditors. And this often will happen in a situation after a private equity buyout where there's a lot of leverage or debt that has financed the deal.
Elon Musk has said that he doesn't have all the answers regarding what Twitter should look like, how it should change, the town square that he's described. So how do you see this playing out? How do you see this sort of unfolding? Because we are living in a very polarized society. Users have been kicked off permanently from Twitter. So how do you see this going forward?
Well, it seems to me that there are two planes on which he's going to have to be making decisions. One is just revenue generation, cost minimization, and much more sort of work a day. How do you run a business? And that is related to, but not identical to, questions about content moderation and how do you curate this large global community of people interacting with one another. I think Mr. Musk has signaled that he wants to have a very, very big tent and then allow people to sort of self-select themselves into virtual communities in a way that sort of allows every flower to bloom. Twitter had that view before. They have run into issues involving incendiary tweets time and again, and that's what kind of has pushed them into their own current content moderation policies. So it'll be interesting to see whether he can pull that off. Thus far, social media companies have had a difficult time with that.
Professor, we just pointed out in the back you have Sonic the Hedgehog sketched on the board. It's a nice touch.
I do. My daughter put that on the board 5 years ago, and I can't bear myself to erase it, so I just have to get a new whiteboard.
Yeah, we like it. We like it. It's a nice touch there. Appreciate your time today. Columbia Law School Professor Eric Talley joining us there. Well, coming up after the break, we'll be in our element. Get it? Element? As we chat with Plug Power CEO Andy Marsh, who's in studio, about the company's green hydrogen ecosystem strategy and the impact of the Inflation Reduction Act on the industry. We'll be right back. Going green with hydrogen. Plug Power is on a mission to tackle energy challenges by building green hydrogen plants to produce 500 tons of liquid hydrogen per day. That's by 2025. And we've got the company CEO, Andy Marsh, with us in studio today. Good to have you on. Happy Friday.
Great to be here, Kiko. Yes, and happy Friday.
Yes. Andy, I was thinking back to our last conversation. This was kind of at the height of the concerns around the energy crunch. And you were saying you were getting a lot of calls coming in, especially from Europe, about how do we invest in this? How do we expand? But since then, it feels like things have softened a bit. I'm looking at where things have been moving. You've cut hydrogen production forecasts. You've abandoned plans for 2 plants. What's happening right now?
Well, I'm going to kind of correct that with the 2 plants at Kiko. One of them I announced previously that we were in a position where we couldn't get enough electricity, so it didn't make sense. The
second, a cost issue.
The second one was we actually never announced we were going to do it, but we announced we weren't going to do it. So maybe a little confusing to some of our investors, but when I look at it, our sales funnel for hydrogen has never been larger. We've had some delays in supply chain, but we have not lost any orders. My sales funnel for electrolyzers, which is the device that generates hydrogen, I think it's probably doubled since the last time we spoke. So I actually don't see this negative. I know how it's been reported, but I don't think it was captured correctly. I don't think we did a good enough job explaining it.
And where do you see this demand coming from? I mean, is this because we saw oil going up so high, and now it's pulling back a bit? Though, are there differences there when we're looking at oil prices sort of fluctuating?
Yeah. So I think and you always have to think a little long term here. If you believe people are going to address climate, people like Bloomberg will say 20% of world's energy will come from hydrogen. Important item about hydrogen and fuel cells is we create a lot more jobs in batteries. And that makes politicians, whether they're fossil fuel politicians or renewable energy politicians, like what we do. And the third one, the national security issues that, the war in Ukraine really has highlighted the importance of us in the free world really dealing with our own energy independence. And all those 3 are drivers.
The broader conversation that's been happening when you think about renewables or green energy versus fossil fuels, it's sort of been framed in this context of a trade-off, right? You have one or the other. The reality is, yesterday we got that report from the IEA that suggests that investments have been accelerating. And I wonder what you've been seeing from companies that you've been working with. Are corporations sort of creating this calculation with the slowdown that's happening in the broader economy that maybe we need to pull back on some of these investments to accelerate the transition, or are you seeing the opposite?
That's an interesting question, Kiko. And luckily, for many of our applications, we actually help customers save money. So when you think about what we're doing with Amazon and Walmart, Amazon was under a lot of pressure yesterday. But when you bring to the table not only renewable energy, but it helps you save money in your present operations by making it more efficient, it's a much easier sales pitch. And during these difficult times, saving money does create value. And look, long term, these companies all have goals for 2040, 2050 to meet their carbon goals. And they're doing it because their consumers want it.
And what's been the impact from the Inflation Reduction Act? Have the incentives included in there helped these companies maybe move in one direction or the other?
Absolutely. If you look at the cost of green hydrogen today, it's lower than diesel fuel. It's lower than natural gas because of the Inflation Reduction Act. It also positions the U.S. uniquely to be an exporter of green hydrogen, especially to Europe. So it has been a real boom to this industry, but I think to our long-term economy.
And you had mentioned during the break that you were creating jobs in New York. So are you able to fill those jobs? I mean, we have heard about companies trying to fill jobs. How is that going?
So young people actually like working at companies that have a mission.
Okay.
And it makes it much easier to recruit young, talented engineers. And some of us old guys actually like working in the future too. So it's actually, one of the things I love about Plug, we have such a wonderful mix of people from 21 to 80 years old who are really helping to drive this transition.
Well, it's great to hear.
Yeah.
Thanks so much, Plug Power CEO Andy Marsh. Thank you for joining us.
Thank you for having me today. It was always a pleasure.
And tickets, get your tickets. We'll tell you how much fans are dishing out to watch Game 1 of the World Series between the Phillies and the Astros in person on the other side of the break. Stay with us.
Sure to, man.
The World Series kicks off tonight for Major League Baseball, and as the Houston Astros get set to take on the Philadelphia Phillies, we're joined by Yahoo Finance's Josh Schaefer to break down the betting landscape surrounding the Fall Classic. So break it out for us.
Yeah, Ness, so a couple interesting trends to watch when we talk about gambling and MLB, and one that I've sort of been focusing on this week is actually a term called micro betting. So you can bet now on every pitch, every at bat, and baseball really lends itself to that. So I spoke to Simplebet CEO Chris Belawakwa about that and kind of the growth in that market. And listen to some of these numbers, guys, it's pretty crazy. So $262 million were bet on this micro betting concept this year, and that means they were betting on the outcome of a pitch, if someone's going to hit the ball or miss the ball or hit a home run, and that handle grew 3 times over the course of the season. So in April, the number was 16.7 million. Then in September, it was 53 million for the monthly handle. So you can see that's kind of how MLB spent a lot of narrative about trying to attract young fans. This is one way that I think they're kind of successfully doing it.
Can we just point out, Philadelphia Phillies. Sorry, this has been bothering me all week. They couldn't come up with a more original name. Phillies.
The Fighting Phillies,
Come
Akiko.
on, yeah.
I thought you were with America's team.
And Fanatics is their mascot. Anyway, I'm rooting for the Phillies in the World Series, by the way, just for the record.
You're going to get some hate mail there.
It's not hate. Okay, so let's talk about ticket prices. merchandising. I mean, this is a very fanatic, very loyal fan base. How have we seen that reflected in the lead up to game one?
So we've used the word fanatic multiple times.
Yeah.
Let's talk about the company.
We're already talking about the
right?
mascot.
Right.
Yeah.
And so Fanatics released some data on the NLCS actually, and what came out about the NLCS merchandise. In 24 hours, they set a record. They actually passed the 2016 Cubs. This is the most sold merchandise ever for the Philadelphia Phillies. You can really see the boom. And then we were just showing the ticket prices, and it shows you the difference between a team that's been good and a team that just got good. So game one is in Houston. The get-in price is $489. Then you turn to Philadelphia, and the get-in price is $743, so almost $300 more. And that's before fees. If you want to go in Philadelphia, you're paying almost $900, and it's a standing room only seat. So it's pretty crazy.
I don't buy that argument because they've been good. I mean, come on. If you're a dominant team, shouldn't we be bringing in the fan base?
Yeah. I mean, I'm from Boston. The tickets are always expensive there.
Right?
But I don't know. Maybe
But
maybe
Philly
some of the
fans are something else. I
But
mean,
I'm talking
I
about
have
the
seen-
Astros. I mean, they've been good for so long. But I don't know. I feel like ticket prices should be higher.
Yeah, no, I don't know. It'll be interesting to see kind of how those move too. I didn't want to touch too many of the records that it might be approaching because we always see the ticket prices move a ton. What if the Phillies lose both games?
Yes.
They play tonight. They play Saturday.
Yeah. They
if
have
they
to
lose
take
both
one
games,
in
maybe
Houston.
people don't want to go.
Okay. Last question. Who are you picking?
Oh, see, I'm on the bandwagon. I think the Phillies are going to win.
But Phillies in 7?
I'd take the Phillies in 7 because it's going to take a while, and I don't know how well they're going to play when they go out to Houston, right?
Okay.
But at home, they've been very good.
Okay, game one tonight. Looking
Excited.
forward to it. Thanks so much for that, Josh. Let's do a final check of the markets before we let you go. We are seeing all three majors in rally mode here with the Dow up nearly 2%, the NASDAQ up 1.7% there. That does it for Inez and I in this hour. We've got much more to come here on Yahoo Finance Live. Keep it right here.
Everyone, futures this morning pointing towards a mixed open. The NASDAQ in negative territory, just barely there. This is all as investors digest disappointing tech earnings, with macro headwinds taking a toll on some corporate results here. While U.S. GDP came in better than expected, with U.S. economy posting its first period of positive growth for 2022. However, things may not be as good as they appear. Joining us now, we've got John Stolfus, who is the Oppenheimer Chief Investment Strategist. Perhaps we start on some of the earnings that have come through. From what you've seen, how does that kind of tee up the rest of this earnings season for you?
Well, thanks for having me on the show. Really appreciate it. It's always good to be on Yahoo Finance. First off, we'd have to say things are actually better than expected. When we look at double-digit returns in terms of gains in the across the board, not across the board, but rather in terms of what has been reported thus far, with 227 companies out of 500 companies having reported, you've got triple-digit earnings growth in energy and double digits in industrials, consumer discretionary, real estate, and utilities. Now, of course, you've got technology is in the red. You've got financials slightly in the red, and both tech and financials are just slightly in the red thus far. So what we've got to say is overall, in a mixed bag kind of environment, what would expect, that's what we're getting. So, I think the effects of higher interest rates beginning to slow the economy, though we have economic growth, as we just heard, in the third quarter. We have a slowing somewhat in terms of the involvement of the consumer, but yet resilience exhibited, if not robust. And job growth continues to be remarkably resilient, even as some employers who have overhired begin to do layoffs because they just had panic hiring.
Hey, John, it's Julie here. I'm trying to figure out, as I look across the tech landscape now, we have some pretty notable busts, right? Meta, obviously, today on the consumer and advertising side, but some of the other misses as well. I mean, Microsoft enterprise spending was supposed to be holding up better. Then you have ServiceNow, which did really well. So, how are you sort of synthesizing and thinking about the big picture when it comes to technology?
Well, when it comes to technology, which happens to be one of our favorite sectors, what we're looking at here is we're looking for, because it's so disfavored, is what we want to look for are the companies that remain profitable, that continue to have good cash flow and pay some kind of a dividend, ideally. So it's really, we're in technology, it's the GARPier, or the growth at a reasonable price area of technology. We always look for babies that get thrown out with the bathwater here when investors are impatient on a quarter-to-quarter basis in that area. And we continue to like industrials, consumer discretionary, and we also like financials, where we think eventually we'll get a steepening real yield curve on a more traditional basis.
John, are investors being head faked by a report, and others, I would say, like Caterpillar? Julie was talking about in the top of the show where new home sales have come way down, yet you have Caterpillar really having a strong quarter. Is this as good as it gets?
Well, I think what it has to do when you look at those, if I recall, the chart you brought up showed that there was strength in terms of in the areas of energy. In one particular area, I think, there we go. Thank you for showing it.
That's why we're here. That's why we're here.
And construction. I mean, all of this stuff is, it depends on where you're building and what you're building to meet needs. In terms of residential, you're looking at slowing, remarkably modest, really, for where interest rates have jumped from the start of the year in terms of mortgage rates. But still, there is this element of resilience in it because the consumer has more money than anyone would have expected at this point with all these rate hikes. And there's a consistency in among businesses to want to have enough employees just in case things pick up.
John, how resilient would those businesses need to be if a recession or a real recession felt, seen through business results, seen through the consumer behavior, doesn't start until mid-2023, as some economists have been expecting, and lasts through, what, 2024?
Yeah, we just don't see it that darkly, and while we are strategists on my team, we have an economist amongst us, and I've been working with economists. I've been in this business for 39 years. I can't believe it, dude. I mean, it's a long time. I didn't start at the age of 12, but it's a long time ago. But my point is, when we look at the economic data, what we do find remarkable is that the resilience that's embedded in it, whether it's related to the consumer, where we have seen somewhat of a positive turnaround, though modest, in the consumer sentiment, And we just recognize the fact that those jobs numbers are not falling drastically. And again, what we do see when we see these layoffs, it tends to be in areas where the employers were panic hiring coming out of the pandemic. And as a result of that, we can't help but think that that's quite normal. The economists who are looking for a recession here will have to see the NBER change its methodology somewhat, because you need to see jobs really fall, and you need to see the consumer really roll over. And that's just not happening this time. And it likely is because there are elements in this that were structured because of what happened with the economy during the pandemic, all the stimulus, the overstimulation, and now a Federal Reserve that while steepening its what the cost of money, it's actually healthy. It's the end of free money, and free money causes speculation, but we don't think it's going to be a draconian kind of effort by the Fed. Ultimately, we think it won't be a Volcker, but will look more like a Bernanke.
And John, just quickly then, what are the implications for when the Fed is going to start winding down its current tightening?
I think we're going to have to wait for that, Julie. I think that it'll happen sometime next year, and we think just the words you used, we think are really very important. I think that it will be a winding down. I think they will sort of ease on down the road, so to speak, when it comes to slowing the pace of the increases in their benchmark rate. I think we're going to get 75 bips. I think it's pretty obvious that in November, and in December, I think the market would be pleasantly surprised with 50, but I think it could live with 75. But I think when we get into next year, it's going to begin to trail lower, because I think the market just needs to feel that the Fed is having an effect at stemming inflation, not ending it at this point in the process.
John Stolfus, Oppenheimer, Chief Investment Strategist. Always good to see you. We'll talk to you soon.
Facebook, Instagram, and WhatsApp parent Meta Platforms forecast a weak holiday quarter and costly year ahead after it missed earnings estimates and slightly beat on revenue. That forecast knocked around $67 billion of the company's total value off the total value, as the shares are down by about 20%. Are its plans to consolidate offices and keep headcount flat enough, considering that more than $500 billion it lost so far this year? Joining now to weigh in is MKM Partners Managing Director Rohit Kulkarni. Rohit, it's good to see you. You still have a buy rating on this stock. Some of your peers in the industry did not disguise their impatience or irritation or frustration with the company on the conference call last night. What did you think of how they're approaching all of these issues?
Patience, and more patience. That's what Zuckerberg wants from the street, and whether they have it, we don't know yet.
But does he deserve that patience?
Yeah. If you look back over the last 7-8 years, probably giving him some credit, we're building some of the largest platforms in the world. So looking ahead next 3 to 5 years, probably I would err on the side of giving him a little bit of benefit of doubt. But right now, they are in a big whirlpool of a negative sentiment. Nobody believes their ability to innovate, fight against Apple, fight against macro, fight against TikTok. So the headwinds are outnumbering Zuckerberg right now versus what his dream, his vision is. And I think there is also a messaging problem here. I think they are making progress versus Apple and TikTok, and they are getting hit on macro as well as metaverse. So there are certain forward progress moves, but I think that's just getting masked by how they're messaging on the next year's spend plans.
Rohit, a buy rating would suggest things get better in the next 12 to 18 months. What gets better for this company in the middle of next year?
Over the next 3 to 6 months, I think one of the drivers would be macro, in my opinion. As in, they already talked about September and October felt better than what it would have been. They're lapping Apple effect. So there are two aspects of the headwinds that I think Facebook should start to feel better about. One is how they're tackling Apple headwinds and how some of the macro headwinds are ebbing. Beyond that, their AI investments should start with how their engagement is trending, and perhaps TikTok headwind starts to ebb and flow at that point. So we are talking about over the next 6 months. That's the way I feel. If I'm right, that's how the stock would unfold. But again, they need to prove that they can be disciplined with costs, and that, I'm afraid, may not happen for another 6 months at least.
What part of the metaverse does Meta Platforms actually have to get right, see some type of user kind of acceleration and adoption of what they're putting on the market versus what Roblox metaverse has already looked like for so many consumers?
Again, I think metaverse, that bucket of investment is going exactly in the opposite direction as compared to what we thought it would at this time last year. I think they're doubling down on the hardware software combo suite. It is almost 10 years ago, an Apple or a Android trying to create their own phones, create their own app store, trying to market the app store and trying to get engagement. All of that in one fell swoop for a new device that nobody is currently using. So I think it's a significantly larger vision than what we thought, and that is going to take more investments. And I think near term, all they need to show is greater adoption of their form factor. Whether that form factor improves over the next 12 months, we don't know, but just overall better adoption of form factor, and that's not coming in yet. So the sentiment is going to be negative, in my opinion. So the only thing they can do is show disciplined costs and reducing spend. If they just tell the world that, okay, we are going to be disciplined and not have more than $2 billion of losses per quarter in metaverse, I think the stock goes up.
I just don't know when that's happening, right? But they didn't show any indication of doing that. To come back to the metaverse numbers for a minute, Horizon Worlds, according to the Wall Street Journal, has only 200,000 monthly active users. 500,000 was the target the company originally set. When do you think they might get to 500,000?
It's been slow going. It has not been going in the direction that they have been. We are hearing more of not just direct to consumer, but direct to businesses, B2B play in the way they feel the VR headsets and VR capabilities may evolve over the next 12 months. So they gave around some tidbits yesterday around how enterprises may be using this. So it's still very early days. We won't see that a company with more than $100 billion in revenues per year, for that to start to show some impact, it's probably going to take a few $1 billion in revenues, and probably we are at least a couple of years away for their virtual reality segment to start to get to, say, $5 billion in annual revenue run rate, just to start to show some moving the needle. It's going to take a lot longer than that. That's where we say patience, patience, patience. And whether investors have that, so far they don't think they have that.
Well, investors are not exhibiting a lot of patience today. We'll see what happens going forward. MKM Partners, Rohit Kulkarni, thank you very much. Appreciate it.
ServiceNow seeing a lot of interest on Yahoo Finance following a better than expected quarter and rather upbeat earnings call. The software company announced CEO Bill McDermott will also assume the role of chairman. Bill McDermott joins us now. Bill, always great to get some time with you. I'm on the ServiceNow ticker page on our platform. Stock's up 15%. My question to you, where's the recession?
Oh, Brian, thank you very much. You know, the waters out there are choppy, and that's why the world seems to need the Now platform and has demonstrated that in their decision making. Look, we have a platform that's truly a once-in-a-generation deflationary force. We're seeing tremendous adoption for not only all things IT and digital transformation, but companies aren't hiring as much. In some cases, they're firing. And you got to do more with less. So this idea of workflow automation to give employees a great experience. On the customer service side, you know, it's one thing to engage a customer, to sell them something. It's another thing in the mid and the back office and the supply chain to optimize the whole experience. And that's where ServiceNow comes in. And I've been saying all along, the digital transformation tailwinds were much stronger than the macro headwinds, but you do have to adapt to the environment. And I'm blessed to work with 20,350 women and men that did just that. Turnkey, ready to run solutions for a better world.
Bill, I want you to expand on this a little bit, because it is just such a different message than we are hearing from some of the other companies within technology and even within enterprise software, right? That they are seeing that choppiness, but it seems to be more of a problem. So, I mean, is it there's something more unique about the company or about the niche that you guys are filling right now?
That's a great question, Julie. This is a very unique platform. You know, there was the operating systems, there was the database era, there was the application software era. We're now in the platform era. And what companies are trying to do is they're trying to drive productivity. They're trying to automate their supply chains. They're trying to rethink their procurement processes. They have to really do more with less. And the reason they're choosing this platform is it is one holistic platform that was engineered for deflation. It was engineered for efficiency, and it was engineered to give fast return on invested capital. So you're seeing a platform that's being adopted by one large manufacturer as an example, that's taking $1 billion out of their procurement costs on the Now platform, and we have them up and running in less than 100 days. This is a major corporation. So this has never been seen in enterprise software. And our brand is now becoming best known for that platform, the Now platform, the digital transformation engine, or the center of gravity of digital transformation in today's modern enterprise. It is all about the technology, the people in our company, our incredible culture, and our ever-expanding ecosystem. It's really fascinating to see how quickly we were able to adjust to a tough environment with the best technology and the best team.
You've got other companies within the tech landscape that want to take the applications that people use, companies are using, employees are using on a day in, day out basis and put it in, you know, a virtual reality, put it in the metaverse. Is the metaverse really going to be real for so many of these applications? Or is that just a pipe dream, perhaps, that we're seeing some of the market move towards?
I think there's a real place in the world for the metaverse, and it is real. But even if you do spend time in the metaverse, you always have to come back down to earth where the real people live and actually execute your business plan. And I think that's where we come in. You know, we have no issue with enabling somebody's dream, for example, to set up a e-mall and become the retailer of the future in the metaverse, creating digital experiences for somebody that they would have never participated before. Let's say a fashion show where somebody can actually simulate in the metaverse that they're in Milan watching the fashion. That's great. And then what's even greater is if they see something that they want to buy, they can actually buy it. And then we can optimize it in a real supply chain, in a real manufacturing process, so we can actually make a real sale. So you're always going to see this interdependency between a metaverse world and the real world where business takes place. And that's where we come in. We play both places.
Bill, for what it's worth, I'm bullish on the real world, but maybe that's just me. Talk to me a bit about your job retraining effort. You talked a little bit about it on the earnings call and the earnings press release, but it sounds like a big initiative for you guys.
It's really exciting, Brian. You know, we announced Rise Up with ServiceNow, and we're going to train 1 million people by 2024. Some of those people will work for ServiceNow. Many of those people will work for partners of ServiceNow, and many of those people work for customers of ServiceNow. We realize that this is a once-in-a-generation platform, and this is a once-in-a-generation opportunity to grow super fast and make a real difference in the world economy. You know, there's an $11.5 trillion deficit based on the skill deficit in the world. We believe it's the opportunity deficit. So by 2028, we're going to help the world close that $11.5 trillion GDP deficit by bringing ServiceNow and literally millions of people in the ecosystem to ServiceNow, so we can transform the businesses of our customers in the public and the private sector all over the world. Super exciting time.
Bill, I'm sorry I lied to you last time we had you on and said we'd talk basketball, because the NBA season did just start back up. So next time we will have to talk a little basketball. CEO of ServiceNow and Chairman Bill McDermott. Thanks so much for the time, Bill. Also, everyone, strength in the banking sector here. It's continuing with Raymond James reporting a beat in revenue and estimates. Banks and finance have recently seen a boost from higher interest rates, but Raymond James is also taking careful note of what it calls a challenging and volatile market environment. Joining us now to talk about earnings and the sector, we've got Paul Riley, Raymond James CEO, in a First on Yahoo interview. Great to have you here with us this morning. First, as we were breaking down some of the earnings that have just come across and largely the season that we've been navigating through, if there's kind of a common denominator or a set of them that you've been taking away from this, what are they from your perspective?
Well, first, great to be here, and it's always good to be on the show. There's just a lot of uncertainty, and I think this is the great thing in our business is people need their financial advisor more than ever. You have uncertain equity markets. All you have to do is listen to 4 or 5 speakers with different views, so it's not certain where we're going. The Fed clearly has said they're going to continue to raise interest rates, and inflation numbers high. The GDP number was actually good today, but again, that shows the economy is going. So it's, you have to pick stocks. You have to pick your choices because it's a very uncertain market. And frankly, in the last almost decade, as long as you were in, you did pretty well. And that's not the case today. So, and investors are, they're individuals, they're in different situations. Some are still longer term and they can take the downs with the ups. Some can't afford the risk. And now fixed income is giving them a chance to invest in. And most people are in between. How do I balance the long-term bets and equities against inflation versus making sure I have income? And, so it's a complicated environment, but it's a chance to really, show your value also.
Paul, it's good to see you. Thanks for being here. If people are coming to you because they're concerned about the environment and they want advice, as they seem to be, what is happening in terms of their willingness to pay for it? I did see asset management fees were down 6% collectively. But I wonder what's happening on an individualized basis. Have you been, we've been talking to everybody about raising prices. Are you all raising your fees?
Well, you look at, with us, the advisor really has the primary client relationship, and the fee pricing is really set with them, with our oversight, but to what they're doing for their client. And what we've seen is most advisors aggressively managing fees in terms of what funds they go in, how they're managing, what the cost is to the investor, but to the end client. But surprisingly, those fees with the advisor have held up extremely well. And it just shows the value. The value isn't just investing, it's psychology. So many people wanted to get out of the market pre-COVID, they would have lost a huge opportunity. Or they can look at the down in the last few months and say, well, look at my down. And they can remind, look, you're on plan. This is your plan for your life. You were up, more than you thought. You're down a little bit now, but you're still on plan. Stay invested so you don't get hurt. And that value, and almost a family psychologist in many cases, has shown that people are still willing to pay the fees, and the fee to the advisor themselves has been under surprisingly a lot less pressure than the overall cost for us to produce, more effectively.
Paul, a lot of your peers in the industry are now looking at a lot of belt tightening as the industry has slowed. What are you doing inside of Raymond James?
Well, we're trying to be very thoughtful. So first, we have comp pressure, as the whole industry has seen. We started talking about it a year ago when, before people did, and we're going to treat our people well, both with our record results this year and quarter, but also because that's the market today, and we have to make sure we keep people. We can only belt tighten so much. We're still growing. We're growing across all of our businesses. And, so we're still recruiting and hiring people. So the focus is, where do you spend smartly and where do you stay focused? Like, for example, our tech spend is going up. Our technology, for which we believe is leading edge, industry leading for our advisors in terms of wealth planning, we can't let that slip, because that's what's driven our continued top of the industry recruiting and retention. And now the apps to the individual, clients. Again, we got to invest there because that's part of the market. So in other areas in the back office, we pride ourselves in top level service, and we have to push to be more cost efficient. And what technologies and processes can we use to keep those costs in check? So we're still in a growth mode. We're cautious on the economy. The great thing about the company, well before I got here, it's always been long-term focused. We've been criticized maybe over the last few years of having too much capital and liquidity. We aren't right now. And, so in bull markets, maybe we look like we're, being too conservative, but we plan for these kind of markets, and it's showing up in our growth, and we still have plenty of balance sheet flexibility to operate, even if we do have a hard landing.
When you think about the absence of easy money policies and what that means for some of the more speculative assets that even the wealthiest clients that you may deal with would be prone to perhaps nibble at in the past, where have you seen that strategy start to wane and perhaps shift into some of the other spaces, and what types of recommendations are you providing them?
Well, you'll still see that as kind of, cyclical. So certainly when rates move quickly like they have, so if you go to the bond market, certainly the non-rated bonds and things get hit first and get hit hardest. But at some point at that price adjustment, that's when, the very wealthy or hedge funds or investment funds see the opportunity to invest. So it's really calling when that happens. So you have to look through the whole cycle and look at the opportunities for those clients. Now, a lot of clients don't have that extra net worth, so you got to keep them down the middle, but others that do have that ability, it's kind of a wait and see and strike when they see the opportunity. Now, if you believe there's going to be a hard landing, that means there's going to be a lot more opportunity and you keep powder dry. If you think this is going to be a softer one and you're going to get a pickup, then, you can be a little more aggressive now. And we see clients on all sides of that right now. So it's, again, not an easy call to say, where are we going to be 6 months from now? But from a company standpoint, with our flexible balance sheet, we didn't lock in rates, what a lot of our competitors did. And we're seeing the benefit of that now. And we just don't try to focus on maximizing short-term earnings. We're saying over a cycle, what's the right thing to do? And so even if it gets into tough times, I like where we're positioned right now.
We always appreciate your soothing tone, Paul, especially in these crazy times. Always good to get some time with you. Raymond James CEO, Paul Reilly. We'll talk to you soon.
Okay, let's keep the conversation going around Meta. We've got Laura Martin, Needham Senior Media and Internet Analyst. Laura, we Inez and I are talking about what we heard on the call yesterday. We didn't even touch on the digital ads part of it. Reels certainly one that Facebook, Meta has made a big bet on. They said they haven't been able to monetize it in a big way, but that was interesting in your notes. You said there was a deafening silence of this historical ad business that has been the big revenue driver over the years.
Yeah, I thought the most interesting takeaway was the silence. I thought the best question on the big call that everybody could hear was, everything you're talking about is new. This all sounds very experimental. Why isn't it experimental to you? And what about the old business? And I think, I think Mark's answer was like either he's not focused on the old business or he doesn't think there's a future in the old business. But nothing they spoke about yesterday actually is the business that today is worth 300 billion market cap and used to be worth 700 billion market cap. It's almost like he's walked away from the core business that is making historically has made all the money. I thought that was the most interesting thing from the call.
And Laura, I mean, when you're talking about walking away from the core business, I mean, should he be focusing on Facebook? Is this what investors want? They don't want this sort of experimental into the future, and especially during a time like this. Do you think timing has something to do with this?
I mean, I thought your point was fair that the market right now wants current cash flow. It wants to bring lower risk, so it wants cash on cash returns. I think the way I read his choices is he's worried there isn't a core business unless he can stymie TikTok. Like that he's worried TikTok is going to take away all of his content creators and his audience. And like MySpace, when you may recall, Facebook took all of MySpace's value away. It sounds to me like he's worried TikTok is going to take all of his value away unless Reels works, which is his knockoff of TikTok. So it just feels to me like this is a business at Facebook where every 10 years, Snap comes along and he has to copy it or die. TikTok comes along and he has to copy it or die. One of these days, you won't be successful copying the hot new thing. And I just wonder if there's actually a business here that is defendable.
Yeah, I mean, Laura, to that point, we were talking about the tough environment Meta's already dealing with in terms of regulation. We know what the track record is with these acquisitions, whether it is an acquisition or taking an idea from another company. When you look at where they want to go with the metaverse, I mean, how convinced are you that the innovation internally is there to make this, even if it's long term, a viable business?
Look, I think Facebook has realized, or Meta now is realized, that it doesn't control its destiny. It doesn't own its content because content creators are leaving it right now to go create content on TikTok and taking their fandoms with them. And it doesn't own its distribution platform because it's sitting on Apple, and Apple is capricious and arbitrary about changing its rules. And Apple doesn't really care if its rules hurt Meta. So I think Meta's answer to that is to let's create a new computing platform like AR, VR, glasses, where we are the platform background. We charge everyone else 30%, and we change our rules capricious and arbitrarily and hurt apps on our platform. I think that's their play there. I think this really stepped up when Apple started making privacy changes in the fourth quarter of 2021. So I think he's realized, like a lot of apps have, that so long as Apple or Android control the policies on their platform and they are answering to regulatory fears on their end, and no app is safe. No app controls its destiny. So his play with the metaverse is to actually own the hardware that is the platform that consumers use. So he can charge 30% and change rules.
So, with that said, Laura, what do you value this company at? Is it about the future play? Is it a metaverse play, or is it still a social media company that just hasn't been able to compete in an increasingly crowded environment?
I would say the latter, that I think it's hard to value because it's unclear there is a core business here if they can't successfully replicate TikTok with Reels. So I think the core business value is a big question mark, especially maybe outside the US is okay, but in the US it really is worrisome. And then the metaverse, you have to put in order to value this company, you must decide, is the metaverse going to work? Or are we going to write off $10 to $20 billion a year in his spending until he figures out it's not going to work? So I think that's the issue with valuing this company now. It's hard to value the core business in a network effects business that's going the wrong way. And it's hard to value what the metaverse will be worth, because at the earliest, he's saying it's going to be worth something in 2030, which feels like a long way off for investors. So I think investors are doing the right thing today by using their liquidity and exiting the shares until it is clear what the value of either the core business is or the value of those metaverse investments are, both of which are really hard to value today.
Yeah, certainly a steep fall from yesterday when you look at where the stock is down right now. Laura, always good to get your insight. Laura Martin Needham, internet analyst there.
Last time mortgage rates were north of 7%, the first Spider-Man movie had just debuted in theaters. 8 films and 3 Spider-Men later, the 30-year fixed is back above 7 to 7.08%, up from 6.94 last week and 3.14% just a year ago. That's according to Freddie Mac. Let's talk about the housing picture with Mike Fratantoni, Chief Economist and Senior Vice President at the Mortgage Bankers Association. Good to see you, sir. So where are these rates headed? Will we see 8 before we see 6?
It's a good question. And I would say one of the prime features of the market today is just an incredibly high level of volatility. Rates are bouncing around like crazy. So if you look at the 10-year Treasury today, it's down about 40 basis points from a recent high. And that tends to be a benchmark that mortgage rates track pretty closely. So day to day, it's unclear where we're headed. But I think over the next 6-12 months, we're likely to see mortgage rates lower than we see them today.
How much lower, Mike, do you think?
So our forecast is probably back to about a 5.5% rate. So I don't see any way we get down to the 3% rate we had in 2020 and 2021. But 7% is really unsustainably high as well. And we think there's 2 forces out there. The Fed is pushing up short-term rates to try to combat inflation. But on the other hand, we're forecasting a recession for next year. And there's a lot of global weakness that's going to be putting some downward pressure on longer term rates. And that'll really be helping to bring mortgage rates back down to a more typical longer rate.
So how would you characterize the impact of these higher rates in terms of how they have hurt the housing sector? And let's push towards 23. What will happen to home values?
Yeah. So really beginning this spring, sort of late May, June, it was just sticker shock. We saw borrowers that were looking to buy a home, their mortgage payment was $400 or $500 more than when they first sat down to come up with a budget for that home purchase. So people just backed away. But I think as we get into 23, again, we have the challenges coming from a weaker economy and likely a rising unemployment rate. But then the benefits of, we think, mortgage rates drifting lower. And one of the biggest challenges home buyers faced the last couple of years was just the lack of inventory on the market. We think it'll be a little bit easier to find a home in 2023. There will probably be fewer situations of that multiple bids above list price. And I think for that, particularly that first-time buyer, it'll be really more thoughtful exercise. You won't have to make the offer the minute you see the home. You might actually have a little time to think about it. But from a housing market and mortgage market perspective, it'll be a slower market in 23 than we had in 2022. We think mortgage originations are going to fall about 9% in 2023 compared to what we saw this year. And this year, volume is about half what it was last year.
Wow, a huge drop expected there into 2023. So given that, then we've already seen a number of layoffs within the mortgage industry. I guess, how do you see that playing out then if you're expected it to slow down even further next year? How many cuts could we potentially be looking at?
Yeah, so in the mortgage industry, there's the 2 types of loans getting made, right? There's refinances, which are entirely rate dependent. Those have just shut off this year. We're down more than 85% in terms of refinance loans compared to last year at this time. Purchase loans have also dropped again due to the sticker shock phenomenon. But we have an estimate that peak to trough, with the peak being in late 21, the trough being in early 23, the industry is probably going to lose 25 to 30% of employment. And we're probably about a third of the way there so far. So you're still going to see additional layoffs and some consolidation in the sector.
And that is part of the Fed goal, of course, is not just bringing down home values, but of course helping out with the labor market as well. There are many that fear the housing sector could be the one thing to break because it is the first one to feel the pain. How concerned are you?
Yeah. So you look back at business cycles over the past several decades, you regularly would see the housing market weaken first when rates first went up. But by the other end of the token, we expect the housing market's going to rebound first as well. So I think the recession will probably be in the first half of 23, but as rates drop, buyers re-enter the market. We expect we're going to see housing lead the economy out of recession as we get into the second half of 23.
So then, Mike, speaking to that, I guess comparing the situation that we're in right now to what we saw back in 2006, 2007, 2008, and I bring that up because of the delinquency rates. And I know it's something that you are tracking very closely, but where we are today, it's not too far from that record low that we set in May. So what does this tell you just about the comparisons that some people are drawing to today to what we saw about 15 years ago?
Man, I would say it's night and day, right? 2006, 2007, you had a housing boom like we'd never seen before. You saw very loose mortgage credit, and you saw really an abundant supply of homes on the market. Coming into this, housing supply was really quite tight. Credit criteria are extremely tight, both because of what lenders are doing, and then really some of the regulations that were put in post Great Financial Crisis have really locked in really traditional underwriting and sound credit behavior. So I think the housing market is in relatively good shape. And again, the undersupply is a real critical factor here that is going to prevent home prices from really dropping the way we did see during the Great Financial Crisis. And I think it's also going to lead to a rebound as we get past this period of weakness and as mortgage rates return to more typical levels.
Yeah, certainly a very different situation what we were looking at in the last recession, right? Mike, Fred, and Tony, great to have you. Thanks so much for joining us. A rail strike that could cripple the U.S. economy is once again a possibility after a second union voted down the proposed contract. And the strike could happen as soon as next month unless all 12 rail unions vote in favor or Congress steps in. Here to talk a little bit more about this and the labor market at large, we want to bring in Tom Perez, American Bridge 21st Century co-chair and former labor secretary under President Obama. Secretary, it's great to see you. So let's start with the rail strike because that's really front and center today. Clearly, stakes are very high right now. The possible strike coming at a time when the economy is already slowing. It seems like a pretty attractive possible agreement here, 24% wage hike, yet that doesn't seem to be enough. I guess from your position as former labor secretary, what do you think needs to happen in order for these two sides to reach an agreement?
I think they'll get there. And, by way of history, I remember when the West Coast ports in 2015 were on the verge of strike. And President Obama dispatched me out there. And there were a lot of predictions of gloom and doom. And we were able to reach an agreement. And when you have so many different unions involved, it's always a challenging process, but I have confidence that they'll get through because there's a real win-win opportunity, really win-win-win, win for the workers, win for business, and win for consumers. And I think there's an acute appreciation that we cannot afford a work stoppage right now. And so I think they will get there. And I've been involved in these dynamics, and it's always darkest before the dawn, and I think they'll get there.
Indeed, and you mentioned the dock workers. They are currently working without a deal. A strike is possible there as well. And Amazon is trying to unionize and Starbucks is trying to unionize. Is this just the tip of the iceberg and a result of this tight labor market?
Well, workers have leverage, and I think that's good. And they're using that leverage. And you see a lot more activity in unionization, whether it's at Starbucks stores or Amazon facilities. I think that's a good thing. And I think you will continue to see workers flex muscle. And you look at the public opinion data, the public opinion of labor unions is at its highest mark in decades. People understand that unions help bring us the weekend, and unions have helped bring us shared prosperity. And so you're going to continue to see this across the country. I think it's a good development. And I think unions, management, business, consumers can all succeed together. And that's what we have to do. Make sure that workers who are toiling every single day get their fair share of the pie.
Speaking of workers, the labor market, I want to bring up a letter that Senator Sherrod Brown recently sent to Fed Chair Jay Powell. He sent it earlier this week, coming ahead of the Fed's meeting next week. And in that letter, he wrote, for working Americans who already feel the crush of inflation, job losses will make it much worse. We can't risk the livelihoods of millions of Americans who can't afford it. So, of course, this brings front and center the debate about what the Fed should be doing. Are they at risk of overshooting? I guess now, do you think it's time for the Fed to pause, or what do you think the Fed should be doing at the next meeting?
Right. I hope they don't overcompensate. And when people ask about inflation, inflation is real. I feel it. You feel it. At the same time, remember where we were. I remember when I was labor secretary, and what we saw in 2009 was the stimulus bill wasn't enough. And when I got to the Labor Department, we had millions of long-term unemployed folks, many of whom are 50 and above, less than a college degree, who'd been out of work for a year and a half. And you know what? They were in big trouble. We didn't have to deal with this time because we had a robust stimulus plan. Did it, contribute to some of the inflation? Possibly. But I will tell you, I lost a lot of sleep over the millions of Americans who had lost their job for a year, 2 years, and frankly, were hard-pressed to get it back. We don't have that problem. We don't want to create that problem by overcompensating. So I hope the Fed will take that into account in their next meeting.
But Mr. Secretary, Democrats were fiercely critical of President Trump for criticizing the Fed when he would raise rates. Why is it okay for Sherrod Brown and John Hickenlooper to do the same thing?
Well, I think they're simply addressing a concern that a lot of people have right now, which is that if the Fed takes action, which results in a recession, people are going to lose their jobs.
But doesn't that jeopardize the independence of the Fed?
No, the Fed is going to do what the Fed does, but the Fed doesn't operate in a vacuum. And I look at Senator Brown's letter as simply a plea for them as they make decisions that they're going to be making to understand the doctrine of unintended consequences. I don't see that as exercising undue influence. He's not saying if you do this, we are going to do X. He's just saying, please remember, please look at history. Please don't overcompensate.
Yeah, and I think it is raising some eyebrows, obviously, given the time of it, the fact that we are only 2 weeks, less than 2 weeks until the midterm. So speaking of midterm, Secretary, I want to get your thoughts just on the messaging that we've heard from the White House, because today, pivoting once again, focusing on the economy. And over the last several months, I think the feeling out there is that the messaging from the White House has been very mixed. I guess, first off, what do you think the messaging should be or needs to be over the next 2 weeks?
We have your back. We climbed out of this pandemic. We've created 10 million jobs under Joe Biden. We had the quickest recovery from the pandemic in U.S. history. We see manufacturing moving at a wonderful clip. Look at the investment in the CHIPS Act, a company in New York announcing a multi-billion-dollar investment. We're bringing down the cost of prescription drugs. We are working on the issues that matter most to you. And we are protecting a woman's right to choose. These are the pocketbook issues. These are the issues that people are thinking about. And that's why, in a normal midterm environment, we'd be prepared to get shellacked. But this is the most fluid environment I've ever seen. And it's fluid because we have put points on the board. we have been fighting on the right side of issues for people, and we've got to make sure that voters understand that as they head to the polls.
But the singular issue that you hear in poll after poll after poll that matters to Americans most is inflation. And it is still out of control. And that's why, or part of the reason why this NBC poll found that Americans trust Republicans on the economy 20% more than Democrats. So will that message from President Biden sell?
Well, we're going to continue to make sure that people know the facts. I mean, the Republican response to today's challenges is let's cut Medicare and let's cut Social Security. Those aren't my words. Those are things that Republicans like Ron Johnson have proposed. I don't think that's going to help people in any way, shape, or form. And so, we're now at the stage of this campaign. It's about turnout. We have election after election. We could go over Wisconsin, Georgia, Pennsylvania, et cetera. We've got all these elections that are razor thin. And I think in the end of the day, we are going to surprise so many people because we saw in those 5 special elections post-Dobbs, Democrats doing well, and not just in blue areas, but in places like Kansas. And so this is a turnout election, and that's what Democrats are doing, and they're doing it well. You see the early vote numbers in a number of states are, frankly, eye-popping. I think Georgia is going to exceed their 2020 early vote numbers. And so it's going to be razor thin. We're swimming upstream against historic tides in midterm elections, but notwithstanding that, we're very much in the ballgame because we have put points on the board, and the president deserves a lot of credit for what he has done.
We'll see the outcome in just 12 days from today. Secretary Perez, always great to have you. Thanks so much for joining us.
My pleasure. Have a wonderful day.
In this episode of Influencers, Dice founder and CEO Phil Hutchin, along with Tony Fadell, Dice board member, Nest founder, and inventor of the iPod.
Humans need to be around other people. I mean, it's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your lives.
There's always unintended consequences in everything, and technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Phil Hutchin, the founder and CEO of Dice. Also, Tony Fadell, a board member at Dice. Tony, as you may know, former Apple executive, iPod inventor, iPhone co-inventor, also Nest founder, and a principal at FutureShape, which is an investment and advisory firm working with engineers and scientists, developing foundational deep technology, I should say. Got all that. Okay, we want to talk about Dice. And Phil, why don't you start us off by telling us what Dice is all about and what you guys are doing?
Yeah, no problem. And nice to see you, Andy. Well, first of all, Andy, have you ever bought a ticket?
Yes, I have.
And how was that?
Not so good, Phil.
And so I think that every time we kind of ask someone if they bought a ticket, that has ever come back to me with like this, like, oh my God, it was amazing. It was always like, I bought a ticket, I thought it was one price and it was another price, or I couldn't buy a ticket and it was thousands of dollars or whatever it was, or, I missed out on the show, whatever it is. And so there's lots of problems around it and, the opaque nature of the industry. So Dice is a super simple way to find out what shows are going on. 2 taps and you've bought the ticket. It's killed scalping. And if you can't turn up to the show, you tap a button and you get a refund. And it's just making all those things traditionally associated with, going to a live experience, they're gone. And now it's just very easy.
I have a million more follow-up questions and we'll get to them. Mm-hmm. But Tony, I got to ask you, you joined the board of Dice in September. What made you a believer? And why join at a time when the live music industry is still getting back on its feet with COVID?
Sure, Andy. As well, it's great to see you. So, So for me, music's in my blood, given my past, and I'm from Detroit, right? So when I was in Detroit, exactly, Ticketmaster first came out, and it was like a revolution. I could go walk down to a local store and get a printed ticket. You didn't have to go to the box office. And so that was an incredible innovation for me. But since that part, they haven't innovated a lot. It's still like, okay, what can we do to extract more money from the fans, really is what it is. And it hasn't been about more convenience, about more access, making it easy. You can say what you want about airline ticketing or other travel ticketing. At least you can exchange tickets, upgrade them, change the dates, everything. You don't have any of those conveniences at all in the entertainment ticketing world or sports ticketing world. Well, that's what DICE is trying to solve. And because I'm such a music fanatic and have been suffering with these things for years, I met Phil, and I didn't just get involved with DICE this year. I've been involved with Phil and DICE, 5-6 years now. So this was like literally when they were like 10, 12, 15 people. So we've been working together with them and just been, because of the experience that they really want to bring. Fans first. It's all about the fans. Even the artists, the venues, everyone understands that. More fans. And especially today when, bands are not making any money except for merchandise and for entertainment events. Other than that, they're not making any money on streaming. We see that unless you're the top, 100 artists, they don't make any money. So where are they going to make their money, and how are they going to make sure the fan has a great experience? That's what DICE is all about.
Phil, I got to ask you about the competitive set. I mean, Tony mentioned Ticketmaster. They're still around. StubHub, Eventbrite. What sets you guys apart from those companies, and how are you going to build your brand?
Right. So I think I kind of touched on it. Like, our only customer is the fans, and that was something that we established on day one. So everything that we build is for that fan experience. So when we're building things with partners or venues or artists or anything else, we always ask the question: is it good for the fan? And I think that the second thing is that DICE is just software. So, if you're looking at Live Nation, I mean, they do huge productions, they do all these things, Ticketmaster is part of it. We just like the using software to bring fans and artists closer together, like helping them, decide which cities they're on, how much they should be charging, all these things to make it super efficient. And I think that the third is that we're able to scale much quicker around the globe. So, I mean, we started off in London, but now we're in the US, in France, Spain, Italy, India, Australia, moving into Southeast Asia. So it's like, it's kind of, there's a global network effect that happens as well, because you're giving that data to artists to help them plan global strategies themselves. So it's just really, when we're talking about empowering artists, it's like helping them control their cash, so they own the cash. They can pay people and do things instead of waiting for someone to pay them.
How do you mitigate against scalpers? You mentioned that. Can you drill down a little bit more there?
Yeah, cool. So this is, I mean, it's like one of those things where in hindsight it's like so simple, but there's nothing to sell. When you buy a ticket on DICE, there's no ticket. And so there's nothing to screenshot, there's nothing to pass on to somebody else or anything else. Just moments before the show, there's like an animated a QR code that goes around, which is there. But it's a very elegant, simple solution, but it's a way that if you've got nothing to sell, then it's impossible for scalpers to put it on any platform because they don't have anything.
And how much of the business, Phil, is reliant upon the return of live music to pre-pandemic levels? And what is your prediction about when that'll happen?
So we've just spent 18 months or, give or take, like sort of stuck in our homes, been entirely digital. And you're thinking about, one of the things that I didn't appreciate, at the beginning of DICE and kind of really kicked in sort of just before the pandemic, is that we saw some data in terms of loneliness for people aged between 17 and 21. And a third of them expressed that they had intense periods of loneliness, even before the pandemic. You put the pandemic on, everyone kind of living digitally. The return to live since summer, it's been insane. I mean, every record has been broken at DICE in the last 5 months. When we're when we're looking at the data, like still now, shows are completely packed. Like the venues are packed, everything else. You read in the newspapers that people have become hesitant about stuff, and then you go to live concerts and they're absolutely full. And I think it's kind of going back into what I was talking about with learners, that humans need to be around other people. I mean, it's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your life. So, live experiences, I think that people are actually appreciating them even more as a result of the pandemic.
Yeah, Phil, I've been giving Tony grief about musical preferences. I'm going to hit you a little bit. Like, I don't know if it's Adele or Coldplay. I'm doing the UK thing with you. So do you work with the artists or do you work with the venues? So in other words, here in New York City, MSG, Madison Square Garden, are you selling tickets for them or are you selling tickets for Adele?
So we do it for both, but the focus is largely on venues because many artists play venues. But we have an artist development team, and that's part of the idea of the global network is that DICE has venues all around the world, and then artists want to play those venues, and we help them kind of connect them with those venues via their agents or the bookers or whatever else. And then part of that is, so I've got an example. So there's an artist in London called By. They started off with us from the very first show, 200 people. And we made the deal with them like, cool. sell exclusively through Dice. And let's kind of like build up this live story. And then from that, you're not allowed to spend any money on social media advertising. You got to trust into your audience, but get the story right. Now they can sell 50,000 tickets in London, and it's kind of like taking them at each of those steps all the way through. And throughout the whole time, Bicep understood their audience. They knew what they wanted, where they wanted to play. They had control over, their live strategy, and this is what we're doing at scale now.
Right. And so do you cover all the venues in the world, or are there some venues that are not a part of your ecosystem yet?
Yeah, so we wish we had. Well, we have all the best ones, or most of the best ones. So there's some holdouts, but there's other people who have the ticketing rights for those venues. But we have it's 3,600 venues sort of around the world, which is increasing, day by day. And we also work largely in major cities. So in New York, over 1 million people used Dice last month. And so there's quite a big spread of venues in New York. And for that, it's the same in Paris and Barcelona, all these things, because there's lots of events happening there. So the discovery engine is really kicking off. And our thing is that if you want to see a show once a month, then let's get you to a show once a week. How do we reduce the friction for you to actually, get there? So, our competition is like people staying at home watching, Netflix. Is like, okay, well, how do we make it as easy and compelling to kind of get out and see something? And it works. I don't think anyone's been to a great show and said, well, I'm not doing that again. So it's the exact opposite.
Tony, while I have you here, I got to ask you a few questions about Apple and the iPhone and Silicon Valley.
Oh, God.
So you were on the cutting edge in designing the iPhone, but it's been around for a while. What do you think is kind of the next big thing in terms of consumer tech? Thoughts on the metaverse? Those are two big questions happening right now.
Well, the big things on the horizon for consumer electronics, we're hearing more about, augmented reality and these kinds of things. We're hearing about the metaverse. Frankly, I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse. So let's make sure we have an environment to live in before we find another environment that, keeps us in like refrigerated chambers and, so that we can breathe and eat. So that's how I feel about the metaverse, but on consumer electronics, I think, a lot of this stuff, people think that this is going to be the next big thing, like augmented reality. I think it will be for certain very niche verticals, but not necessarily like the consumer thing that you need. Because, we saw this before. You got to need the technology, and then you have to understand that the consumers want it, right? And they want to live with these things on it. And it's social acceptance, not just you accepting it, but the people around you accepting it. And that I've learned all the time is, the technology might be right, but is the social timing right? Is there a social acceptance? And are you truly delivering a pain killer because there's a clear need? There's a clear pain. The iPhone solved a need, right? It was on the go, internet, email, media, these kinds of things. Well, we don't see the need yet for the metaverse, and then to have the metaverse wherever you go on you. We already tried that with Google Glass. I think it's going to take a little while.
Yeah, and speaking of Google, you helped create the iPhone, the iPod Nest, which was bought by Google, and these products are networked now in a huge way. What is your take on both the upside and the downside of this massive amount of networking that some people say, leads to dystopian possibilities, but also tremendous upside?
Well, look, there's always unintended consequences in everything. And technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. So we have to do things that promote social bonding, like what Phil's doing with Dice, right? Not letting the ticket bots in there, not letting the scalpers in there, doing all the things necessary. And that's why I love what Phil and Dice is doing, is they're trying to bring all the best things to connect the artists to the fans, right? And getting rid of all of those middlemen who are just stealing along the way. So that's what we want to do. And so I love the network. It can have better shows. have the artists make more things for their fans so that the fans have a better and better experience. And maybe through that, we can create even more social movement to fix some more of these problems. But it's about bringing people together and not about a network of, intermediaries stealing along the way.
All right, just one more Wayback Machine question.
Okay.
Okay. And that's, you worked with Steve Jobs.
Yeah.
Apple built a music business when you were there. What did you learn from Steve, and what do you think he'd be thinking about the world today and the technology that we're using?
Well, I think for me, what it was all about in the music store and the iPod, it was always about, what do the customers really want? What is going to give them that that emotional experience that they crave, that they want, and a rational part of that, making it simple and all those other things. And that's that's like Dice. So when you see something like this, you're like, wow. I think that if Steve was here today, he would go, we need to get artists more money. I think if he looked at the streaming services out there, I know how much he loved musicians, bands, and wanted to support them. I remember way back when he was looking at buying certain media companies, that kind of stuff, because he really wanted to revolutionize that. And so as far as I'm concerned, if he woke up today and saw the streaming services the way they are today and where the artists are not getting fairly paid, he would fix that. Absolutely.
I remember Tony and Phil when he came by and demoed the iPad at Time Inc. when I worked there, and he played music and he played Friend of the Devil. And I said, oh, the Grateful Dead. And he goes, I love the Grateful Dead. You can see he really meant it, right?
Yeah.
He was really passionate about that. You come from a musical background, a music industry background, I should say. But geez, what made you decide to get into ticketing?
Yeah, I mean, I wasn't tech before going into the music and not knowing anything about the music industry. So very naive, but very lucky in the music industry that, found some artists who were getting bigger and bigger, and actually didn't care about ticketing, didn't understand it, because you spend so much time, working with the artists and making an amazing album, to make an amazing artwork, looking at their live show, and didn't think about the ticketing until the artists started getting bigger in North America, and that was when I suddenly was like, hang on a minute, we did a deal for $40 and now the ticket's 65. Where's this 25 going? It's sold out and it's been sold for hundreds, thousands of dollars, and all the fans are angry at the artists. Like, why isn't anyone fixing this? And so then I went back into sort of old world, new world together, and just analyzed all the ticket companies and tried them all out. Didn't want to, just trying to see if there was a solution. And that was the thing. Well, if no one else is going to fix it, I guess that we have to do it. So, and kind of just touching on to the last question as well. I think that take a lot of inspiration from what Tony created. Really thinking about the small things. The experience when someone sees it. Small little animations within the app, the ticket, the imagery. You're talking about brand before, like people wear Dice t-shirts and have the bags and everything else. Like all these things are like things which we really care about, because you need to make a revolution, and all this stuff like pays off because eventually, because of all these things being put together, artists make more money in the right way.
I didn't really ask you about the business model, your P&L. How are you doing? How's the company doing? So can you dive into that a little bit quickly?
Sure. As I mentioned before, it was the, we, in the pandemic and coming out of it was like, it's a shock. I mean, we went from no one going out to everyone going out. Yeah. And, from 0 people in New York, like sort of going out to, 1 million people going out. So, we have it's over 1 million in New York in the last month, 1 million in London, 500,000 in Paris, like all these people sort of coming together. How we make money is that we charge the venues or the artists for using Dice as their partner to sell the tickets. So it's like we're very pro privacy, and so the again, just protecting the fans from this, but also everyone knows like how we make money. We make money from selling the ticket. There's no advertising, nothing else that's on there. And in terms of the volume is like it's accelerating as Tony knows, like every week right
well
now.
Let me be clear, we're happily writing checks, and we're backing these guys, and even in the darkest of times we see the light, and we see the growth, and we see the fans, and they're coming back, right? It's sticky. People love it. They're telling their friends about it. We do very little advertising. I meet a ton of people. I go, yeah, I'm an investor in Dice. It's like, oh, I'm a user. Like, there's so many people. If you actually ask people in the regions where we operate, there's a lot of people using it. We just don't sit there and market it. And, it's self-marketed because the fans love it. And so that's why we keep investing, because we know this is the future, and it already is here today.
Word of mouth seems to be working. So are you guys venture back, Phil, IPO in the future, perhaps?
Yeah. So yeah, we're venture back and public listing in the future for sure. Yeah.
Great. And Tony, how did you guys meet?
So interestingly enough, I had friends in London, and they said, "Oh, you have to meet Phil. You guys would get along. You love music. He's doing something really cool." And Phil and I just were at a hotel. I think it was the Ham Yard, and we just had a drink, and we just started talking, and we talked all about music, and then we started talking about books, and started sharing titles, and just getting into psychology of like the fan, and what does it mean, and why do we love shows, and really just hit it off. And it was just there. I was like, okay, that's it. And Dice was tiny. It was just a vision. And so it was really about a team and a mission, and Phil as a entrepreneur and visionary.
And Phil, where do you see the company 5 years, 10 years from now? I mean, doesn't it have to become part of one of the, well, they used to call it FANGs. I guess they're MANGs now. Part of an ecosystem. Everything's got to be part of an ecosystem. Or can it be a standalone, do you think, going forward?
Yeah, I think it'd definitely be a standalone. I think that live entertainment, how people look at the TAM, the market right now, I think it's undercooked. I think that it's huge. I think that if you've got 90% of the population of the world liking music, maybe half the population loving music, and 30% of people love music so much that they pay to go see it, and that's a massive market. And I think that, what we're seeing is growing this around the world. I mean, like, for example, we're just starting off in India. That market could be as big as the US within 10 years.
Right. I love the TAM thing. That is a truly small set. People who hate music. I hate music, right? You don't have to worry about that. That's a pretty small group of people, right? It's pretty funny.
It was the same TAM for the iPod. It was the same TAM for the iPod.
Right. Yeah, that's about right. That's about right. Just everybody. And final couple last questions here. Phil, what do you think that you want to be your legacy?
Wow. I have to think about that one. Okay, you know what? It's the idea. One of the things I love the most, is the idea that we're in Mumbai and there's a scene happening in Mumbai, and there's this new music that's happening in Mumbai, and through the connections of Dice, that artist goes straight into the US and Asia and through Europe and blows up. And we do that time and time again. That the idea of bringing culture sort of around the world, that would be awesome.
And Tony, same question over to you. You've got all of these things you've accomplished working here with Dice, and I'm sure you've got all kinds of other things percolating in your brain. What do you hope to accomplish over the following years?
For me, it's really about, mentoring and investing my time with the entrepreneurs who are truly changing the world for the better, whether that's environmentally, socially, or for health. Those are the three big things, and Dice is doing that for the social experience all around the world. It's amazing, and that's what I hope Phil is able to fulfill and bring this mission, and I think he's well along the way to delivering.
Well, it'll be great to watch the company grow as we hope we emerge from COVID and live comes back and people get interested in your business. So I want to thank Phil Hutchin, founder and CEO of Dice, and Tony Fidel, board member there and entrepreneur and an executive extraordinaire. Thank you guys very much for your time.
Thank you so much, Andy.
Thanks, Andy. Great to see you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Welcome back to Yahoo Finance. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. It's not only an earnings-heavy morning with a profit warning by Amazon hanging over the markets, it's a busy day for econ data. And Julie, fresh read on consumer confidence coming in here.
Yes, coming in a little bit ahead of estimates, very slightly. 59.9 is the reading from the University of Michigan versus the 59.6 that was estimated. The current conditions index, a little bit higher even than that, 65.6 versus the 65 estimated. Expectations, 56.2, a tick better than estimated. And inflation expectations pretty much in line. 5% is the one-year inflation expectation, 2.9% over the next 5 to 10 years. This is the final read on these numbers here. So this is not necessarily absolutely fresh data here, but nonetheless, we are seeing some areas of strength here, as pointed out by Joanne Shu, who is the Survey of Consumers Director at the University of Michigan. We are seeing buying conditions for durables up 23% in the month. So some still not terribly discouraging indications. By the way, we talked about PCE earlier. Consumer spending comes out as a part of that PCE report, or alongside it, I should say. And personal spending ticked up 0.6% in September, which is better than estimated.
Yeah, it's been interesting to track the divergence among some of the affluent parts of the economy, but as well here, low-income consumers are really pointed out within this report too. Low-income consumers reported sizable gains in overall sentiment. Consumers with considerable stock market and housing wealth exhibited notable declines, though, in sentiment. That is interesting to see.
Is this too, Brad. Noting at the bottom, uncertainty over inflation expectations remains elevated, indicating that inflation expectations are likely to remain unstable in the months ahead. Not probably what the Federal Reserve members want to hear.
Yeah, maybe not.
We're also continuing to watch shares of Apple this morning. Those shares were actually higher just before we got to the 10 a.m. hour. Right now, moving on up by about 5% on the day after the tech giants beat earnings expectations for the fourth quarter, but fell short on iPhone sales. Joining us now for a deeper dive into the quarter, JP Morgan head telecom and networking equipment analyst Samik Chatterjee. Samik, great to have you here with us this morning. First, we got to look at the iPhone sales. I mean, this is still 60% of the product revenue, 47% of the overall revenue that they bring in. And we don't get that breakout of the actual kind of generations that are being purchased. But if there's anything that you would point to, what would you say about the consumer with the relation to some of the iPhone sales demand that we've seen thus far?
Yep. No. Thanks for having me on the show, and happy Friday, guys. Really solid earnings print, and you saw a solid revenue print from Apple as well. I think relative to the iPhone, to your question specifically, what you can see is Apple's threading the balance between sort of volumes and pricing, or the price increases that they've taken in international markets very well, right? So you can see there's obviously a delicate balance here, given how consumer spending has been tracking, that you need to really be able to drive to deliver resilient results, and Apple has been able to do that. I mean, we've in our data seen some changes here and there, in the sense that there are customers that are moving to the Pro and the Pro Max on the iPhone 14 lineup, so preferring the feature upgrades, and then rather than buying the base model, sometimes preferring to trade down into the iPhone 13. But I think net, what you really want to take away from the iPhone results that you mentioned is, one, Apple remains supply constrained in the RAM quarter, so that's driven some of that miss. But that said, it's still managed to thread that balance between pricing and volume fairly well.
Do you think going forward, we've been talking about potential, if not recessionary signals, certainly slowdown signals from a number of different companies. Is that going to start to affect Apple in the out quarters? I mean, when you get in Amazon, for example, making a holiday forecast that is broadly disappointing, does that have implications that maybe people are going to buy the lower priced iPhone for the holidays, or maybe they're going to get something else entirely?
Yeah, no, great question. I think how we've been looking at this is, as you think about the September quarter that they just reported and the December holiday quarter, you probably will not see as much impact in these two quarters, because there's more of sort of the buying at the high end, people probably using more and more the monthly installment plans and still preferring to go for the higher end products. Typically what happens, you do see a sort of mix down going into the March and the June quarters. And if you do, I mean, we're not really going to bet here that Apple's going to be completely immune from the macro impact, but clearly there's a product cycle in their favor where they've just launched the new phone. So when you think about even the holiday quarter, I think that the momentum there carries through the December quarter. As you get into March and June, we'll sort of have to evaluate where the consumer spending stands. But again, what you'll probably find is it's not going to be a surprise that volumes are going to suffer a bit more as consumer spending pulls back, but also because you've taken the price increases in some of these markets. So again, you're trying to sort of balance it out in terms of where you get to in terms of revenue outcomes. And that's where I think the real sort of upside here is, given how the macro backdrop is. Obviously, not everyone on the street is expecting iPhone revenues to be up next year, but what you're seeing now is a greater likelihood that iPhone revenues could be flat to up next year, even despite the consumer spending pullback, as well as sort of comping very strong growth numbers. So that's where the upside is. That's probably what the shares are showing you, is that people are believing increasingly in the resilience of the portfolio, including iPhone.
Samik, how big of a downside risk is China?
The China market itself obviously has been softer, right? So we're seeing that across the Android OEMs a lot more than we're seeing with Apple. I think two things are in favor of Apple when it comes to market share in that country. Obviously, some of these restrictions that have impacted Huawei are still continuing to sort of play out in terms of benefits for Apple. Not only are you're sort of selling more phones to new sort of upgraders and switchers, but obviously there's a large installed base of Huawei phones that will steadily come through the market and have to purchase new phones. So iPhones have the opportunity to capture that share. And you're also benefiting from the product cycle and consumers increasingly sort of switching into the iOS ecosystem. The benefits of the ecosystem are starting to play out in that country as well. But clearly, it's a market that's a bit more challenged on the consumer spending side. Particularly for us, the watch point is some of the events coming up around the e-commerce events coming up in that country and sort of what promotions are driven around those events. And so we could see a demand uptake around those events, promotional events in the country, but we're closely going to monitor that and see how sort of it trends from here on.
Apple just raised prices for music subscribers. Do you expect within the services realm that they're going to be increasing some of their other prices?
I would say yes. I mean, the expectation would be that you have headwinds both in terms of inflation as well as in terms of sort of currency in the international markets that you need to adjust for, right? And so the combination of that is probably going to be reflected in a pricing sort of across the board, product, services, et cetera. So you're really looking at more broad-based price increases at this point. Not all of it necessarily means that you're offsetting FX on a completely. You're probably still going to have a net sort of modest negative in relation to sort of when you net that out. But I think that that's a fair assumption that you have this inflationary backdrop and currency that's going against you in the international markets. So you do need to raise prices. And again, I think what's really the results are showing you is the pricing power that both the products and the services have, which is again getting appreciated by the share price reaction today.
JP Morgan analyst Samik Chatterjee. Samik, really appreciate the time and the context that you've provided around these Apple earnings that we've been chewing on all morning here. Thanks so much. And everyone, switching gears, let's take a look at the markets right now as we are just about 38 minutes into today's trading activity. Taking a look at the NASDAQ, we've seen that move into positive territory. It's up by about 0.5% right now. Changing this over to an intraday look, and perhaps we'll get fancy with some candlestick charts. Also, that's up by 51 points there. Dow Jones Industrial Average, you're seeing that up by about 1% right now early in trade. And then additionally, the S&P 500, that's up a little bit more than 0.5%. Do want to dive into some of the retail names, though, here on the day as well, especially considering what Amazon had kind of warned within their earnings call after they reported earnings, saying that consumers are cutting their budgets and trying to save a little bit of money. And we'll make this equal weighted just for the sake of giving you a fuller view of what's taking place and some of the retail landscape. Perhaps investors taking warning to that comment from
Welcome to Yahoo Finance Live on this Friday afternoon. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on today's rally as we kick off the final hour of trading. You're looking at the Dow up just over 800 points, S&P also holding on to gains up nearly 2.5%. Taking a look at the NASDAQ 100, that's rallying 3% today above 11,500. If you take a look at the action that we have seen over the past 5 trading days, starting with the Dow, you can see the Dow over the last 5 days up just around 5.5%, on track for its 4th straight winning week. Taking a look at the S&P 500, that's also in the green over the last 5 days, up nearly 4%. The NASDAQ 100, we have certainly seen a wild swings here play out in the tech sectors. We've gotten a number of disappointing results from some of those larger cap tech names, but despite all of that, NASDAQ 100 on track to close the week up nearly 2%. And taking a look at some of the action that we've seen playing out in the bond market, the 10-year yield pushing higher once again today, back above 4%. And you can see the 30-year yield also pushing to the upside right around 414. Taking a look inside at some of those individual movers, the NASDAQ 100, I mentioned some of the disappointing results. Amazon, their guidance for the 4th quarter falling short of what the street was expecting. We're seeing that reflected in the moves today, off just around 7%. Apple, on the other hand, beating expectations on both the top and bottom lines and really helping to reassure some investors out there that maybe it's not as bad as it had initially seemed for tech, at least for Apple, to say the least. That's stuck up just around 7.7% today. And taking a look at the broader market action as we count down to the final hour of trading, all 11 of the S&P sectors trading to the upside. Technology, real estate, communication services among the leaders there. Energy, also a big story today, up just around 0.5%. If you take a look at some of those individual names, Exxon was out with its earnings report this morning. That stock up just around 3%, beating the street's estimates there, as well as Chevron. You can see Chevron moving to the upside, up just around 0.6%, Dave.
I tell you what, it's the weirdest recession we've ever seen, if indeed we are headed to one, isn't it? All right, let's get you up to speed now on Elon, on that little blue bird. Twitter is officially his problem and his company closing the $44 billion deal. Shares are now suspended. Musk promptly cleaning house, firing CEO Parag Agrawal, who reportedly exits with a $42 million pay package. CFO Ned Siegel also let go with Twitter's policy head and general counsel. Musk later tweeting, "The bird is freed." The SEC confirming the deal and that Twitter is now part of X Holdings, Inc. Banks, including Morgan Stanley and Bank of America, agreed to provide the $13 billion in debt financing. Elon also secured $7 billion from private equity investors, including Larry Ellison, as well as a Saudi prince. Former President Trump, who some expect to return to the platform, celebrating the return of Elon, saying it's now in sane hands. Moments ago, Elon posting another tweet, and an interesting one, addressing concerns about moderation. Twitter will be forming a content moderation council with widely diverse viewpoints. No major content decisions nor account reinstatements will happen before that council convenes. Let your imaginations run with what Elon will do with Twitter. But let's talk about it with Ray Wong, Constellation Research Principal Analyst and Founder. Ray, good to see you as always. Happy Friday, sir. Big picture, just your reaction to the last couple of hours, Elon closing this deal and promptly cleaning house in the C-suite.
Happy Friday. Elon had to take some bold actions, and some of those actions was to fire some of the rot that he felt was really happening at Twitter. It's a sign of things to come. But I think the bigger picture is really, what's he going to do? You know, what are the next steps? And I think a lot of people have been waiting for that. We've seen the reinstatement of Kanye West. We've seen the move towards that content moderation board, and I think that's a very important first step. But there's a whole bunch of innovations that he's going to have to unlock, really, to get investors to come back, and more importantly, that people have faith, especially given the macro conditions of what's happening with digital advertising in social networks.
Well, right, digging into that a little bit deeper, because I think that is a huge question here. What is going to make this a more compelling investor story? You laid out some of the plans in terms of content moderation, also welcoming some people like Kanye West, supposedly back to the platform here. What else do you think Elon Musk should do to make Twitter more appealing to investors?
Yeah, one of the things that they're going to have to actually figure out is how to actually add subscription services, add new service lines. They've got to bolster digital ads with memberships. They also have to take a look at, their role in terms of content and content creation, including more creators, more influencers, getting them back onto the Twitter platform. They've lost a lot of them over the last period as people go to Insta and TikTok. What can they do to jump in? I think that's going to be one of his first challenges. Then the second challenge is really, how do we actually get to maybe the super app that he's talking about? There's probably a lot more regulatory barriers than he probably realizes at this moment that might stop him from being able to do commerce or finance or be able to be like the ultimate like WeChat app. But there are opportunities as well to actually build out additional services and capabilities. Commerce or payments might be too hard, but be able to enable commerce, enable identification to be used in other areas for transactions. I think that's going to be one area that he could look at.
Just some clarity on this Kanye issue, because again, that statement said no account reinstatements will happen before that council convenes. Kanye's account is now visible again on Twitter. He is not tweeting, so there's a little confusion there. It did reappear today. Is that a coincidence? We're just going to have to wait and see for comment from Elon. But let's talk about two things, Ray. One, you talk about the subscription model. I'm just curious, what would you pay for a subscription model on Twitter? And if, big if, voices like Kanye, Donald Trump, even Steve Bannon return to that platform, is that one advertisers will return to?
Well, that's going to be the big question. What is being done to actually bring back advertisers and what might offend advertisers? We're in a culture at this moment where a lot of people are upset. They get offended by other people being on there. And I think what Elon's trying to say is, it's a bigger tent. It's got to be a bigger tent. People might have to tolerate, some voices that they might not like. And if advertisers like that or not, we'll have to see what happens. But the Content Moderation Council is there to create those policies. And those policies are going to be able to dictate, hey, here's why you might get a different voice. You might get a different opinion in order to actually create a bigger tent. So I think that's the first part. Services I would actually pay for, well, I think, being able to create broadcast services are going to be important. Accounts that actually give influencers a bigger voice, I think are going to be important. Places I might place like analytics and information insight. I want to know trends, right? I remember back in the day, the Yahoo Buzz Index, right? Being able to see the trends of what's hot, what's not, being able to aggregate that. And, I might even want to participate in surveys and other areas where my feedback is actually being paid for and actually being used to improve other products, services, and consumer goods.
And right, Twitter's just one of the big stories playing out in tech this week. We also heard from a number of the larger cap names. Let's start with Meta, Alphabet, and what we heard at the beginning of the earnings season when it comes to Snap. And the theme there is this pullback that we're seeing in advertising spend. We've seen the reaction play out in the names, Meta falling over 20%. We saw the reaction in Alphabet off just around 7% following their disappointing earnings. Anything in there surprise you? And why do you think we saw such a severe reaction play out in the market?
Yeah, we're seeing a big reaction, and it's really because we have 5 macro crises that have come together that have not been resolved. Infection, which is the virus, inventory, which has been supply chain, inflation, as we've seen, interest rates, and of course, this invasion. None of those have been resolved, and what that's doing is creating a lot of concern in marketing budgets. And what people are doing in every organization is they're trimming down their budgets, and this has hit digital advertising more quickly than any other area. And so in the case of Meta, you look at their market cap, they're below $99 or $100 for the stock, which is pretty indicative of what's going on. And of course, that spillover hit at Google, especially on the YouTube ads. And of course, it spilled over to some of the areas around where Microsoft is playing. And of course, you're going to see some spillover in Amazon's digital advertising.
Been a fascinating week in big tech. You got Amazon trading at its lowest level since 2020, Apple having its best day since 2020. Is there anything to learn thematically from Apple's earnings, or are they just a safe harbor? Is Tim Cook just a master escape artist?
Apple's the only Matana stock doing well, and they've been a good job in terms of creating a moat. It works this way. You got 1.2 billion devices. You manage to build services on top of the devices. You've managed to retain customers. They're spending more with you consistently. They're buying new devices across the ecosystem. They've got it down. They're probably the smartest digital giant that's out there. Now, overall in the market, it's been crazy. Big tech stocks have lost $550 billion this week. We've lost $3.5 trillion since November. We've down 3.5 trillion since 2022, but we're down 10 trillion in market cap since November 2021, when valuations were set up in a different, very different light. And so this is having a lot of spillover. But there is something to learn. I think it's really important. We just did a customer business confidence survey, and what people are investing in are analytics, automation, and AI. And there's a series of enterprise tech stocks that have been doing well, from ServiceNow to Oracle, because they're playing in those areas.
Right, you quickly mentioned Matana there, and you said Apple was the only one holding up. Also in that group is Microsoft, Tesla, Alphabet, Nvidia, and Amazon. Are you still, I guess, does that investment thesis still stay intact then? Is that still holding up in terms of names that you like, or how has that changed because of these results?
It hasn't changed if you're a long-term investor. You can see like the pullback that's been going at Microsoft and Alphabet today. It's because the cloud services businesses is amazing. If you're in it for the midterm to the long term, this is probably a great buying opportunity. We might be at the bottom. We never know where we can predict that, but it sure looks at it this way, especially giving some indications of where the Fed is with interest rates. As a really good friend of mine calls it, this has been the world's biggest margin call. And, I think we're done with the margin call. Now we got to figure out where we are with earnings. Since valuations have been hit, can we sustain earnings? If we can sustain earnings, we will avoid the credit crunch and, of course, the unemployment and, of course, the hit on the housing market going forward, which is typically how recessions fall in terms of the domino effects that happen.
Well, for the broader market, it looks like, at least for now, they're able to shake off some of those underwhelming results that we have gotten in the tech space this week. Ray Wang, always great to have you. Thanks so much.
Hey, thanks a lot. Happy Friday.
You too. Well, we are just getting started here on Yahoo Finance Live. Coming up, more on the fallout from Elon Musk's Twitter takeover. Find out what the future could look like for the social media giant. With the World Series beginning tonight, we speak with Major League Baseball's Chief Revenue Officer. And Amazon shares falling sharply following a disappointing earnings result. We'll break down what Amazon's report could be telling us about other retailers heading into holiday shopping season. Don't go anywhere. Amazon shares taking a pretty big hit today, falling on weak sales guidance for its very important holiday quarter. So what does this tell us about the state of retail heading into the holiday season? For that, we want to bring in Jerry Storch, Storch Advisor, CEO, and former Toys R Us CEO. Jerry, it's great to see you. Say Amazon guiding between 140 to 144 billion. The street was looking for 155 billion. But the question to you is, what does this tell us about the holiday shopping season? Could it potentially be weaker than maybe we initially thought?
Well, I thought it's going to be weak for quite a while, and I think it's just confirming evidence of that. Retailers have mountains of unsold inventory from weakness earlier in the year, and they started all the holiday sales early. But history shows it's really difficult to grow the holiday just by starting the sales earlier. So they probably pulled some sales forward into early October. Now we've got the election sucking up all the oxygen. Then we'll come out of it. But by and large, the reality is it's going to be a very promotional holiday season. The consumer is clearly weakening when you look at the data. With inflation rising so rapidly, necessities like food and gasoline, a lot of money is going to those kinds of things. People are simply having to spend more to get the same thing. So it's going to be a tough holiday season. Look, you see warnings from everyone. Something like Mattel. I mean, toys have always held up well during holidays, but they're saying they don't think so this year, that it's going to be pretty tough. And Hasbro already has reported some weak numbers there. So I think Amazon's number is just confirming that it's going to be a difficult holiday.
Is that a positive consumer story and a deflationary story for the economy, Jerry?
Well, if you mean because everything's on sale, that certainly works to some degree to do it. But what you're seeing is there's just massive numbers of units that are selling at this, at this very, diminished price, but it's not necessarily what people want. I was heartened. I'm an Apple shareholder, like I think almost everyone in the world is, one way or the other, right? But heartened by Apple's success. You see, if people will pay for what they want. The problem is retailers have all these products people do not want. And so, the question is how much do you have to put them on sale before you sell something nobody wants? And I think we're starting to find out the answer to that. So I think it's going to be difficult regardless. It certainly had some deflationary impact that you have all this inventory that has to be cleared. But when you look at the data, it doesn't appear to be overwhelming this double-digit increase in necessities, in food. Gasoline, it's down versus where it was earlier in the year, but it's still up high double digits versus last year at this time. So you have a lot of and housing has gone literally through the roof in terms of prices, and obviously interest rates are rising by Fed intention. So we see the consumer having to spend their money on a lot of things other than holiday gifts.
And from a retailer's perspective, they're also dealing with the stronger dollar, worker shortages. From your view, from the checks that you've made, have these situations improved at all, specifically the worker shortages?
I don't think the worker shortage is improving very much. The supply chain issues have mitigated somewhat, but of course that's because retailers are slowing down their purchases with all of this glut of inventory out there, and with what most of them have, which is a very very subdued outlook for the holiday season at this point. Again, there are very few, other than some of the luxury brands, very few retailers who are saying, wow, this is really fantastic. It's going to be the best year ever. You get some good reports out of people like some of the food companies, some of the CPG companies, but that's exactly what we're saying. They're raising their prices, and consumers, their necessities, or people view them as such, and you get good numbers out of those sectors.
Jerry, speaking of bloated inventories, Adidas has a very interesting inventory issue with loads of Yeezy merchandise, their signature product. What do you expect them to do with it? And what is the comeback story for a brand that's so closely identified with someone that they had to cut ties with? Is it similar to what Nike would have to do if, God forbid, they ever had to cut ties with the Jordan brand?
I have to tell you, I don't know what's going to happen to the inventory that's been produced and not sold. In the old days, which is totally unacceptable these days, they probably would have dug a hole in the ground and dumped it in there. That's happened more than once in the history of retail to an unsaleable product where it's just cheaper to dump it than it is to sell it. Maybe they'll try to strip the badging of it and sell it on ultra discounted channels. There's always somewhere in the world there's someone who will buy something, so they'll get rid of it. But it's basically worthless inventory at this juncture. Adidas has been struggling for a long time. That predates this issue. Nike has been so clearly number one in the space and done so much better than they have. And this was one bright spot in their world. And they're going to have to take a clean sheet of paper and say, what are we going to do now? Because they had a problem before this, and now it's doubled down.
Well, Jerry, if you were the CEO of Adidas advising him right now, how would you navigate this issue? Because there is backlash clearly that Adidas had waited so long to cut ties with Kanye West. There was the hashtag boycott Adidas that was trending on Twitter last weekend. Do you think those types of, issues are going to linger here with the company for quite some time?
No, I really don't. I mean, I think they took the tough action, and it's a little, it's easy for some people to say, hey, we won't do business with them anymore when it's not a big part of your business. It was a bold step, and I think a strong statement on Adidas's part, and I commend them for it to take the action that they did. So I think that'll vanish in terms of the concern. What they need to do is find product people want to buy and sell that. And that's where they've been struggling, at least compared to Nike. I mean, Nike has just been spectacular, let's be honest. And as we were just talking about, even they have inventory problems, right? And they said, oh my gosh, we have all the stuff that didn't sell earlier, plus all the stuff we ordered that all came in at once, and now we're way over inventoried. So I think we're facing a very, very difficult period as we look forward here.
No one seems immune.
No, and when you look at it, I mean, it's not a surprise. I mean, we all took at least one economics course, right? And you can't just keep spending money and not expect it to generate inflation. And the only tool that we're using right now to mitigate this is increasing the interest rates. And clearly, low interest rates and lax Fed policy was one factor leading to inflation. But we all know it was also the COVID pandemic, supply chain issues, worker shortages, and government spending all over the world. Not just in the U.S., but massive government spending that led to the kind of inflation that we're seeing right now. And if we were a different country other than the U.S. and didn't have such a sort of a bedrock currency, if we were Greece or something, people would say you have to cut your spending and balance your budget if you want to get inflation under control, right? Well, we're never going to do that. So all we do is just keep raising interest rates until eventually the only thing that can happen is that we plunge ourselves into a real old-fashioned recession. So I'm a little worried about that. I have to be honest with you, and I don't think we're in a good place. So, but
you're not alone.
Christmas always comes.
You're not alone in those concerns. Jerry Storch, good to see you, sir. Enjoy the weekend.
My pleasure.
All right, coming up, it's almost 5 o'clock on a Friday. So what better time to talk beer and shares of AB InBev up more than 1% on this Friday on strong Q3 earnings. The company's CEO joins us next with Brian Sozzi.
AB InBev raising its guidance, saying beer sales have accelerated. Brian Sazzi is the CEO of the world's largest brewer in studio. Over to you, Saz.
Thanks, Shauna. Yeah, joining me right now is AB InBev CEO Michel Ducaris. Good to see you. Good quarter from you guys this week. Is this just revenge partying in its finest form?
Good seeing you. And thank you for having us. No, I think that is more business momentum that is cutting across the different geographies that we have and is building as we execute our strategy. And of course, consumers are celebrating and having more cheers everywhere.
Yeah, no, there's a lot to celebrate, just getting out of our houses after 2 years. But you know, there's a lot of concerns, economic concerns. The economy around the world is slowing. You're a global brand, of course. How does that impact beer demand?
So beer as a category is very resilient. And if I would say to date, what we've been seeing is beer is growing globally. Volumes are up. It's gaining share of throat. So this growth comes part from beer taking from other alcoholic beverages in different markets. And as you know, beer is an affordable item. So when you have economic recession, downtrends, usually consumers maintain consumption in beer, or they even uptrade because it's very affordable to go from mainstream beer to premium beer. What could be different if you change your car or if you go on an international trip? I think that demand is holding. Beer as a category is very resilient. You don't have a lot of penetration on items such as like private labels. So even though people sometimes change channels, they don't change the brands that they love.
I definitely don't want a private label beer. That's not my jam. But look, in this environment, do you see people trading down? And obviously, I'm a consumer of your product, from a Bud Light Platinum, you know, a more premium type of beer, to a good old-fashioned can of Bud just to save a couple bucks.
Not yet. Globally, we don't see this. Premiumization, as I said, as a trend, continues to go and is doing well. You think about our global brands, more premium brands, this quarter, they grew very well, led by Corona that grew revenues 23.5%, while we grew revenues 12%, a little bit above that in the quarter. So more premium beers continue to move. Is almost unstoppable trend, I think, in the category. A lot of headroom to continue to premiumize.
Let's talk about some of the products on this table here. So I've had one of those. I had one of those last night. I have not had one of those in a while. That I've not had. But so this, talk to us about this. What category is this in from your portfolio? How big a brand is that? And even something like Cutwater as well on the other side.
Yeah. So you know traditional beer very well. We have here premium, low carb. You should definitely try Budweiser Zero. Is amazing.
You got me with the label.
Is one of the go-to brands that I have right now because you can take any day, any occasion. And there is this traditional categories as we speak about, like beer, wine, spirits. But this is inside out type of view. Consumers really look at occasions and what they want to drink. And there is a big portion of consumers out there that they prefer flavor, convenience, and this so-called beyond beer fourth category is emerging across the globe. In the US, it's something that already has like 10 years that people see this in different shapes and forms. And neutral and Cutwater, for example, are a manifestation of that. Those are made with real spirits. One is a vodka seltzer that has juice. The other one is a full cocktail. You can have a Moscow Mule, you can have a Lamaritas, several different Mai Tais and products, high quality, awarded premium spirits from Cutwater that we also do in a convenient package that is ready to drink. It's growing very well. Both brands are available nationally and doing very well in this space. Sources a lot of volume from wine drinkers, from spirits drinkers. Very incremental to our business and delicious. You should try it.
Yeah, sounds like a party in a can to me. I know you're very excited about the World Cup. What is a sales estimate? Do you have a sales estimate on how big the World Cup could be to your business?
So first and foremost, I'm excited because I'm a fan, as billions of people out there, and a serious fan. We were talking before.
We were talking before. You seem serious. Yeah, I compared it to watching my Yankees, but clearly it runs deeper than that.
I love the games. I'm going to be there watching as many other fans across the globe. And it happens every 4 years. It's the biggest sport event on earth. I think that this year will have a totally different connotation because of post-pandemic. If you travel around, if you go to sports events this year, you cannot have a ticket, right? So it's all fully sold. I think that FIFA will be also big. We are activating 70 countries. In the years that we have FIFA, usually our volumes go up between 0.7 and 1% for the year.
Nice boost.
And the tournament is 3 weeks, but it's global. So numbers from FIFA say that like 2.5, 3 billion people watch the games globally. There are celebrations in each and every country. We'll be activating in 70 countries with the local brands and local passion points, but also with Budweiser, which is the official sponsor of FIFA World Cup Qatar.
Lastly, before we let you go, it's 5 o'clock somewhere. All those viewers on the Yahoo Finance platform probably looking for that cold one. What's your favorite beer? I know you must get asked that all the time.
I like beer, period. Every time that I need to go for one, I love Budweiser. And after moving to the US and having the chance to live here and work with AB and the colleagues here, Michelob Ultra is another outstanding one. But I love beer. Budweiser is the one that I prefer the most. Take your zero whenever you can, or a Michelob Ultra.
I'm taking it, believe me, I'm trying very hard not to pop the bottle on that one. Well, welcome to Yahoo Finance. Good to have you on, Michelle Ducaris, AB InBev CEO. Now it's Shauna. It's time for a drink, Shauna.
It is time for a drink.
We need to get it on.
I'm with you. I want to try some of that cut water, so hopefully you guys can save me again. I have to say, my favorite beer is Bud Light with a fresh lemon. I've been doing it for years.
Who puts a lemon in a Bud Light?
A lot of people judge it. I get some weird looks when I do it. But it's very, very good. And I recommend everyone out there, you have to try it next time you're out at a drink, or even if you're having a Bud Light at home. All right, coming up next, Pinterest bucking the trend. Its shares moving higher after earnings, unlike rivals Meta and Snap. Find out why next. Time for Triple Play. 3 stocks that we are watching in the final 30 minutes of trading: Gilead, Intel, and Pinterest. My pick today is Gilead. Shares getting a big boost on strong earnings and also a couple of analyst upgrades. Gilead's third quarter results topping expectations, and the biotech giant upped its guidance. Sales for the quarter was $7 billion, down slightly from $7.3 billion a year ago. But Piper Sandler and JP Morgan both upgrading the stock to overweight from neutral, while Truist upped its rating to buy and lifted its price target to 91 a share, about 12 bucks higher from where we're trading today. Truist is bullish on Gilead's oncology pipeline, which it says will continue to grow over the next 18 months. If you take a look at today's jump, just around 13% year to date, though, the stock still, it looks like it's actually holding on to gains up just around 17%, Jared.
That's right. And I'm looking at the Wi-Fi Interactive where I have a 1-year chart up, and we can see this nice rounded bottom, and we have accelerated to the upside right there. And if you take a look at a max chart, though, you can see this is one of those biotech stocks that has really gone sideways for a number of years. You can see spiking about 2014, 2015, coming down and just consolidating literally over the last 5 years. So are we going to eventually break out from this 4 to 5 year trading range? We will have to see. Now, my stock is Intel, having its best day since March of 2020, up about, let's see, that's 10.5%. And that's as a chip maker beat on third quarter profits. EPS coming in at 59 cents versus estimates of 33 cents, but it was a slight miss on revenue. Even worse, the company really turned heads after slashing its profits and sales forecast for the quarter and for the year, far below that which was forecast on the street. Nevertheless, you see it's green there, as are all chip stocks basically. Shareholders seem to like the aggressive cost-cutting measures. $3 billion in cuts scheduled for 2023 alone. And CEO Pat Gelsinger & Co., he has in store more to manage the cyclical downturn in semiconductors. On this note, Jefferies is commenting, quote, Intel's cost-cutting plan not only has the potential to drive $1.50 to the bottom line, but also shift the company culture to a leaner, more efficient mindset. And Jefferies, by the way, has a hold rating on the stock with a $28 price target. I'm going to do a little technical analysis mumbo jumbo here. I want to put a max chart on so that, let me try this one more time. Max chart in so you can see that it never eclipsed those highs of the dot-com boom. Now it is coming back to earth as it did 20 years ago. History repeats or rhymes?
Well,
Dave?
it won't be that bad.
Really interesting, and the cuts are the catalyst here. And what Pat Gelsinger told Carl Quintanilla this morning, that the CHIPS Act is the most seminal piece of U.S. industrial policy since World War II, calling it a profoundly important step. So they're cutting their way to wins here, but they're spending $20 million on that chips factory in Ohio. They're building one in Germany. And if that statement proves to be true, well, then we can all feel optimistic, more so than the cuts, about the long-term viability of Intel and NVIDIA and AMD, and that will be the question. How influential is the CHIPS Act? Because they're all down quite considerably since that was passed. All right, my play is Pinterest. Despite an ad storm brewing, the stock is soaring on their Q3 earnings. Pinterest beating on both earnings per share and revenue, returning to both user growth in the period after 3 straight quarters of decline. Global monthly active users rising 2.8% to 445 million, above estimates. Revenue grew 8% year over year on a loss of $65 million. Now this, as I said, bucks the trend of a very tough week for the sector, one that saw Meta fall more than 20% to its lowest level since 2016, said Pinterest CEO Bill Reddy on the call, really focusing on younger users of the platform. Quote, Gen Z gets something on Pinterest that is distinct from what they get on other platforms, namely a place to discover with intent and purpose and to explore their creativity. Shares of Pinterest up more than 12%, a welcome sign, rainbow in this storm of social media stocks. Still down, though, more than 30% year to date, guys.
Yeah, Dave, they have a ways to go in order to get back to where we were at just around 11 months ago. But when you take a look at today's reaction, you can really see how much Pinterest stands out from some of its competitors out there. We certainly have seen a big pullback in a lot of the ad spending that has been reflected in the drops that we have seen from Snap or what we have seen from Meta so far this week. But Pinterest, the outlier here, really performing better than expected. KeyBank calling these results, quote, inspiring amid a depressing environment. So some excitement today. We'll see whether or not that holds, though, for this quarter. All right, coming up, President Biden and ExxonMobil are in a bit of a war of words. We have the details after the break. President Biden going after big oil once again, responding to Exxon CEO Darren Woods' comments on investor payouts, tweeting earlier today, "Can't believe I have to say this, but giving profits to shareholders is not the same as bringing prices down for American families." We want to bring in Rick Newman for a little bit more on this. And Rick, we know Exxon reporting another record profit this morning. President Biden has been very critical of some of the bigger oil companies over the last several months, and once again, doubling down on his criticism.
Right, and he said this in response to ExxonMobil CEO Darren Woods, who said in a prepared statement, I'm surprised this was in a prepared statement, but he said, I'm paraphrasing, well, we are giving back to the American people. We're raising our dividend this quarter, and they did raise their dividend from 88 cents a share to 91 cents a share. So their dividend, I believe, is the second highest in the S&P 500. But of course, Biden's point is, well, that's great for Exxon shareholders. What about everybody who's not an Exxon shareholder? So I guess Exxon thinks everybody should go out and buy a share or two of Exxon. It's about $115 a share right now. And Biden says, no, instead of raising the dividend, what you should be doing is cutting prices so people can save money at the pump. But look, these are cheap shots on both sides. Companies like Exxon, they're not going to cut their prices below market price just because they get political pressure to do so. And I would point out that there are a lot of other really profitable companies, and you hardly ever hear President Biden saying that Apple should cut the price of an iPhone because communications are too expensive or anything like that. So I think in the oil and gas industry, they're used to being an easy target. And I think it's fair to say Exxon is not going to cut its prices below market prices. It's going to keep doing what it's been doing for decades, which is returning that money to shareholders.
You know, I think it's another profound example, Rick, of just how big a megaphone Twitter is, and that Elon has some opportunities there if he can monetize that. But anyway, gas price is certainly a political football, as is the U.S. debt ceiling, which may be back on the hot burner pending results of the midterms. What lies ahead?
The debt ceiling is going to have to be raised again, probably sometime in the middle of 2023. And Kevin McCarthy, who would probably become Speaker of the House if Republicans do take control of the House as expected, he has suggested Republicans are going to return to their old tricks on the debt ceiling, which is when they do have the power to obstruct budget bills in Congress, to hold up extending the debt limits while they dicker over some other priority, which would be cutting government spending, or could be doing something about the soaring cost of Medicare and Social Security. So this raises the specter that we could once again go back to the days of debt ceiling showdowns, where everybody's fretting over what will happen if the Treasury can't pay the government's bills and all this kind of stuff. That could happen, but there is another thing that could happen, which is if the Republicans do win on November 8th, then there could be some kind of bill in the lame duck session, which is between November 8th and when the new Congress comes in at the beginning of January, that would raise the debt ceiling, preempting that kind of fight. And there have been a couple of serious economists who say what Congress should do is just raise the debt ceiling to $100 trillion. In other words, just make it irrelevant. Some people want to get rid of the whole thing. So, we'll have some really entertaining politics in 2023, Dave.
Oh boy, entertaining if you want to call it that. All right, senior columnist Rick Newman, I'll see you on the golf course tomorrow, sir.
Good, man.
Thank you.
Bye.
All right, coming up, a new era begins at Twitter. Stay tuned to find out what changes Elon Musk may have up his sleeve next. The bird is freed. That's what Elon Musk tweeted upon closing the $44 billion Twitter deal that's dominated the headlines now for several months. Musk promptly firing the CEO, CFO, policy head, and general counsel. So what's next for the Blue Bird? Dan Ives is the managing director and senior equity analyst at Wedbush. Always good to see you, Dan. So let's first start with this. How much is Twitter worth? And two, this is a twofer. If forced to pay for Twitter, how much would you pay per month?
Well, first off, in terms of what Twitter's worth today, I mean, I think it's worth 20 to 25 billion. So this just comes down to, I think it's going to be one of the most overpaid, expensive M&A transactions in tech, probably next to AOL Time Warner. Okay, in terms of what he's paying relative to the fair value that we see. Look, and when you talk about monetization, I mean, that's going to be the issue. I mean, Twitter pervasiveness has never been the issue. It's how do you monetize it? And that's going to be the problem for Musk. The easy part for Musk was buying Twitter. The hard part's fixing it.
Well, Dan, let's talk about fixing it because he's taken some steps over the last 24 hours. A couple of the top executives are gone. He also announced that he's forming a content moderation council with widely diverse viewpoints. That was in a tweet that he just posted a couple of hours ago. But what do you think's in store? What changes do you think need to be made?
And it's a balancing act. I think part of the problem is you're trying to get more advertisers on. You want the power users to continue to come up, but then you got to make sure that from a content perspective, it's not a cesspool. Because if that's what it becomes, then ultimately that's been part of the problem for Twitter. It's going to be this tightrope that he's going to have to walk. That's why when he talks about the WeChat type model, the super app in terms of what they have in China over the next 3-4 years, that's a great vision. But in the near term, it's going to be cost cutting. It's probably going to be more monetization of the core power users. And it's trying to get more advertisers on the platform. But it's the carrot and the stick. You need engagement and subscribers in what right now is just a perfect storm for digital media.
How dramatic do you think the headcount reduction is? And you talk about advertisers. Do they want back on a platform if it does indeed welcome former President Trump, Kanye West, Steve Bannon, and the like?
I mean, to your latter point, that's part of the problem. That's why I think he put that tweet out today. I mean, otherwise, if you want to spend $44 billion just to make it a town hall and a free-for-all, then you can do that, right? But, I think that's really the issue in terms of that balance that he's trying to strike. And I think overall, when you look at the situation here, I mean, the headcount cuts are going to be massive. I mean, this is one, because of the debt, you're now going to have to, from a free cash flow perspective, service that debt. Puts more pressure on cost cuts. I'd say 30% on the low end, probably 40 to 50% on the high end.
So, Dan, of course, that begs the question what that's going to do for the culture of Twitter, what that means for Elon Musk. Concern there about reputation and his management style. What's your take on that?
I mean, you couldn't find in the world two different cultures than Musk and then the Twitter culture. I mean, I don't see too much ping pong going on during lunch with Musk running Twitter. And I think that's the issue, is that it's worked for Tesla. And it's worked for SpaceX. That's why he's the richest person in the world. But now it's trying to make sure morale, keeping employees, resumes not going out, in terms of surge. There's going to be clear cuts. And I think that's really going to be the balance that he's going to need to find to get Twitter through this next chapter. I view it as just a Kilimanjaro-like uphill battle to turn this thing around.
I want to turn a little bit to the whole week in big tech, Dan. Biggest story of the week to you in terms of what we're learning, whether it's Microsoft or Amazon, Meta being hammered, or Apple just proving resilient yet again?
I think there's a few themes. First, Facebook, Meta. I mean, that conference call, probably one of the worst I've heard 22 years doing this on the street. Look, right now, Zuckerberg, it's like Ted Stryker in the movie Airplane. I mean, that's sort of the vibe I think that most investors were getting. Because you're betting on the metaverse. It's 3 to 5 years out. And right now, social media under massive headwinds. So I think that's one that can continue to sell off. Cloud, still holding in well. Obviously, some cracks that we saw with Amazon and Microsoft. The one that comes out smelling like roses, again, it's Cupertino and Cook. I mean, they're the one where demand continues to be firm. And I think in large cap tech, I really think Microsoft and Apple are the ones who are going to be getting more dollars.
If you take a look at Apple, obviously a huge quarter here, the holiday quarter. The Street's impressed with their most recent earnings. Looking, though, ahead to growing their services business. We know they just upped their prices on their subscription services. How big of a boost do you see that being to Apple here over the next couple of quarters?
Yeah, look, it's a great point because I think the big part with Apple in terms of the valuation is that services business. You need that to re-accelerate. Just forget currency for a second because that's about 1,000 bip headwind back to organic double-digit year-over-year. And I think if you start to get there, and I believe there's that big opportunity, right now services is still 25-30% penetrated. You have that golden install base. That's really its ability, especially with the iPhone 14, still looks strong in terms of overall demand now going into holiday season. But services is the crux. I mean, you need that to really re-accelerate organically, I think for the Street to really start to believe that this is one that can navigate the storm. Last night, a huge step forward in what's been a nightmare on Elm Street week for big tech.
And what did we learn from Amazon about what lies ahead?
I think they definitely have some significant, not just cuts, but I think they're trying to figure out the new normal. On the e-commerce side, clearly, you're seeing some softness going into the holiday season. You still have that COVID hangover that they're going from a growth perspective. And I think there could be some net share gains that Microsoft's going after with Amazon on cloud. But you look at the reaction today, stock's down 6.5%. Last night it was down 20% after hours. The Street's starting to realize now Amazon, maybe they've cleared the deck. Low enough numbers, now you can start to buy the stock. I think you're seeing a similar theme in some of these big cap tech. Meta you put by the side just because that's more of a train wreck situation. But I do believe some of this, the bark's a little worse than the bite in terms of, where we start to go through in terms of numbers over the next 3 to 6 months.
Dan, you're repping the Penn State strong, a 15-point dog tomorrow against Ohio State. What's your prediction?
Look, I'm here in State College. I mean, obviously, this is probably the best Ohio State team I've seen in 20 years. I think there could be a shocker in State College tomorrow. I think Penn State could win this game.
Ooh, can't wait for that. Noon Eastern time. You know what Dan is doing this weekend. Enjoy it, sir. Good luck.
I'm here in State College, yep.
That should be a fun one. Dan Ives from Wedbush. Good to see you, sir. Go Nittany Lions. Coming up, we're counting down to the closing bell on Wall Street. Check out those numbers on a Friday. We'll see how they close after the break.
About a minute to go here until the closing bell. Ines Ferre is in studio with us with a closer look at some of this week's movers. Hey, Ines.
Hey, Shauna. Yes, and the Dow at a 2-month high at 4 week straight of gains. The NASDAQ composite up 2.8%, almost a 2-week, its best day in 2 weeks. Let's take a look at the U.S. dollar index because that had started higher earlier this week. I'm going to pull up a 5-day chart. You can see just above 112 earlier this week, right now at above 110. So this has helped support equities, that rally that we've seen recently. Let's take a look also at the sector action because we are looking at all 11 sectors of the S&P 500 in the green, with technology there gaining the most. And over on the NASDAQ, a big day for tech stocks, a big week for tech stocks. Apple up 7.5%. Here's a closing bell at the New York Stock Exchange.
Certainly some reason to cheer the close on this Friday ahead of Halloween. A spectacular performance. Let's check out the numbers on the markets. The Dow, you got it. 4 straight weeks in the positive and an 828-point close, up 2.6%. Look at the NASDAQ. It's been a wild and tumultuous week in big tech, up 2.87%, more than 300 points. And the S&P also turns in a winner, up nearly 2.5 points. We had a string of brutal Fridays now in the rearview mirror. Let's talk about it with Dan Griffith, Huntington Private Bank Director of Wealth Strategy, and Ryan Nauman, Zephyr Market Strategist. Good to see you both. So Ryan, let's just start with those numbers we just saw. What do you make of that rally to close a wild week?
First, thanks for having me on, and happy Friday. Yeah, it was really kind of a surprise because over the past 3 weeks, equities have performed very well, but in a lot of that was due to 10-year yields declining. If you follow yields, yields have declined and equities have rallied. Well, that was opposite today when yields rose at one point above 4%, the 10-year did. And typically that's bad news for equities, but that wasn't the case today, as equities, as you said, had a really strong day. And that could be with the US dollar, as you mentioned earlier. The US dollar came down a little bit, so that also was a relief to equities. But I found that big rally today a little bit of a surprise, considering that yields also rose.
And Dan, what do you make of the fact that the market's still rallying today despite the weak earnings that we got from Amazon yesterday, when we saw massive losses in Meta? The Dow actually ended the day in the green, really showing that stocks are becoming less reliant on tech. But what does this signal to you as we look at the current quarter and then out to 2023?
Well, I think, we are in the midst of earnings season, and although we've had some really big headline numbers come in a little bit lower or significantly lower in some cases, one thing to remember is almost 70% of the folks reporting have come over and have beaten estimates. And I think that shows a real underlying strength in many of the sectors out there. Obviously, we saw green in all of them today, but including those outside of the technology area, I think a lot of them have a really good story to tell, even if it's not one that always makes the headlines.
Brian, $550 billion shed from big tech in a week. It's been a stunning one. I want to kind of give you free for all, whether it's Amazon or whether it's Apple or whether it's Alphabet, Meta, or even the GDP number on Thursday. What was the biggest story of the week that tells you what's coming next?
Yeah, for me, I look at the economic stories. We had, a solid GDP for third quarter coming in at 2.6 on a resilient consumer spending. You also have the employment cost index. While remaining historically high, the growth has slowed a little bit. It rose 1.2%. And then you have the PCE index, or the Fed's preferred inflation rate today. It remains stubborn. And when you take those three into consideration, you're looking at the Fed supporting its 75 basis point hike next week and potentially another 75 basis point hike in December. When you look at these economic data points that they follow, that inflation isn't going to be coming down materially anytime soon.
Dan, what do you think? I think the 75 next week is pretty much a sure thing, but looking out into the December meeting, Bank of America saying that they expect maybe the Fed to signal that it's going to slow in December. What are your expectations?
I think we agree that 75 is definitely something that's going to happen here next week. But beyond that, I think we still think we're looking at some strong numbers. Obviously the Fed's done some stuff this week and last week to point towards, a 5% number, which ultimately could be a good place to land. There's a lot going on in the economy that kind of points both directions towards a little bit of a slowdown next year. Obviously, unemployment numbers are really good, and the consumer numbers, Ryan, you just mentioned, are both bright points. But a lot of increasing inventories are a little bit of a problem, and some of the other leading economic indicators still would leave some area for the Fed to continue to raise.
So, Ryan, all the factors that we just took into consideration, what's the strategy you move forward?
Yeah, that's the $1 million question, right? And I think you have to build portfolios that are resilient to a recession. Like Dan said, I think 2023, we're looking at a slowdown and most are expecting a recession, whether it's mild or a moderate recession. I think you have to focus on high quality dividend paying stocks that have a quality balance sheet, free cash flow. Look at those high quality names. Also look at sectors that are a little bit more defensive, like consumer staples, healthcare. And also, if you have a really conservative investor, maybe focus on utilities. But you have to look at building a resilient portfolio that can withstand an economic slowdown.
Dan, what about you? What are you liking in this environment?
No, I think a lot of good points there, Ryan. Obviously, we're talking to clients a lot about kind of nibbling a little bit, taking those names that they feel very comfortable with, and being patient, really looking at what they believe in longer term. So we're doing a little bit of bond buying right now, and obviously a little bit of very strategic stock purchasing. As I mentioned before, there are plenty of really good stocks that have performed really well, and a lot of people out there, especially in that middle market, small cap area, who are very optimistic about what their numbers look like long term. So we're not jumping in, but we're certainly telling people not to stay entirely on the sidelines.
And Ryan, when you take a look at the strength of the consumer right now, obviously we've had a couple of mixed results, especially when you take a look at Amazon warning or really coming up short when it comes to the fourth quarter guidance, raising some concerns here because it's a very important holiday season. What does this tell us about the strength of the consumer and maybe the weakening that we're starting to see on that front?
That's a great question. And interest rates, as we know, it's a lag on economic data, the consumer, and so on. And that's what we're seeing here. Third quarter, consumer was strong and showed a willingness to continue to spend. But we're seeing the impacts of inflation and higher interest rates or tightening financial conditions. And that's what these corporations are starting to foreshadow moving forward, is that economic growth, their earnings are going to slow because the consumer is going to start feeling it due to the inflation and higher interest rates moving forward. And I think that's where you see Amazon, Apple, and some of these companies giving some warnings for quarter four.
Ryan Nauman, Dan Griffith, great to have you. Have a great weekend. Thanks so much for joining us this afternoon. Well, we were just talking about earnings, so let's take a step back because as we look at some of the big themes from this very busy earnings week, Jared Blickery is joining me here in studio to break down some of those themes. And Jared, let's start with dividends and buybacks and what we've heard over the past 5 trading days.
Yes, well, dividends and buybacks. Perfect story is ExxonMobil just released its results this morning. They upped their dividend to 91 cents per share from 88 cents per share, and they reiterated a lot of their guidance. Now, they ended the quarter with $30 billion in cash, and that's where they want to be. Now, President Biden has criticized the oil industry, not singling out anybody in particular, but about not returning profits, not keeping profits from the American people. So I think Exxon's point this morning, they even said outright, we are returning profits to American shareholders. Get that right there. But we also know it's not just the energy companies. It's also big tech companies like Apple, Amazon. I have some figures from Apple here. They had a $3.7 billion worth of dividends. That is our heat map here. Let me just put a chart of Apple so we can see that. Apple down 12.3% over this year. And here's the chart. Let me get to some of these figures here. $3.7 billion in dividends over the quarters, $25.2 billion in open market repurchases. So just shy of $30 billion for Apple. Now, you look at that chart there, it has mostly maintained its gains over the last 3 years, and you probably wouldn't be too critical. Even Amazon, let me pull up a chart of Amazon as well. Now, had a bit of a stumble today. You can see not quite right up to snuff in terms of that support line, but Amazon ended the quarter with $10 billion potentially in buybacks, of which it committed $6 billion to buybacks. And they also have another $6.1 billion to go. Then I want to turn our attention to Meta. Now, Meta is another story. You can see down 70.5% over the year and really just slicing through a number of support levels. Well, get this. They spent $48 billion since the mid-level of 2021 at $300 per share. And that seems to be an overpayment for some of that stock right there. So these criticisms come to light when companies stumble. And a perfect example is IBM. You can do share repurchases year after year after year, but it's only after that finally hits the bottom line and shareholders realize this is a huge mistake with 2020 hindsight that this comes to the forefront.
All right, so let's talk a bit more about buybacks ahead of a new law taking effect next year that will tax them at 1%. Goldman says they estimate they'll top $1 trillion, the largest on record. What's the larger trend there?
Well, the larger trend is we're probably going to see fewer buybacks because of this tax, at least a little bit. Now, 1% doesn't seem like a lot, but it does on the margins. And when you're talking about some of the largest marginal buyers of stock, which are oftentimes corporations themselves, this does matter. Now, why don't they just funnel this into dividends? Dividends can be taxed at a rate of up to 20%. And so that matters in terms of investors. Now, Goldman is saying in terms of this year, not next year when that law goes into effect, but this year, for the rest of the year, $4.5 to $5 billion is going to be spent every day by corporations buying back stock. So that is a huge tailwind for equities. Doesn't mean that it's going to overcome everything that we've seen. But given the fact that we are coming out of a blackout window because of earnings that are ongoing here, when companies release the results, well, then they can go back and buy back their stock after that. So that's kind of where we are right now. So with this window opening, we're going to see that tailwind tailwind applied to U.S. stocks.
All right, Jared Blickery, good stuff. Good to see you, my man. Have a good weekend. Up next, diesel gas prices creeping up to $5.30 a gallon nationally. We'll tell you why. Next. Diesel supplies are reaching critical levels in the United States, in particular right here in the Northeast. The Energy Information Administration reporting just last week that the country had only 25 days of reserves remaining. Now the Biden administration weighing options to avert a crisis as we head towards the winter. For more, we're joined by Opus Global Head of Energy Analysis, Tom Kloza. Tom, good to see you. By one metric, diesel levels lowest in 40 years. How concerned should we be?
Well, I think we're concerned. I'd be a lot more concerned if this were the end of November or the end of December, because diesel fuel and heating oil are the same molecules, essentially. And it's used a lot in the Northeast and it's used in Europe. So we've seen prices in the Northeast go up by about $1.20 a gallon this month alone. And that's for diesel and for heating oil. The rest of the country, maybe 50 cents. And I would say that in a couple of weeks, when you get PPI numbers, that's going to haunt the inflationary aspects of those numbers.
Tom, how long do you see supplies remaining tight then, throughout the winter at least?
I think so. If we get a mild winter, it really alters the calculus. And we do have some time now. It's probably worthwhile that we see these, the use of the word shortage as opposed to tightness or whatever, because something does need to happen. The problem is December 5th is when the European Union essentially begins boycotting or banning Russian oil, and Russian crude oil and Russian diesel are pretty much necessary for Europe and most of the North Atlantic. So it's going to be very, very touch and go. I would submit that maybe in the next 40 days, we don't see much short selling in the market. And like all markets, it needs short selling. So we're going to be very, very high up there. And again, I think it's bad for inflation. Everything moves across the country by either vessels, which use diesel now in their mix, trains, and of course trucks. And it's very expensive with $5.50 to $6 prices out there.
Tom, speaking of Europe, we all talked for weeks, if not months, about a coming energy crisis in Europe, and now European natural gas prices plummeting. They don't even know what to do with it because supplies are full. Is it too early to say coast is clear?
Yeah, I think it's way too early. Now, it does tell you what happens with these markets that make parabolic moves. I mean, natural gas went from the equivalent of like $100 a barrel to $500 a barrel at the end of August, and now it's back to about a third of that. So the same thing could happen in the United States. We're going to see the refiners get back in gear in the next month. They've had a lot of maintenance in October. They're going to make more gasoline, but they're really going to try to make more diesel, jet fuel, and heating oil because they're making $60, $70, $80, $90, $100 a barrel. They're making their fourth quarter margins right now in the first month of that quarter.
So, Tom, when you take a look at Europe, it sounds like it's more of a sigh of relief rather than the fact that maybe Euro policymakers should be complacent. I guess, what should they be doing or could they be doing to make sure the situation doesn't get significantly worse throughout the winter?
I think they're doing everything they can do right now. I mean, an embargo or a boycott is going to be very, very uncertain, and we don't really know what's going to happen. I mean, we have a desperate despot in charge of Russia, and he could cut off some of the supplies that wouldn't ordinarily go to Europe or some other countries. So there's a lot of uncertainty, and I don't think you'll see much selling in the market between now and December 5th.
All right, I'd be remiss, Tom, if I didn't ask you about the Twitter back and forth between Exxon and President Biden. Exxon CEO suggesting on Twitter that's exactly what they're doing in the form of returning profits to the American people in the form of their quarterly dividend. And the answer from President Biden was, can't believe I have to say this, giving profits to shareholders is not the same as bringing prices down for American families. What's your take on this back and forth?
My take on this is like, well, at my country club, we don't have any unemployment. It's really tone deaf on the part of the Exxon CEO. I'm sorry, but giving money back to shareholders is not the equivalent of treating the people on the margins of society who are paying these prices for heating oil, diesel, kerosene, or whatever. He needs to, speak to the people on Main Street and not on Wall Street.
And Tom, to that point, taking a look at Main Street, we know Exxon just posted another record profit, but when you take a look at gas prices, they have come down quite a bit. Here we are today at $3.76. When you take a look out over the next couple of months to year end, are you confident we'll remain below $4 a gallon?
Yeah, I think we're going to be okay on gasoline prices, because companies like Exxon and all the refiners right now, they're going to be making so much money on the middle of the barrel, the diesel and the jet fuel, that they're going to make a lot of gasoline, probably more than they would intend to make. So I think we're okay. And in the months of December and January and even February, we use about 15 to 20% less gasoline than we use in the driving season. So the whole thing, again, is, in the next 90 days, we'll look not so much for a point of stasis, but the launch pad from which the prices go at the end of the first quarter 2023 or in the spring.
All right, Tom Kloza from Opus. Appreciate it. Enjoy the weekend, sir.
Thanks.
All right, coming up, new UK Prime Minister Rishi Sunak has more ties to the United States than you might expect. We'll tell you about that next. A Botox boom during the pandemic has all but faded with the filler that is inflation. Anjali Kimlani here with that story. Anj, what are we learning?
That's right. Good one there, Dave.
Thank you. Thank you.
That is right. We've got AbbVie reporting today that there is, in fact, a slowdown in customer use of fillers and Botox, specifically lowering guidance for the year down $600 million to $5.3 billion. Still not a bad number instead. And they do expect this to be a shorter term impact. They expect that customer confidence will increase in a short period of time, just like it did after the 2008-2009 recession. Also, the company is facing a patent cliff for its blockbuster drug Humira. So that is another thing that they have on the books for next year, the impact there. And that, of course, we know it was the whole reason why they merged with Allergan back in 2020. So everything combined, kind of an uncertain day in terms of the quarter for them, but looking a little bit more positive out in the future.
All right, Angela Kimlani, thanks so much for the appreciation of my jokes. No one laughs at my stuff, Anj, so thanks. Have a good weekend. Appreciate it. Jana?
I always do, Dave. You know that.
You do. That's true.
All right, let's turn to another story that we are watching here. Economic turmoil, a new king and 2 prime ministers in as many months. The United Kingdom has its challenges in the months to come. So is Rishi Sunak up to the task to discuss? We're joined by Yahoo Finance editor-in-chief Andy Serwer. And I know you wrote about the special relationship between the UK and the US, especially when it comes to the new Prime Minister of the UK, Rishi Sunak. What can you tell us about that?
Well, first of all, the special relationship between the UK and the United States. I mean, some people say, oh, we have a special relationship with France or Israel, but doesn't compare with England. It goes back 6 centuries. Mm-hmm. And actually, Shauna, the special relationship, that phrase comes from Winston Churchill in 1946 in a speech with Harry Truman. So, you know, it goes back a long, long way. Of course, you know, we have all the ties with movies and TV and rock music. Economically, you know, 1 million people in the US work for British firms, 1 million people in the UK work for American firms, about $1 trillion of foreign direct investment back and forth. So there's a lot there. And then, of course, politically, geopolitically right now, with Russia, China, and Saudi Arabia less friendly than ever, having a real friend like the UK is more important than ever. So the special relationship's still intact.
I thought it came from Love Actually, Andy. That is news to me. No,
Yes.
It is a classic usage of these special relationships.
Notting Hill.
But, you know, as much as we talked and learned and heard about Boris Johnson, we've heard very little about new Prime Minister Rishi Sunak. What are we learning, and what about his connections to America?
Yeah, I mean, his connections to America, Dave, it's really amazing. I mean, there's never been anything like this with the head of state in England or maybe any other country. I mean, the guy worked at Goldman Sachs. He went to Stanford. He worked at a hedge fund that invested in CSX, the railroad. He owns a house, an apartment in Santa Monica. He even had a green card at one point. And then, you know, he's married to a woman there's Rishi right there. He's always kind of a good dresser, dapper guy. His wife his wife who went to Claremont McKenna, who we met at Stanford, is the daughter of the founder of Infosys, the giant Indian outsourcing company. So that family's fortune, a lot of it was outsourcing jobs from the United States. And, you know, if you think about it, though, Rishi Sunak sort of represents the relationship between the United States and England in a way that's sort of very 21st century. It's about finance. You know, if you think about the 20th century, Winston Churchill, the military, maybe going back to the 19th century, Andrew Carnegie with the commercial relationship. So very much a man of the time representing this relationship between England and the United States. I mean, as I said, he had a green card at one point.
Yeah, wow, it really highlights the strong connection there. Andy, we certainly know that this is a very challenging job, particularly at this time. We talked about the pound falling to a record low against the dollar. Obviously, the economic crisis, I think you can call it, of what the UK is in right now. Do you think Rishi is the right person for the job?
Well, he certainly has this financial background. I mean, the first hedge fund manager to be the Prime Minister of England, or worked at a hedge fund to be absolutely precise there. You know, we spoke to Ann Berry, who you know, who runs Threadneedle, and she actually worked at Goldman Sachs with Rishi, sat next to him when they were both analysts years ago, and points out that this is a guy who spent his entire career sort of thinking about markets, thinking about supply chain, the global interconnectivity of markets. So that's crucially important for the UK right now, particularly as they're alone, not with the EU, need to rely on the United States a lot. So from a capital markets perspective, you know, he has the expertise. And of course, the markets have stabilized in the UK since he became Prime Minister. Now, as far as foreign policy goes, that's another matter and, you know, very, very complicated right now. So we'll have to see about that. But, you know, he is in the crosshairs and has a big job in front of him.
It certainly does. You can read Andy's column on yahoofinance.com over the weekend. Andy, thanks so much for stopping by in studio. Have a good weekend.
Thanks, Shauna.
All right, well, coming up next, Dave's conversation with Major League Baseball's Chief Revenue Officer on everything from streaming to sports betting as the World Series kicks off tonight. Don't go anywhere.
I can see it the way you like. I can do it the way you need. None of the boys know the first thing about your fantasy. And if they try, they cannot do it just like me.
A Major League Baseball season that started 1 week late under the storm clouds of a lockout is now near its pinnacle, just a few hours away from Game 1 of the World Series. Got the 87-win surprise Philadelphia Phillies at the 106-win Houston Astros in the Fall Classic for the fourth time in 6 years. So you've got expanded playoffs, new sponsorships, streaming, and sports gambling. How have they impacted the business of baseball? I touched all those bases with MLB Chief Revenue Officer Noah Garden earlier today.
The great news for us is we were able to come to a great agreement with the players and the Players Association. We played a full season, and which is culminating now in a really exciting way, right? You take a look at the expanded postseason. I'll tell you that from our perspective, overwhelming yes, right? The goal of that was to keep more fan bases active for a longer period of time. You know, September, we saw some of the best attendance numbers in September that we've seen in almost as long as I've been here. And, you know, that's attributable to all these fan bases that are having more of an opportunity to compete for some of these coveted spots in the postseason. And, you know, listen, you're seeing it tonight. You've got a team that, if not for that expanded postseason, may not be there today. And they're there. They're playing well. They're exciting. That fan base is rabid. And we got an amazing matchup that we're going to see the next week and a half.
Nobody had Philly headed this far. The thought prevailing wisdom out there is you needed New York or LA for a massive television audience. What do you make of that?
Listen, everybody always points to those sorts of things. I mean, you see the numbers, right? You see the numbers throughout certainly our expanded wild card. You see the numbers, the division series and on. Our ratings are up. And if you've watched, as I know you have, some of these games, I mean, those fan bases, first of all in Houston, they're always there. They've been supporting that team forever. They're rabid. It's exciting. Every time I'm there, my new watch tells me the sound is going to make me deaf and the decibels are too loud. And listen, it's shining through in Philadelphia too. I've got to be in both places, and the excitement, I mean, it's taken over the entire town. And so, we're excited by the matchup. It's two amazing markets, and I think it's going to be a great series.
Let's talk about some of the television deals. Now, you've been in streaming before anyone. MLB.TV was 20 years really ahead of the game, but new partnerships with, of course, Apple TV and with Peacock. How successful were they, and do you imagine more streaming in the future?
Yeah, it's interesting. I started in baseball on the MLB.com side. So, I was there in 2002 when we were streaming, when Netflix was still sort of sending DVDs, door to door. So we were early for sure. And I don't think anybody really understood back then what it was going to be today. And I'm sure in 20 years, it'll look as different then as it does now to us looking back. I'll tell you that listen, it's been increasingly hard to reach our fans, right? Our fans, even within the linear bundle, distribution has been a challenge. And fans, whether they're young or old now, want to watch content and where they are. And some are streaming and some are leaning back on their couch and watching the TV in front of them. And, we used to say back then at MLB.com, if it has a plug or a battery, we should be on it, right? And, we live by that today. And so we'll continue to go where our fans are and hopefully deliver a world-class product that we can be proud of and they can enjoy. And, knock on wood, these deals with Apple and Peacock this year were a nod to both a little different, quite frankly. Peacock was interesting in the sense that they wanted sort of this earlier time frame that was really earlier than we'd started games in the past, other than maybe one game in Boston during the marathon. And, we weren't sure what to expect from that, but overwhelming success. The time slot was great. Players like playing earlier. They've done an absolutely fantastic job. Apple, just take a step back. We've been partners with Apple forever. Right. We were the first to stream on their iPhone, first to stream on their iPad. We were on stage with them almost every single release. Right. This is an extension of a long-standing close relationship that we've had with them. We've had the #1 sports app on there. So, it just made a tremendous amount of sense for us. And we reached just a lot of fans. And, listen, they're seeing a lot of the same halo effect that sports has traditionally brought to other content too. What they're saying is it's bringing people in their ecosystem that they've not seen before. And it's certainly, from the numbers perspective, we're seeing, more eyeballs than I thought we'd see. So great test, more to come. But it doesn't mean that the success on streaming is going to, take us away from linear or otherwise, right?
From a numbers perspective, how important was it to stay away from the NFL on the World Series schedule?
You know what? Listen, not really important. Look at what we did in wild card this year, right? We were on wild card on a weekend when there was a lot of sports. There were some great college football games. There was NFL, and look at the ratings that we had, and that continued into the DS. So when we do our schedule, it's really not about put it based on other content that's out there. It's really on when we think most of our fans are going to be able to watch the games and cheer on their favorite team. And I think that's the way you've seen it played out.
Like every professional sport, the tie-in with sports gambling is essential in terms of growth, in terms of reaching a younger demographic. Can you talk about how that has helped baseball grow and get younger?
Yeah, listen, I think we're sort of in the early stages. I'm not sure we're fully materialized on that effort yet, but I would say that that's the goal, right? The goal was never about like how much money you're going to make from sports gambling. It was really about engagement, right? If people are engaged for longer periods of time, they're going to watch the game for a longer period of time. That's going to adhere to the benefit of television ratings. It's going to advertising, all the things that we look at when we're trying to create a successful business. I would still say we have more to come. It's been great. Right there, it's doing exactly what we thought. But at the same time, we still need to innovate in the way people gamble. We still need to provide more content to that section of our fans and more data. And that's where you're going to start to see, alternative broadcasts. we have a family product. We're committed on our, our main feed, so to say, to continue to not over gamblify it, right? To not make sure we're creating all that content for such a distinct audience. That's the beauty of streaming too, right? You can have all these different feeds and address different types of fans. And so you're going to see us get more aggressive in that space, providing, different types of broadcast to those fans, and most importantly, we're going to innovate on the way you can bet on different things within the game.
Let's touch on attendance quickly. Down a bit still from 2019 pre-pandemic, up from last year. How do you view it? Are there things you can do to evolve the game that would juice attendance? Do you watch things like the Savannah Bananas and how they're changing the product a little bit?
Listen, I love the Savannah Bananas, right? It's sort of like our it's just fun to watch. I'll tell you, attendance is funny. I'm very encouraged by attendance this year. I mean, if you think about it, we went into this year, as we discussed earlier, sort of in the, tail end of the pandemic. If it was the tail end, who knows? But people were still afraid to get out. And you saw that in the numbers early on. Yep. From that time to where we are today, we saw some of our best numbers in the September timeframe. We continued to make up the ground that we lost early throughout the entire season. And, from a trajectory standpoint, I couldn't be really more pleased where we are. So I think, we ended on a strong note. We had a great postseason, looking forward to next year. And, I think headed in the right direction for sure.
Shauna, I just have to take issue with one thing Noah said there. I really think it was intentional that they stayed away from the NFL Sundays. It's the first time since 1947 that there was no planned Sunday World Series games. And the head of Fox Sports programming says, obviously, we didn't want to go head to head with the NFL on multiple nights, but we won't stick on that too much. I know you have a horse in this race. Who you got?
I do. Obviously, the Phillies, my hometown. There's so much excitement going on in the city right now around Bryce Harper and also with Kyle Schwarber. Schwarberfest going on at Wawa. The city is so excited. We just heard just about the excitement surrounding the game ahead of this series. Dave, I hope you're with me in rooting for the Phillies. Can you do it?
100%.
Okay.
I want Bryce Harper to win a World Series. I think he's great for the game. Love the swagger.
I know. It is about time that Bryce Harper did win. All right. Well, let's turn to another story that we are closely watching here. Crypto investors were hit hard by taxes this year. Despite those losses across the board that we have seen over the last several months, many investors won't be getting much relief from the IRS in April. So here to weigh in is Yahoo Finance personal finance reporter Rebecca Chen. And Rebecca, I think many crypto investors were hoping to recoup some of those losses. We're hoping for a break this year when it comes to taxes, but it doesn't sound like that's going to be the case.
So that's correct. So Shauna, in 2021, crypto went up in value and many hit record high. However, in 2022, investors just weren't so lucky. Unfortunately, a lot of the valuations has dropped. And even though many have hoped this year that they could take that loss on their return, IRS has come out and say that cryptos are property investment, and which means that it is subject to certain loss rules. So I think what investors should be aware of this coming tax season are a couple items. The first is that regardless of how much loss they have incurred throughout the year, in order to take these losses on their returns, they have to sell their crypto. So without selling the crypto for the IRS, it just really doesn't, they cannot take that on their return because nothing has happened in terms of what IRS thinks. And the second is that I'm sure a lot of investors had a great year last year and paid a lot of taxes. And so they're probably hoping that with this year's loss, they could carry that loss back and then deduct their gain from last year and hopefully get some money back. But unfortunately, IRS doesn't allow this type of carry back for individuals. So that's another thing. And the last thing is there's this thing called the capital loss limitation. So regardless of how much loss you've incurred this year, the most you can take on your tax return is $3,000. So even if you had $10,000 of loss or $100,000 of loss, the most you can take is $3,000. The good news is that even with this $3,000 loss limitation rule, what you can do is for all the extra losses that you have, you can carry it forward forever into your future returns until you use them up.
So there are some limitations there, but also some, I guess, areas of opportunity. What about those investors who unfortunately were affected by if they had an investment in, say, Luna? What is your advice to them?
So for Luna, there's many cryptos that has lost a lot of value this year, and to some investors, certain cryptos became potentially worthless. So for these, although the IRS doesn't really come out and say they can't deduct the loss on these worthless crypto, the experts that I have been chatting with said that try to sell these for a penny or even a fraction of a penny on any exchange. And once you've done that, you can come to the IRS and say, hey, I sold these, I had these transactions, and now I want my loss.
Yeah, certainly some good advice there. And speaking of advice, tax season, it's only 5 months away. It's going to be here before we know it. And you know, we always talk about that. We always try to prepare our taxes ahead of time. What's some of your advice for crypto investors out there as we do approach April of next year?
Yes, so a lot of the CPAs I've talked with, they said that one of the biggest struggle that he sees his clients face is the fact of providing good record. As we know, cryptocurrency is the trading goes pretty fast. You can buy and sell multiple times a day or even within a second. So sometimes it's hard to track exactly what you sell or what you purchase a certain currency for. So doing that, keeping a really good record is definitely extremely important. And also, if you sell a currency and you cannot prove your basis to the IRS, they could come to you and say, since you can't prove it, we're gonna say you got this for free, or you bought it for a penny, and we're gonna tax you on your entire amount of proceeds. And nobody, wants to pay more tax than they need to. So it is definitely very important to keep a great record for the tax season.
Some very, very important advice there. Rebecca Chen, thanks so much for joining us in studio, and welcome to the live shows. It's great to have you. We look forward to having you back.
Thank you so much.
All right, coming up next, shares of Meta plunging this week following disappointing earnings results, but the social media giant wasn't the only big mover on Wall Street. We've got the rest for you next.
はい、お父さんにポーズお願いします。ああ、これかこれか。あ、これお父さんが撮ったんだよ。
小さくて可愛かったんだよ。な。Happy birthday to you. Happy birthday to you.
懐かしいな。はい、こっち見て。そうそうそうそう。いいね、いい笑顔だ。おー、いいよいいよいいよ。
あ、上手だ。
そうそうそうそう。千里、最近学校どう？
撮ってんじゃんね。ちょっと撮らないでよ。
大丈夫大丈夫。悔しかったな。
あれ、さっきから私の隣にいるのは？
マイクだよ。
マイク？
マイクはいつも私のそばにいた。悲しい時も。
いや、テストの結果聞かせろよ。
怒った時も。
本当に。いいから
いいぞいいぞ。楽しい？
楽しい時も。嬉しい時も。
Happy birthday。
マイクありがとう。
どんな時も。
マイクはどこに行ったの？
It's been quite a wild week on Wall Street. We're taking a look at some of the biggest movers of the week. Tech has dominated the headlines over the past 5 trading days. Let's start with Meta. Shares had taken a huge hit after the company missed on earnings. It issued weaker than expected guidance. Meta's Reality Labs, which includes its VR headsets, losing $9 billion in the first 3 quarters of the year. We took a look at the shares. They have plunged just about 23% over the past 5 days. A lot of those losses coming within just the last 2 days. Shares fell to the lowest level that we have seen since 2016. And that also means big losses for CEO Mark Zuckerberg. He lost about $11 billion in net worth over the past 2 days. When we take a look at that 20+% drop in Meta over the past 13 months, his net worth has dropped by just around $100 billion. All right, next up, let's take a look at Alphabet. Google, the parent company there, shares off just around almost 5% over the past 5 trading days. But the big emphasis on this was earlier this week when the company missed on revenue. Earnings fell short of expectations. Slowing ad sales growth was a big issue as firms really cut their budgets. The tech giant's drop on earnings was the biggest intraday decline that we have seen since March 2020. You're looking at that drop on Wednesday, a drop of just around 7%, ending the week just above $96 a share. Now, despite the weak results, some analysts did stay bullish on the name. Evercore, Deutsche Bank, Oppenheimer, and Morgan Stanley all maintaining their overweight ratings. And when you take a look at this stock year to date, still severely in the red, that large decline off just around 33%. All right, let's take a look at Twitter here, because the New York Stock Exchange delisting shares after Elon Musk closed his $44 billion deal to buy the company. His first move at the helm. He ousted Twitter's top 3 executives, announced the closure of the deal here, ending that long drawn-out saga. Now, Twitter shares rallying 26% over the past month. And over the past 2 months, you can see the shares of just around 32%. At the end of the trading day yesterday, Twitter closed at $53.70, so just below that $54.20 per share price that Musk agreed to pay back in April. And it wasn't all about tech this week. We also want to take a look at Caterpillar, the company out with earnings here this week. Strong results really pushing shares up more than 10% at the highs of yesterday. And taking a look at the 1-week chart over the past 5 days, Caterpillar closing the week up just around 15%. Thursday's jump was the largest post-earnings jump that we had seen in the company in just about 5 years. Caterpillar is just one of the industrial names benefiting from some economic optimism. But despite all this, it wasn't good enough for all the analysts out there. Deutsche Bank actually downgraded Caterpillar to hold, writing in a note to clients that, quote, "We have to draw a line in the sand on intrinsic value." And taking a look at this stock over the past 3 months, you're looking at shares up just around 16% since the start of the year, though. Caterpillar, one of the fewer names holding on to gains year to date, up just around 6%, Dave.
Man, Shauna, it feels like a month in the past week as far as the markets go, and it's another big one on tap next week. Here's what we're watching. It is, of course, a Fed week. Monday, trick-or-treating, but we're also watching for some data. We'll get PMI, we'll get earnings from XPO Logistics, Avis, Aflac, and IMAX. On Tuesday, we'll get a glance at manufacturing numbers, JOLTS, as well as vehicle sales, and a busy earnings day with Uber, Eli Lilly, AMD, Airbnb, just to name a few. Hump Day is Fed Day. We'll get another 75-point hike, we think, from Jerome Powell, 2 o'clock press conference. Also earnings from CVS, Yum Brands, the parent company of KFC, Taco Bell, and Pizza Hut, Etsy, MGM, eBay, Robinhood, all report. Thursday earnings from Peloton, Cars.com, Penn Entertainment, CoinDesk, Starbucks, DoorDash, and Yelp, among others. And finally, Friday, it is a jobs day. Earnings also from DraftKings and from Hershey, who, by the way, stock up 24% year to date ahead of Halloween. Speaking of Halloween, just around the corner, we'll hear from the maker of Snickers, M&M's, Starburst, and Skittles on what their plans are and how the business of Halloween is up this year.
Halloween is just 3 days away, and it's expected to be the biggest celebration in the past few years. That's according to Mars Wrigley's, the candy maker, projecting this year's participation is going to jump 11% from just a year ago. To discuss the outlook for this year's holiday is Tim LaBelle. He's Mars Wrigley's Chief Halloween Officer, fun title there, and President of Sales for the U.S. Tim, it's great to see you. So we talked about people expecting to spend about $10.6 billion in total this Halloween. Candy prices up just around 13%. What's been the impact on your business?
Yeah, good afternoon, everyone, and happy Halloween. I'd start off where you talked about $10.6 billion. Of that 10.6, 3.2 billion will be confectionery. So we at Mars Wrigley, the authority on Halloween, we're very excited for Halloween 2022. And there's a couple of reasons behind that. One, we had record sell-through in 2021. And the excitement from our retail partners across the US, we collaborate with them over a year in advance, and they were very, very excited about the results of 21. And we worked with them every step of the way. We know from the National Retail Federation that 75% of the US households will be participating in Halloween this year. That's up 11% from last year, which is great news. And within that 75%, 93% will celebrate with confectionery. So yeah, we're super excited about Halloween 2022.
I bet you are. I love that wall of M&Ms there behind you. Candy inflation is one of the big stories this season. How is inflation impacting the bottom line for you? And is candy flat out recession proof?
Yeah, so what I would tell you, at Mars Wrigley, the consumer is our boss. And value for money is a critical element in everything we do. So we look to take costs out of the system everywhere we go, end to end of our supply chain, without compromising our most important principle, quality. We're not recession-proof by any stretch. We've been impacted by inflation, but we make sure our portfolio fits every consumer need state. So we have price points from $3, $5, $10, which is a critical price point, all the way up to $30. So Halloween can still be an affordable treat to celebrate my personal favorite season.
It is my favorite season too. So Tim, real quick, we only have about 20 seconds here. We have so much candy on set. We've got to ask you, we have Snickers, M&Ms. I know you guys have a ton more. What's the top selling candy this year? What's your favorite?
Yeah, so our top sellers are M&Ms and Snickers, 2 items in the top 5. We have the #1 variety bag available for sale this year. And my favorite item for Halloween is M&M's peanut butter. It is the classic, and I love it.
I love it too. I love peanut M&Ms. I also love the plain M&Ms that we have lots on set here. So I was very excited about that. Tim LaBelle, great to have you. Very happy Halloween. Thanks so much for joining us.
Thank you.
Well, that'll do it for us on today's Yahoo Finance Live. Be sure to come back on Monday at 3 p.m. Eastern Time for all of your coverage leading up to and after the closing bell. That does it for me and Dave Briggs. We'll see you right back here next week. Have a great weekend.
全ての未来は選ぶことから始まっている。それはキャリアにとっても同じこと。踏み出したからこそ見える未来は確かにある。正解はない。大切なのは自分で選ぶことだ。デューダーツハイクラス転職サービスデューダ X 始まる。
It's Thursday, June 2nd in New York City, and this is Yahoo Finance Live. I'm Brian Sozzi with Brad Smith. Julie Hyman is on assignment this week, but I know she's still watching us on our free mobile app. Let's take a quick look at the futures here right now. You're seeing futures, I would say, weaken off the highs of the session, in large part because of disappointing ADP jobs numbers that came out moments ago. Of course, that sets up, interestingly, for the jobs report tomorrow, Brad.
Yeah, 128,000 private payrolls added during the month of May. We're going to dive further into that in a moment. Taking a look at the futures here right now that are still holding on to some of those gains. Those gains that we were seeing also reflected of what we're seeing in the oil market right now. As we see any type of drawback there, you'll start to see that reflected in some of the equities as well. And that's exactly what we're tracking here right now. WTI down by about 0.8%. You're also seeing Brent crude down 0.8%. And then additionally, RBOB, gasoline futures, you're seeing that lower by a little more than 0.5% right now.
And of course, OPEC meeting is underway. Also watching yields as well. Yields are climbing, 10-year yields, I should say, close to 3% here. Really, I would say after those Jamie Dimon bearish comments yesterday at a conference that still has Wall Street in a tizzy. Now, here are three things you need to know right now. Sheryl Sandberg is stepping down from her role as chief operating officer at Facebook's parent company, Meta, leaving behind a 14-year legacy at the tech titan. Javier Alavan, who is currently the chief growth officer, will take over for Sandberg this fall. Yahoo Finance tech editor Dan Halley joins us with some key analysis. And Dan, there's a lot to, as they would say, unpack here. From a Meta standpoint, they have just lost a very key leader at the company, and then, of course, a key leader throughout corporate America.
Yeah, I mean, obviously her impact on Meta, Facebook, I don't know what we'll call it. It's been invaluable, right? She helped grow this company from essentially when it was still a startup to this gigantic behemoth of a social networking empire, right? So she was part of the ability for that company to grow out its ad platform to become the company that it is. Now, that also does leave behind this legacy of various issues that have come to light over the years. when it comes to their data collection capabilities, their ability to police what kind of ads are purchased, how ads are purchased. Obviously, the 2016 election, when we had disinformation campaigns, Russian agents purchasing ads on Facebook at the time. So she really does have this, this complicated legacy of being the person that brought up this company alongside Mark Zuckerberg, but also, left it with these stains as well.
Yeah, and she recognized that in the post, also recognizing that Facebook right now is far different from what they had set out on years ago, and the debate around social media changing beyond recognition since those early days. All that considered, how does this position Facebook in what they want to be doing to diversify their revenue streams going forward?
Yeah, I think this really is kind of a almost way of them saying that we're going whole hog, as far as the metaverse goes, right? We had Cheryl there guiding us through building out the ad platforms, ensuring that we're able to grow alongside the purchase with WhatsApp, the purchase of Instagram, building out Messenger on its own, selling ads across those, monetizing as best as possible. Now they're kind of transitioning to this new version of Meta. They're going to obviously be changing the ticker symbol soon. Mm-hmm. That will kind of be its final movement over to that Meta side of things. And I think that's where, Sheryl Sandberg kind of doesn't fit into this puzzle anymore, right? So they're going to bring in Javier Olivan. And even though he's filling in the COO position, Zuckerberg had said it's not going to be the same as what Sheryl Sandberg had been for the company then.
Would I be concerned? You're seeing Facebook shares, of course. They are the top ticker on the Yahoo Finance platform right now, higher slightly in the pre-market. You do have to worry about what other defections there could be from Sandberg's team. When you lose a leader like that, usually there are a whole wave of people that exit stage left as well. But Dan and Brad, another issue here is Sheryl Sandberg has had a side business, if you will, with Lean In. She has championed female leadership in the C-suite for many, many, many years. I'm interested in who takes over that baton because there are not a lot of other female leaders in the C-suite right now, first and foremost, and secondarily, not a lot of them with the platform of Sandberg, and then last but not least, not a lot of them that want to even talk out on these issues.
Yeah, I mean, it's interesting, right? Because she was that leader for so long, especially when she was so public as a leader at Facebook, but she slowly started to kind of pull back from that position, right? At one point, she was at the congressional hearings in 2018, right, dealing with the 2016 election interference. She was the face of Facebook at that point, more so than Zuckerberg was. And so she was that big presence, but she's been pulling back a lot in recent years. We haven't really seen her doing much publicity for the company. If she has, it's been very minor. It hasn't been, putting out fires or anything along those lines. So, to your point, it's almost as though she hasn't been that person in that role as, this huge presence as a female C-suite leader for some time.
We're going to be continuing this conversation, but a huge presence indeed in the C-suite, but especially in Silicon Valley that needs more gender parity, gender representation, and she certainly was that for such a long period of time. It'll be interesting to see what comes next, and not just for Sandberg, but also for Meta platforms as well here. Dan, thanks for joining us this morning. Also, everyone, we've got to keep a tab on shares of GME. They are lower here this morning, down by about 1.5% in pre-market trading. The company reported first quarter earnings, which revealed a wider than expected net loss of over $2 a share. The company once again failed to provide an outlook for the rest of the year, but did follow up its recent NFT wallet unveiling with the announcement of an NFT marketplace, which is set to launch in Q2 for the gaming retailer, I might add.
Brad, let's start with the earnings call. So I put this out this morning. This is a joke. This whole GameStop story is turning into a big, fat joke. I don't know what CEO Matt Furlong is doing at this company. This was his shortest earnings call as CEO of GameStop. 7 minutes, 41 seconds. And the call before this wasn't exactly great. It was 10 minutes and 5 seconds or something like that. Zero details on what they plan to do. And I know this is what they're trying to do over at GameStop. Just they don't want to lay out their master plan on how they're going to change the universe and send their stock price maybe up to $700 a share. But at some point, as an executive of a public company, you have to come out here and say, this is what we're going to do. These are our numbers. Here's how we're going to execute. Take some questions from the Wall Street community. Try to get more analysts out there covering the stock. This is another embarrassing performance by a guy, Brad, that made $17 million last year despite only being 6 months on the job. What are you doing all day?
Well, it also begs the question of when we think about the Wall Street community or the community of investors here, when you have that low analyst coverage, and it's really more the retail investor out there that is so focused on GameStop, do the fundamentals matter? I would still argue, yes, the fundamentals do matter if you're looking at this company and the vision and how they're using the money, even taking into account some of the at-the-market equity offerings, which, quite frankly, if you are an investor, you should care about because that dilutes the shares that you have. And so, with all that considered, how they're using that money when they went out to the markets and introduced those offerings in 2021, now in 2022, focusing on the NFT landscape, which we know has hit a headwind, a major hurdle in the road here as valuations for many of those non-fungible tokens have decreased substantially from the fanfare that we had seen even in 2021. At this point in time, I wonder when that starts to actually drive revenue for them and produce a profit at the end of the day.
Good luck with that. At least they teased. At least they told us they're coming out with an NFT marketplace in the second quarter. No projections, no anything else on what this might even look like. They just dropped it in their 7-minute and 41-second earnings call. And I think if you are a believer, this ongoing believer in a GameStop on the Reddit threads, at some point you have to question why you in fact invested in a company that still operates thousands of stores, terrible locations, really bad lease rates, and you're getting no strategy from an executive team, a well-paid executive team with many years of experience at Amazon. You're putting your life savings in this company, and you're getting nothing from management, just another quarter of operating losses.
I mean, at the end of the day, it's really just
I know I'm hot. I know I'm hot on GameStop, but it really bothers me. It bothers me.
It's such a it has been such a momentum trade where it's really just going against the shorts. And so with the short interest that's pulled back tremendously, is there still that same fanfare that dives head into GameStop?
Oh, there is. I'm going to go look at my Twitter feed, and I can guarantee I'm just getting absolutely shredded. And I'm sorry, I'm going to bring you into it too as well. I mean, welcome to the cesspool with me. Cool. All right, switching gears, and we got the ADP report, jobs report this morning ahead of tomorrow's big payrolls report. Private payroll employment rose by just 128,000, falling far from the estimated 300,000, marking the slowest growth in the post-pandemic era recovery. And Brad, what really stood out to me in this report and is a major red flag as I draw on my notepads, I take a square and I make it in red and then I put a little check mark next to it. Small employers, small jobs lost 91,000. Small-time jobs, small businesses, I should say, lost 91,000 jobs. And that tells me these are companies very much struggling with inflation and finding the talent they need in this environment.
You know, this is a tick down month over month from what we've seen from the private payrolls numbers, and particularly here. And we've got that kind of amazing work by our team putting together kind of this longer-term view of exactly where those ads have come, putting this in the context as well of all the jobs data and the employment situation that we're getting this week. It, of course, precedes the jobs data that we're going to get tomorrow, the jobs report from the Bureau of Labor Statistics. And all of this considered, what we had seen in the past is that the two might not marry up the same that we would have expected, where you could get a blowout on ADP, but perhaps a lag or a miss on the expectations in the monthly jobs report. JOLTS, we saw that tick down yesterday slightly, but still hovering in the range of some of those record highs. So all of that considered, look still across some of those key categories in leisure and hospitality that had gotten hit the hardest on the onset of the pandemic, retail as we continue to track where those jobs are coming back. But at the end of the day, it's also still going to come down to wages and how much new employees are getting paid or able to negotiate in this job environment and this market, which we know is already cutting in to so many of the margins for businesses too.
Right on. And you know what else is bothering me here too? Let's say we do get a sub 100,000 print on non-farm payrolls tomorrow, which is possible. The president, I think, teed that up in his op-ed here a couple days ago. And of course, this ADP report does nothing to help that. Now you will have concerns about a recession. That will fuel that recession inflation narrative on Wall Street and with others in the business community. At the same time, the Fed is still going to be out there raising rates by 50 basis points probably at its next few meetings. That is a terrible setup for this market.
Yeah, we're going to be keeping a close eye on all of this economic data. Sticking with the conversation, let's welcome in our first guest to break down how this will impact the markets. Joining us now, we've got Quincy Crosby, who is the LPL Financial Chief Equity Strategist. Quincy, great to have you here with us this morning. First and foremost, want to get your reaction to a bunch of the employment situation data that we've seen come out to the course of this week and, of course, leading up to tomorrow's jobs report as well.
You know, it's interesting because what we're seeing, just a change, a change. We don't know if this is now a trajectory or just a one-off. But if you looked at the conference board, for example, jobs hard to get, you're starting to see a little bit of a shift there. Then you also saw in the ISM, Institute for Supply Management Manufacturing report, take a look at the jobs aspect, employment. That was down a bit. Tomorrow, we also get the Institute for Supply Management Service Sector, which, of course, is the largest. I mean, we're a service sector economy. It's going to be interesting to see what the employment numbers look like in that report. The question is, does the Fed like this? Because what the Fed needs is to get those wages down, get the negotiating capability to get higher wages, to get that down, because that, of course, will help bring down that price wage spiral, which has taken hold. Companies, small, large, and medium, have got to pass that higher price of labor onto the consumer. That's inflation.
Quincy, isn't this a terrible market backdrop? We're seeing decelerating job growth. Saw it here again in this ADP report. Now we're looking at several more rounds of rate increases. What case is there to be optimistic about stocks here?
Well, at some point, the Fed finishes, right? The question is, does the Fed break anything along the way? They have actually they've come out, they've talked about pain, you know, they use that word. You got to take them seriously on that. And you know, because they have started to talk about the need to get the number of jobs down. Because the more you take away the number of jobs, the supply of jobs gives the labor going in there get more of a chance to get higher wages. Take that supply down and you cut the ability to get higher wages. So you heard Christopher Waller give this speech in Germany just a few days ago, and he mentioned, you know, what has to be done with the job market. Look, it's not a science. That's the issue. It's fine tuning, and it's very difficult for the Fed that really just has blunt instruments to fine tune.
Quincy, you mentioned that the wage pass on is a major part of the inflation scenario, but another part is the supply chain scenario as well. And so with that in mind, would you be leaning your equity strategy more towards companies who are able to mitigate some of the headwinds on the wage front or on the supply chain front right now?
Well, obviously, it would be good to get both. But one of the things that we're seeing is we expect the supply chain to ease, even at the margin. That's what we're looking for, that these headwinds ease at the margin, because the expectations is they'll ease more. So you just give the example of China. You open up Shanghai. It's going to take time before people go back to work, go to the factories. Shanghai is what? 25 million people. It's 7% of the Chinese $17.5 trillion economy, but it's one of the most important. So you expect to see the port there, which is one of the most important global supply hubs for the world, for the supply chain. That should start to ease as well. And then the factories beginning to work should ease. So that's important. But I have to say, you listen to companies and they talk about inflation, but they talk about the wages too. We're seeing freezing, right? Hiring freezes. We're also hearing the chatter amongst companies, of a whisper of companies saying, hey, let's be a lot more careful with hiring. You know, they don't want to come out and say we're freezing, but you know that they're moving in that direction when you're much more careful. That actually should start to tamp down the higher wages and the ability to get higher wages.
All right, being strategic in their hiring plans is what we've heard as well from some of those companies. Quincy Crosby, who is the LPL Financial Chief Equity Strategist. Thanks for the time this morning. We appreciate it. Guys, coming up, shares of Hewlett-Packard Enterprise are sliding in the pre-market after a disappointing Q2 earnings report. We're joined by the HPE CFO on the other side of this short break to discuss the challenges the company is facing.
サントリーから新発売。大人の男性向けスキンケア。顔の印象が変わる10日間始まる。
つい鏡の前でにやけてしまいます。恥ずかしい。触り心地も良くて毎朝おおってバロンいいじゃんって
顔の印象が変わる10日間始まる。サントリーバロン。
Shares of Hewlett-Packard Enterprises are under pressure after the company missed analyst estimates for sales and profits. The company also cut its full-year profit forecast, citing its exit from Russia and supply chain constraints as headwinds. Joining us for more is HPE's CFO, Tarek Robbiati. Tarek, good to see you here this morning. So you had your fourth straight quarter of 20% plus order growth. That is good. But I think one of the biggest questions on the street here this morning is, why isn't some of that growth reaching the bottom line?
Good morning, and thanks for having me on your channel today. It's a great question, and it's a great way to start our conversation. Yes, we've had 4 consecutive quarters of order growth of 20%, and it's remarkable, and it's across our entire portfolio of products and services. The delta that exists between order growth and revenue growth is driven by the supply shortages and also disruptions in the supply environment. So we have been witnessing this for some time. The supply chain globally across our industry is still not stable. It will take us a little bit of time to get to that point. And the reason why I say this is that we have to understand the root causes that got us to where we are in the industry. And we have to look back at how much dependence there was on a supply chain that was based in Asia and in China in particular, and the fact that the supply chain is decoupling from Asia and from China. That obviously takes time. we have been coming from decades where 40% of the global manufacturing capacity was in China. And that will have to find a new equilibrium and be a lot more distributed across various countries in the globe, in Europe, and also in Asia. By the way, we've opened up a new factory in the Czech Republic to make sure that our supply chain is geared for the future and built to be not only efficient cost-wise, but also efficient in terms of speed, in terms of redundancy, and resiliency for the future. So we're moving forward on that front, but obviously you cannot expect decades to be reversed in a quarter or two. It will take us, I would say, a few quarters to navigate this, and we're in the process of doing so, and so is the entire industry.
What is that timeline that we should anticipate, that we should kind of benchmark against for the supply chain to stabilize as correlated with the forecasts that you have?
So we don't expect the supply chain stability to be attained before a few quarters from now. It will be well into next calendar year, 2023. Part of the reason why that is, and we've witnessed this with the Shanghai lockdowns, is that the pandemic is not over. And China is continuing to enforce its zero COVID policy. And obviously, this from time to time creates some disruptions like the one we've seen in Shanghai. So my best estimate for you is to say at this stage, we're seeing this stabilization happening towards the end of calendar year 23.
Tarek, within your revised guidance, how much of an economic slowdown have you baked in?
Yes, so our revised guidance was change on EPS, but I have to say we maintain our free cash flow guidance of $1.8 to $2 billion. And that's very, very important, particularly now with the downturn of the equity markets. Companies are no longer simply valued on revenue multiples, but we have to look at profitability and free cash flow generation. And we are doing extremely well on that side. We're comfortable at this stage reiterating our guidance on free cash flow of $1.8 to $2 billion. In that guidance, we obviously had to factor in some changes at the macroeconomic level, as you point out. And one of the headwinds that we're facing is foreign exchange rates. The US dollar is appreciating materially against other currencies. If you look in particular, the euro, the British pound, and the yen. And when we started our fiscal year, we had anticipated some movement in favor of the US dollar. We anticipated that this would affect our growth by 50 basis points downwards. But the reality now is that this is going to affect our growth by 2 points downwards. And so that is one of the headwinds that we're facing, because effectively Europe is suffering given all the events that are happening there. And it's normal that you therefore see an impact on us. 40% of our revenue comes from the Americas, 27% comes from Asia Pacific, and the remainder comes from Europe, which is a large number, 39% if you consider it from our vantage point.
Okay, and so considering where that revenue gets made up internationally and the different regions that you operate within, the exit from Russia particularly, where in the rest of the business do you expect for some of that free cash flow to be able to be put back to work in order to make sure that you're kind of offsetting any of the losses that you would have seen in Russia going forward?
So Russia, in terms of economic impact on us, was minimal. We did say in our earnings release that we, in the course of the quarter, were impacted in the amount of $250 million on revenue, 1 point of total margins, and 6 cents of EPS. Of that $250 million impact, Russia was minimal. The rest was really more related to disruptions in the supply chain in China. Now, in our guidance and where we see the cash flow coming, it's we believe it's for us, it's a story of two components. One is the reversal of headwinds we had on the working capital level as we were buffering inventories for several quarters in a row. And two, it's also our own historic restructuring plans are coming to an end. And those restructuring costs are diminishing very, very rapidly in our free cash flow statement. So if you take the combination of growth in earnings, the reduction of working capital headwinds, and also the reduction of restructuring costs, we feel very comfortable that we can attain our free cash flow guidance for the full year.
All right, we'll leave it there. Hewlett Packard Enterprises CFO Tarek Robbiati, always good to see you. We'll talk to you soon.
Thank you very much.
All right, still to come, Chew on this. Chewy tells naysayers to go fetch. After a surprising first quarter earnings beat, we have your early morning movers. as well as the opening bell next.
Dainomic!
俺は明日美彼方、数々の戦いを乗り越え新たな力を手に入れた。これまでのウルトラマンデッカーの物語を振り返ってみよう。それはこの日から始まった。突然のスフィアの襲来、激しい戦いの中、俺はウルトラマンデッカーに出会う。ウルトラ D フラッシャー、それにウルトラディメンションカードを手に入れ、ウルトラマンデッカーへ変身することができたんだ。輝け輝け輝け、クラッシュデッカー、ウルトラマンデッカーフラッシュタイム。ウルトラマンデッカーの基本形態、クラッシュタイプ。この力のおかげで俺は初めての戦いに勝つことができたんだ。スフィアの侵略によって宇宙に出ることも地球に戻ることもできなくなった中、俺はガッツセレクトに入隊した。そこで出会ったのがかけがえのない仲間たち。龍門相馬です。
桐野一花です。
明日美彼方です。
HANE2 と申します。
朝影です。隊長の村星大二です。
副隊長兼総打手の貝崎沙和です。よろしくね。
そんな中、
これが君たちの初陣です。ガッツセレクト出動。
ラジャー。俺たち新生ガッツセレクトの初陣を迎える。
攻撃開始。
それぞれの立場で奮戦する中、俺は新たな力を手に入れた。ウルトラディメンション、はじけろストローンデッカー。
Welcome back to Yahoo Finance Live. Shares of Microsoft are under pressure in the pre-market after the company updated its full-year guidance. And Brad, wow, especially a day after where we got some upbeat guidance from Salesforce, which is, of course, is a Microsoft competitor. I would say, just looking at this presentation that Microsoft put together via a new filing, they lowered the bottom end of their earnings outlook by 4 cents, and they trimmed the top end of their earnings outlook by 3 cents. And they're blaming FX exchanges, which is not too different from what we just heard from HPE CFO Tarek Robbiati moments ago, another tech company lowering their outlook because of FX headwinds.
Yeah, this is for their fiscal fourth quarter. So in this year, particularly here through May, what they're seeing right now is revenue. The guidance range previously was for $52.4 billion to $53.2 billion. Right now, they're lowering that to a range of $51.9 billion, or if you round up 52. But the high end, that's going to come in at around $52.74 billion. So when we think about this in the net income perspective, yeah, you broke down exactly what they're looking for. On the net income side, that would be closer to 16.85, and then top end 17.43. And I think for more what we're seeing on Microsoft, this is impacting the NASDAQ composite. This is impacting more broadly this move that we're seeing in the pre-market for some of the major averages moving lower right now.
Yeah, no, you would have to think as more companies present at various investment banks in the coming weeks, you will see more guide downs because of FX, various economic pressures. But again, we are watching that opening bell on Wall Street after that Microsoft warning. And here's that.
Japan 日本のお米文化を守っていきたい私たちにとっても、アマゾンは欠かせない存在だと思ってます。クラウドを活用した米の銘柄判定のアプリ開発や、お客様の信頼が高い決済方法で美味しいお米の価値を伝えていって、未来に残せる米作りを目指していきたいです。
Here's that opening bell. Kick off today's trading session. And there we have that opening bell on Wall Street, sponsored, of course, by our friends at Flex Shares. And again, lots of focus on Microsoft here. Of course, that Dow component warning about their profits in their sales owing to FX headwinds. But we did have some other companies and movers to watch here, Brad. We're watching Chewy. In the pre-market, shares were up about 16% here. That is after the company posted better than expected results. And coming into the session, a good shout out, a good note from the folks over at Citigroup that the short position in Chewy was about 25% of the flow coming into this report. So the shorts really be betting against another disappointing quarter from Chewy. They didn't necessarily get it, but I would argue this was not a clean quarter from the company. You had gross profit margin pressure. You had a miss on their auto ship customers, a little over 20 million, I believe. The street was looking for something a little stronger. So not a clean quarter from Chewy, but perhaps just a little bit of a relief rally.
Yeah, the gross margin actually declined about 10 basis points year over year, the company had noted. And then additionally, you look at the net margin, that declined as well by about 100 basis points year over year. You know, all these things considered, do the pandemic pet owners or the pandemic pet purchases or those furry friends that you allowed into your home, does that equate into future growth and consistent future growth and upselling from the Chewy side? Where can they continue to, as we had seen on the Petco front as well, a company that is very familiar with Chewy. I'm interrupting.
That was the name of my former dog. No, not really.
I'm just putting a restaurant business inside the Chewtopia, if you will. But at the end of the day, it really does come back to where they can see some of the overlaps in services and products. We had seen more of these pet retailers leaning into insurance, other services that could become more sticky and creating this ecosystem here for them particularly. But I think from what we heard from the company and Chief Executive Officer of Chewy, Sumit Singh, saying that the fiscal year is off to a good start, 14% top line growth, sequential improvements in gross margin and profitability. But at the end of the day, that's a sequential year over year. That's what we really want to take a closer look at here at the end of the day as well, to really get a sense of how much they're able to keep those customers in their overall ecosystem on a year in, year out basis.
Yeah, worth noting, right? You're worth noting here. You saw Chewy shares up about 15% in the pre-market, seeing some of those gains weaken here a couple minutes into the session. Perhaps as investors really drill down to this into this quarter, you have Citigroup reiterating a bearish rating on Chewy. But I will note this too. I did not like to hear on the conference call from Subit Singh lower pet adoptions. We're seeing lower pet adoptions, and it was pet adoptions that drove this company's financial results during the pandemic. But by and large, interesting quarter from Chewy, and I joked about on Twitter, Brad. I love sharing everything with our viewers. Every time I see this company's report, I think about all my dogs that have died through the years. How depressing!
What kind of dogs did you
And there's my tweet. My team just put it up for me. That's just they do things every day that always surprise me to the upside. That is great work right there. And, it's depressing. That's why I don't have a dog right now. These things really traumatized me.
What kind of dog did you have growing up?
I had a Cocker Spaniel at one point, Chips. Named Chips.
Chips.
Yeah,
Wow.
yeah. I know Mom's going to love that. She's watching this every day.
We had an English Springer Spaniel named Kobe, actually.
Dog's now dead, though.
Yeah, well. Anyway, from the Chewy quarter to AI, C3.ai.
Dead stock here, Brad.
Yeah, shares of software company C3.ai under pressure following disappointing guidance. The CEO noting current economic and political uncertainty, along with pervasive market passivism, lends to the company's inclination to set the expectations a little bit lower here. And so I think for this company and C3.ai, particularly here, they're going to call out things like subscription revenue for the quarter, increase of 31%, the increase of 38% on their overall revenue for the quarter as well, $72.3 million compared to the $52.3 million 1 year ago. But again, it's going forward from here. Where does the company actually see some of that sustained growth? And I think the investors are hardly digesting and very hardly, I would say, some of that growth and where it's going to come from at this point in time, when you had seen so many of the pandemic plays and C3 and anything having to do with the cloud or artificial intelligence or any of the apps that would be directly leaning on some of the C3 solutions and applications, those opportunities, it's now gone fully organic. And if you haven't invested in that organic growth, it's really a question of, all right, where are those opportunities going to come from?
I do like their logo. It's a very nice logo. A couple of things worth noting here as well. A friend of the show, Dan Ives over at Wedbush, noting this is another debacle quarter and guidance. The disappointment continues. Ives is really, who has a neutral rating on C3.ai, really taking this company to task and now saying the company's, quote, credibility in the eyes of the street have been damaged. Really disappointing consistently in terms of results since they went public. But what bothered me, another thing bothering me among many things this morning, Thomas Siebel, longtime tech executive, on the earnings call last night said they are seeing customers push orders back. When you see a veteran tech executive like Thomas Siebel step up on its earnings call and say, hey, customers are a little cautious right now because of the economic environment, that is another one of those. You draw a box on your thing and you check it because that's a red flag too.
Yeah, absolutely. Let's take a quick look at the markets here because one of the red areas actually stems across the major averages right now, the Dow Jones Industrial Average. We were seeing this in positive territory across the board coming into the start of the trading session, and then you saw some of that slip up continue to happen after we heard from Microsoft and their guidance, and then additionally even more so as we had heard more comments from the banks this morning, and we're going to get some Fed speak today as well too.
Well, maybe Jamie Dimon is starting to get his hurricane. Hurricane in the markets here because that Microsoft guide down was ugly.
And not a New Orleans hurricane, which is a very fun thing to think about, but quite frankly, the other hurricane here on the markets, Dow Jones Industrial Average slipping into negative territory, down by about 0.2%. S&P 500 lower by about 11 points, 0.25% decline there. NASDAQ Composite, you're seeing that down fractionally 0.4% there. We've got much more on today's early market activity. Yahoo Finance's Jared Blickery joins us from the floor of the New York Stock Exchange next.
あ、割とならこうするね。家から一歩も出ずに買い出し完了。おもてなしにアイデアを。楽ちんだにゃん。
仮面ライダーブラックさんプライムビデオで独占配信。
貯金だけじゃダメか。
そろそろ FX な皆さん、 FX なんで外為 .com で始めないの。初めてのあなたを全力サポート。外為 .com。
五感を呼び覚ます移動空間を思い描く。
冷蔵庫空っぽ。あ、買い出しの時間ないじゃん。
なるほど。あ、ボルトならこうするね。お買い物も約30分でお届け。おもてなしにアイデアを。
助かる。
五感を呼び覚ます移動空間を思い描く。包み込まれるようにあなたと世界をつなぎ、新たな可能性で満たされる。新次元のひらめきを体験できる。デジタルで自動化されクリーンに走る。持続可能なハイクラスモビリティの新世紀へ。アウディ。
洗練されたこうセンスを感じるようなショップカードにしたいなと思ってます。メッセージを入れたいから別のフォントないかな。繊細な色を出したい。
you
あれ出さなきゃね。
新米炊いたんだよ。
お米嬉しい。サトフルでちょうど届いたんです。
本当いいサトフルだよね。
いい奥さんだろ。
そういうとこだよ。
ふるさと納税を始めるならサトフルで。
Rightly or wrongly, the Fed views the labor markets as the conduit to achieve their inflation objectives.
I think the whole inflation fear is way overdone, and it's starting to leak into the data.
We've not yet seen that turnaround in US inflation that will really get the Fed to actually cut rates rather than just pause the hikes.
Now, the odds of recession are very high, but we haven't seen the whites of the eyes of that recession yet.
I think there's an argument you're starting to price in a mild recession, but you're certainly not pricing in something severe.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good to see you back. How was jury duty?
It was good. It's a great thing in America, and New York City does it better than anybody.
You sound inspired this morning.
A man and a woman that revolutionized it, and the rest of the country copied.
Should we start the
Very
show?
Cool.
Let's start the show.
You know, the judge looked at me and said, "I know you," and he said, "See ya."
Live from New York
I was
City
up by
this
10
morning.
a.m.
Good morning. For our audience worldwide, this is Bloomberg Surveillance. What a day we've got coming up for you. An ECB rate decision, earnings from Apple and Amazon, TK. We've got to talk about Credit Suisse as well. Futures unchanged on the S&P. Credit Suisse over in Zurich, down and down hard.
Why are we talking about this, folks? We're talking about this because for the Bloomberg world and global Wall Street, this is painful and somewhat clear. Lisa was mentioning before the show, a little opaque. But, John, what I would suggest here is I am focused on the dilution at hand. The stock down 12%, down 16% earlier. It's 10% to the Saudis, and a further dilution. The way you spell rights, folks, rights is not seen in America, John. Spell rights, D-I-L-U-T-I-O-N.
Dilution.
It is dilution.
It's
That's
a
what
4
we're doing.
billion Swiss franc rights issue. And, Tom, it's the rights issue that I think a lot of equity investors wanted to avoid, and ultimately they can't avoid it. And, Tom, there's two other issues at play here as well. You've got the rights issue, you've got the terrible earnings, and then you've got the reorg. So can we talk about the reorg? Can you make sense of the reorg this morning?
Yeah, they want to be James Gorman. Simple as that. And, you know, there's another, on the FT, there's an article on Nachman over at Goldman Sachs. Goldman Sachs wants to be James Gorman. Everybody wants to do wealth management and the consistent cash flows generated. That's different than doing SPACs.
We need to talk about what First Boston ultimately becomes, Lee. So that's going to be the spin-off for the investment bank. Reuters is reporting just moments ago, by the way, that they're considering an IPO for that particular unit.
They're looking for outside funding to help provide some of the risk-weighted capital to go out and really build out the leveraged finance unit that really had been the stalwart of Credit Suisse for so long when they merged with DLJ back around 2000. So how much can they really recreate that using private capital without necessarily some of the consumer deposits? And then also I'm curious about what kind of equity stake some of the senior managers who are taking this on have.
That stock looks ugly. We're down by 10, 11 percentage points this morning. TK, if you want even uglier than that, look at Meta. Facebook is down 20% in the pre-market.
Julian Emanuel writing for Evercore that after Meta, after what we saw with Google, Facebook, Google, there I go, now it's clear. After what we saw there, Amazon and Apple today are ever more important, but I really take issue with people that compare even Google with the cash flow streams of Amazon and Apple.
Facebook is not in the mix at all anymore after the damage to that market cap so far this year. Want to whip through the price action for you outside of equities, which, as I say, are unchanged on the S&P 500. And look at the bond market. Yields are higher by 5 or 6 basis points, just north of 4% on a 10-year. Kind of been hanging out at that level over the last couple of days on a 10-year maturity in the Treasury market. In the FX market, euro just slightly weaker. Euro dollar down 0.4%, 100.41 on euro dollar. TK, a weaker euro going into an ECB rate decision a little bit later.
Weaker euro, but coming back over the last couple of days and combined with the equity market, John, you mentioned in our 2-hour meeting before we were on air that the idea that SPX has actually done better than the tech bang-up of the last couple of days, and you see it with euro goes to parity, stronger euro. VIX from 30.31 into 27.55. There's some oddities right now on this important Thursday.
I think that was the story yesterday, Tom. If you strip out the muscle of big tech and just go to the equal weight S&P 500, it was positive yesterday. So the pain you saw in Alphabet, the pain you saw in Microsoft, it didn't bleed. It didn't bleed in a major way.
20% of SPX market cap this afternoon.
Unreal, isn't it?
Yeah.
Couple of names. Just fantastic. Lisa, looking forward to that, the earnings and an ECB rate decision later this morning.
Yeah, and John, you were talking about how yesterday, if you stripped out some of the big tech names, you actually saw a positive return on the equal-weighted S&P. The reason why? The step down. I know you guys are incredibly excited. Do we get the step down in the ECB today? Not necessarily at the 8:15 a.m. rate decision, where they are widely expected to go 75 basis points, raise rates by that, and across the board raise all of their benchmark rates. But in terms of December, Do they go to 50? Do they even potentially go to 25 basis points? We get an 8:45 press conference with ECB's Christine Lagarde. How much does she signal they're concerned about the pain? And what is the litmus test of the euro? Does the euro weaken further if they signal a step down, or does it actually gain in terms of the potential for some sort of economic growth? At 8:30 a.m., U.S. Q3 GDP figures. This is the first read that we get, really digging under the surface. Maybe we get a positive read after 2 consecutive quarters of a negative print, kind of eradicating some of the claims about a technical recession. Do we get a more optimistic look there? And then initial jobless claims. Why are we not seeing them really tick up? They're still at historic lows, even as the Fed aggressively goes after raising the unemployment rate. And as we hear some of these big tech names really talking about potentially cutting back pretty substantially some of their staffs. And after the bell, Apple and Amazon report earnings, also Intel. And I'm curious to see them as well from the chip sector. But Apple and Amazon front and center. Apple, importantly, John, how much can they remain the cash cow? How much can they remain the story of, you could all doubt me, you can all think that we're not going to necessarily perform, especially in light of what we're seeing at the Intels and the other chip producers in the world, but we continue to outperform. Is that going to still be the story today?
Hey, Lisa, thank you. TK, if there's one name that can define an earnings season, it's Apple. And we've been talking about lowering the bar for the last couple of weeks. We've had the report here at Bloomberg that maybe iPhone demand is faltering. Tom, how many times have we said that going into the print? And as we often say, they knock it out of the park.
Well, they knock it out of the park. And again, it's going to be the same with Amazon, and that's subsets. How does services do at Apple? It's, I sound like Dan Ives here, which is not my job. But the answer is, John, you're right. They always are these angst, these worries. What I would point out, particularly to American listeners and viewers, is I believe there's another price war at the phone carriers to move units.
I see the same thing.
And that, I'm not sure how that folds in.
We'll catch up with the Apple story a little bit later. Let's start with the ECB story this morning and speak to Katrina Dudley, the portfolio manager and research analyst at Franklin Mutual Series. Can we just begin with the ECB, Katrina? We're looking for 75 a little bit later. What are you looking for?
I think we're all looking for 75, so you're right in the ballpark there. What would be the surprise here is if they do 50. You've seen the Reserve Bank of Australia do 50. The Canadians followed fairly quickly, and so the ECB does have the flexibility to do a 50 basis point and a little bit of a wait and see. And we've seen some kind of softening in the PMI data. Take a look at the Eurozone numbers. They were weaker than we're expecting. A lot of that weakness is coming in Germany, which is really that manufacturing hub of Europe. So we are expecting 75. The surprise here would be 50.
Katrina, is there a theory to that? Is there some form of grounding of economics in these adjustments from Canada, maybe from ECB, maybe, dare I say, from the Fed, or is it they're just making it up as they go?
Everyone here is making it up as they go because we really have not been in this position for so many decades. The caution with the ECB is twofold. First of all, if you go back, post the GFC, they tightened too quickly and they acted too quickly in the past. So I think that there is a little more hesitancy at the ECB than there are in other markets. The second thing is that we really don't, understand here in the United States. Europe's faced a triple whammy here. They've had the war crisis, they've had an energy crisis, and they're facing monetary tightening. And so the combination of those three, I think, puts them a little more on the cautious edge. That said, I really do want to say that we are probably in line with the market, expecting 75 basis points. What we're really paying attention to is the forward guidance and any signaling you get as to what they're going to do in that next meeting.
So let's talk about the potential reaction to that, Katrina. Yesterday, we saw the Bank of Canada surprise to the downside with respect to how big the rate hike was. This was the step down that people were looking for. People have looked to the Bank of Canada to really be on the front foot with setting a tone for central banks. If the ECB follows that and signals only a 25 basis point rate hike in December, what's the reaction? Does the euro strengthen? Do we end up seeing actually more expectations of growth in the euro region, or do we see the long end yield spike and further weakness in the euro?
what you're going to see is the market's going to react positively, because what they see is that the ECB is accommodating the fact that the PMIs are slowing, and by slowing down the pace at which they increase interest rates, they're giving support to the overall economy. The risk here, and the risk that we're really focused on in the United States, in Europe as well, is that the rise in rates chokes off an economic recovery. So if they temper that rise in rates, they're likely to see that economic recovery has some small level of incremental support. I do say it is a much smaller level of support. In terms of Australia and Canada, though, I do want to point out one small thing is the transmission mechanism there for those rate reductions. So instead of doing the 75, they did the 50, is much quicker and cleaner, because the housing markets there are variable rate mortgages. In the United States and in more of Europe, the UK is an exception, you don't have as much of that debt and that mortgage debt. So the transmission mechanism there isn't as fast as it is in those other Commonwealth markets.
Hey, Katrina, wonderful to hear from you to kick off our coverage today. What a Thursday we've got coming up. Katrina Dudley there, Franklin Mutual Series. TK, the depot rate could double a little bit later, from 75 to 150.
And what's great about this, folks, is we have John Farrow with years of experience on the lawn at Frankfurt, and I believe Maria Tadeo's there today.
We're going to catch up with the later.
The two of you together on this, because I would know the depot from the repo from the whatever
from
rate.
the Teltro.
And exactly. And the answer is the body language of the press conference is going to be really, really interesting. We'll bring you those headlines on radio and television through the morning.
I actually think this moment is a lot more simple to understand, because we're seeing it play out in the United States increasingly too. You're going to see some political pushback, Tom.
Huge.
In a much, much bigger way. Look at the data in Europe right now. The PMI's in the 40s, and they're going to hike 75 basis points.
You're going to laugh at me, because I've been screaming about this for months. There's a point where you walk towards neutrality. Maybe it's 75 beeps now, maybe it's 50. What do I know? And then every step from there becomes excruciatingly difficult. And we are there right now.
Jamie Dimon at JP Morgan spoke to CNBC in the last couple of weeks, and he talked about the next 100 basis points of tightening from the Fed being the most painful 100 basis points. I'd extend things just a little bit, Lisa. I think politically, it's going to be the most painful 100 basis points, not just for the Fed, but maybe for the ECB as well.
I would agree. I also think, though, that at this point, if they don't continue to hike, what is the response from the bond vigilantes on the long end? Do you start to see borrowing costs surge in a way that becomes political untenable regardless of what they do?
The ECB decision coming up a little bit later. Earnings from Apple and Amazon. What a Thursday. Some economic data coming up at 8:30 Eastern Time. We'll break that down with Mike McKee. Coming up shortly, Sharon Bowler, Goldman Sachs, in the next hour. Looking forward to that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Central Bank is set to lift main interest rate hikes to the highest level in more than a decade. It's trying to lower record high inflation. Almost all economists surveyed by Bloomberg predict a second straight 75 basis point hike today. President Xi Jinping in China is willing to work with the U.S. to find ways to get along. The comments came before a possible meeting with President Biden next month at a Group of 20 summit. It signals an effort on Xi's part to maintain ties despite disputes over everything from Taiwan to chips to the invasion in Ukraine. Russia has carried out military exercises simulating a retaliatory nuclear strike. Vladimir Putin oversaw the drills. Secretary of State Antony Blinken told Bloomberg that the U.S. has warned Russia that any use of nuclear weapons in the war against Ukraine would have grave consequences. And Credit Suisse is planning a sweeping overhaul. It includes $4.1 billion in capital raise, a carve-out of its investment bank, and thousands of job cuts. It's the most urgent attempt yet to repair Credit Suisse after huge losses and management chaos. In breaking up the investment bank, the firm will create a separate advisory and capital markets business that will revive the First Boston branding. And the world's richest man told Twitter employees he doesn't plan to cut 75% of staff. Bloomberg's learned that Elon Musk denied the numbers in an address to workers at the company's San Francisco office. Still, the billionaire is expected to cut staff when he takes over the company, causing anxiety among workers. The $44 billion deal set to close Friday. I'm Lisa Mateo. This is Bloomberg.
家の売却でお悩みのあなたに売り時を逃さないために重要なのは
制約までの速さ。
正解。家の早期売却を目指すなら
買い手もノウハウも豊富な大手で相談。
その通り。 それら全てに応える不動産一括査定サービスといえばスマイバリュースマイバリューなら大手6社の査定からな
We want to go through the transformation of the next 3 years with a very, very strong capital base and leave the transformation also with a very strong capital base. It will become profitable definitely from 2024 onwards.
What a tough morning for everyone working at Credit Suisse this morning. Good morning to you. That was the Credit Suisse CEO. The stock is down in Swiss trading by almost 12%. From New York, let's get to the price action. What a day we've got coming up for you. Outside of Credit Suisse, we've got earnings from Apple and Amazon after the close. We've also got an ECB rate decision. Equities look like this on the S&P. We're positive on the S&P by almost 0.1%. It yields higher by 6 basis points on a 10-year. Just north of 4%. The euro's weaker going into that ECB call a little bit later, Tom. Euro dollar just above parity still, a one handle on the euro.
For Global Wall Street now, an informed conversation on the disaster known as Credit Suisse. This is trading on a book value basis. This is off the BQ screen on Bloomberg. It is apples and oranges, 1.4 something for JP Morgan, a little bit better for Morgan Stanley, really showing the successful decade of James Gorman, and Credit Suisse, 0.24. That's all you need to know. That's what Marcus Ashworth knows of Bloomberg opinion steeped in EU banking. Marcus, you and I go to dilution, except you and I know the calculation of equity dilution is complex and is usually something failed on a CFA exam. How bad will the equity dilution be for shareholders of Credit Suisse?
Well, I think they're learning a lesson of their compatriot banks, what Swiss Bank, which merged into Union Bank of Switzerland to create the UBS model. 10 years ago, UBS decided to cut through, muscle, bone, everything just to get to a level whereby they could be appreciated on the stock market. It looked like, wanton destruction as we are looking at Credit Suisse now and seeing, all sorts of things going on which, look unpalatable. And silly in some senses. Some of the most profitable parts of the bank are going to be hived off. But if it results in, as you said, that tangible book value of 0.25 or whatever it is, doubling and then going again up towards just tangible book value at some point in the next few years, that will be deemed a success. And that's all the management care about.
Marcus, what is the timeline to find the formal dilution of these set of transactions? To me, it's a 3-year timeline, even though they're talking it up in a cup of coffee. Is it 3 years or is it even longer until you let the dust settle on dilution?
Oh, I think there's got to be substantive, real results well before that. They may take 1 or 2 years beyond that, but you've got to have the direction of travel clearly laid out. They need partners clearly on the investment bank, CSFB. They need partners into the structured part of the product group or sale thereof. They need real results and something absolutely clearly happening. Credit Suisse is about a private bank, a wealth management, and asset management. The rest of it, is important, but it's not vital, and that's clearly what they're showing here. The amount of capital they're putting in investment banking, the hiving off the successful glory bits of stateside stuff, that's where the money still is. The European side, not so much. That's going to get withered on the bone.
Marcus, Credit Suisse is its own animal. It has its own pain. It has its own story, but it is within the microcosm of the European banking system, which faces a sort of regime change today, potentially, if the ECB doubles the deposit rate, if they double the benchmark rate. They've been used to the highest levels in more than a decade. How much does that change the scenario in a positive way for banks that have been looking for higher yields, higher rates for a very long time?
Difficult one. Not very much. I mean, especially if it causes a recession, which is quite likely, I think, in my mind, that we're already probably in a recession in Europe and it's going to get worse. So hiking interest rates and doing some other things as well. I think it's the other bit, the complex monetary plumbing bit, which is these excess reserves. A lot of banks borrowed up to 2 trillion euros at as low as -1%. They've got that free money locked in. And as you say, if deposit rates go up to 1.5, they can sit and park their money back at the ECB at 1.5%. What a lovely round trip. That's too generous. And clearly the ECB are going to want to do something about that. If they overdo it, they're going to cause a liquidity withdrawal or potential financial conditions nightmare, like we saw in the UK recently. and perhaps a collateral squeeze as well. They may lose control of their money market rates. They could get this very wrong. They could get sued. There's all sorts of things that could go wrong with positive rates for the ECB. Is quite a new world. They are so used to negative rates, they haven't quite worked out what it's like above ground.
Which raises a question about what they're going to do in December, and that's what people are really looking for today at the ECB rate decision in terms of whether they ratchet back some of their plans to raise rates. Do you think that that's what the market is basically asking for, and that financial stability will be an increasingly pressing concern if they signal an ongoing aggressiveness?
Yeah, I think the answer to this all lies, as ever, not with the ECB, but in the Federal Reserve. What the Fed do on November 2nd is key to everything. If the Fed do slightly pivot or say that the next hike won't be something like another 75, it gives the ECB the freedom they so need and want to perhaps only do 50 in December, and probably will stop it either there or very soon thereafter. They will talk a bigger book. They have to keep that euro back above parity. Just gone back above, first time for quite a while. They'll want to keep it above parity, and therefore they'll want to keep talking, but they really want the Fed to ease off.
You'd have to imagine, Marcus, by the time we get to December, there's a forecast that spouts out recession. Isn't that? Is that avoidable?
No way. I think absolutely UK, Europe, they're already in recession in all but name, and it can only get worse the more they hike interest rates, let alone talk about withdrawing stimulus too hard. They get the quantitative tightening wrong and all this reduction of excess reserves. A world of pain is coming.
Marcus Ashworth, thank you, sir, out of London. That's the problematic view of things, Tom, when it comes to the ECB. The fact that their base case doesn't include right now a recession in the Eurozone. Next forecast, I believe, come in December, and when they sit down in December, Tom, you'd have to imagine there's some form of downturn, some real downturn in that outlook. And how do you hike again 50, 70 basis points if that's the case?
I was remiss, John. I didn't look at this when I came in this morning, and it is the Bloomberg Financial Conditions Index, which I've mentioned a number of times. England and America are very close, and they've improved here over the last number of days. ECB is stunningly different. This is a different press conference than what we're going to see from Chairman Powell.
There is one really big piece of good news, though, in Europe when it comes to the gas price story. Lisa, is so much better than it could have been at this time of year, primarily because it's been warmer than most people thought it would be.
And this is what I'm struggling to understand. At what point is this a positive development that has really fully been bled through into markets versus what everyone seems to be saying, just wait until actually the winter comes, because it hasn't gotten cold yet. And I was reading a story about daylight savings time being actually a nightmare for the European region because people turn on their lights earlier and that uses up more energy. There are all sorts of things that people are looking for. I know you look skeptical, but these are some of the things that are
I've been looking forward to getting rid of that for a long, long time, haven't you?
I wonder how much pressure there is. Yeah, I mean, I wonder how much pressure there is this time from an energy perspective, because it creates a little bit more of a difficulty.
We fall back.
You fall back.
We fall back.
Oh, of course.
We spring
and
forward.
You spring forward.
Thank you.
That's right.
That's my value add for the day.
We'll all remember that, Tom. Thank you.
My value add.
Three hours away from the opening bell, here's the price action for you. Starting with the equity market on the S&P 500. Futures just about positive on the S&P. Let's call it unchanged. On the Nasdaq right now, we're negative 0.5% on the Nasdaq 100. Meta is down and down hard. But like yesterday, it's not bleeding in a major way. We're down about 19% on Meta. Yesterday, we were down hard on Alphabet, call it Google, Tom. Down hard on the likes of Microsoft. We were off by almost 8%. But as I say, if you strip it out, if you equal weight that S&P, we were positive yesterday, Tom, and I think that might be a surprise for some people out there.
You followed this closer than me, but there's got to be a separation here. This is about Mr. Zuckerberg, right?
Oh, without a doubt.
It's like the Mustang with the sink walking into Twitter. Google's about Google, right?
Sheryl Sandberg has left. Facebook is kind of a mess right now. The outlook, they're investing in a very uncertain future, Bramo.
Yeah, she's got the Bramo
the metaverse, the rebrand. Take your pick.
Well, how much is this really the push-pull of the negativity? Yes, of Meta, Facebook has its own challenges, but we're seeing the same thing across the big tech names that have reported. How much is this the specific situation of FX headwinds and an economic downturn on one side, and then the step down, the potential for the Fed to not hike rates quite as much as people had expected on the other, providing optimism to the other sectors? It's the push-pull.
I thought Neil Dutter of Renaissance Macro was just awesome yesterday. Sat in that chair and he just said, step down. It's implicit in the dot plot from the Federal Reserve. This is not news. Why did you need a journalist at the Wall Street Journal to write this up for you and summarize what people have already said and what is in the guidance?
I could not agree with him more. And you've raised the issue about how strange it is that we seem to be agreeing. But
John mentioned this before air. John and I usually don't talk before air, but, you know, we spent 30 seconds today catching up. And, John, you mentioned it. Everything in the S&P looks good versus the tech challenges that are out there. Caterpillar just out. I'm sorry. Caterpillar's not a tech company, and they're up nicely. They go from a 197 up near a 200. You know, a little bit of a lift there on a CAT after earnings.
EPS 395, the estimate 318.
Pretty good.
That's a big beat up.
Maybe that's what we're going to see. Let's do this. Let's dive to the ECB now. I'm going to ask a couple questions. You can get out of the way of John and his real expertise on this. Christian Scholz is of Citigroup, the deputy chief European economist. Christian, I mentioned earlier the fancy math of the Bloomberg Financial Conditions Index for Europe. It is extremely challenging. How much will Christine Lagarde's press conference be treated today, touched today, by the grim financial conditions of Europe?
Well, it will play a role, I think. I don't think it will have much of an impact on the rate path, on what Christine Lagarde's going to decide and her team are going to decide today, the 75 basis point rate hike, or what's going to follow on later. But it will play a role in how they think about reducing the balance sheet, because that is clearly the next thing that's going to come up. That's going to be in focus, I think, also in the press conference today. And that's where they really need to be careful to not make things even worse on the financial conditions side. You know, obviously the Italian question, but there's many other issues in the plumbing of the financial system that need to be dealt with.
Sounds like a movie. The Italian question is, well, John, jump in here on the balance sheet.
Well,
You're
I think
expert on this.
beyond the balance sheet, Tom, the Italian question right now, if you want to deal with that. Christian, it's the Italians asking the questions, not the Europeans asking the questions of the Italians. You've got the new Prime Minister essentially, and not subtly, going after the ECB about hiking into a downturn and the pain it could cause, backing away from bond buying. Christian, how do you think this ECB will grapple with a different kind of politicisation?
Well, they've created a tool, the TPI, the Transmission Protection Instrument, in order to deal with spread widening where it's not fundamentally warranted, so where it's not caused by a policy error that governments themselves need to fix. That is a bit of a warning to this Italian government, not to play by the rules, but it's also a guarantee that if they do, the ECB will be on their side. Will it be enough if trouble really starts hitting the proverbial? We are a bit skeptical. It's big on paper, this tool, but the mechanism of actually activating it and everybody agreeing on it, we think is very difficult. So it's clearly a very, very difficult situation, but it starts with Italy itself. They have to play by the rules.
With that in mind, is it too early to discuss QT at this meeting?
QT will inevitably have to be discussed and will have to be decided and will have to happen the minute the ECB moves beyond neutral on the policy rate, because you cannot have the policy rate being restrictive and or stepping on the brakes and at the same time having a balance sheet setting which is still supportive to the economy. So at that point, the ECB is going to have to start QT. We don't think that the ECB will reach restrictive territory before the start of 2023. So there's still a bit of time, and with all the complications, they better take their time in thinking about it. But come, say, April next year, they will be reducing their balance sheet. And come December, they'll probably decide about this. And today, they may even hint when they will do this.
They will plan to start that in April. They will plan to continue following the plan. But right now, according to their plan, there will not be a recession in Europe, even though every major Wall Street bank and beyond seems to think that there will be. Do you expect them to revise that expectation today?
Well, today is obviously not a meeting with new forecasts. They clearly signal that things have played out worse than they perhaps expected in their last set of forecasts in September, which will signal that a recession will probably be part of the base case in December. We've always said that they won't get very far in their rate hike cycle because of this. But at the same time, inflation is in double-digit territory. We'll see in the next few days where it's going next. It is broadening. Demand seems to be recovering too fast for supply to catch up. There is a case for the ECB to hike into a recession, of course. And I don't think they'll let a recession of, say, the garden variety stop them.
You know, Tom, I do wonder how much some of the American tourists end up being part of the demand story, given the fact that everyone and their mother seems to be going over to Italy.
Just as a quick aside here, but I think Paris is traditionally 17%, 20% of French GDP, and then all of a sudden it was 25%, then it's 27%. With the new tourist boom, I wonder if that tips over 30% of French GDP.
And if you look at all the airlines, September and October is the new summer just because people can work remotely. I wonder, Christian, from that perspective, some of the gains that you've seen in the recovery, does this make the ECB's job harder? That if they are not aggressive enough, you end up with inflation that is more persistent, and you end up with market vigilantes coming out and penalizing the ECB for their actions?
Indeed, there is a strong consensus, at least in parts of the, among observers, that the ECB is behind the curve, that it failed to realize that, all the stimulus that the government's injected in the economy during the pandemic was going to have some impact on, a strong impact on demand when supply couldn't recover quickly enough, and that supports inflation, and that raising interest rates earlier maybe would have made the whole process a little smoother. I think, of course, we all agree that really most of the inflation has nothing to do with the European economy. It comes from external. It comes from Mr. Putin's war in Ukraine and everything that happens around energy, which the ECB cannot do anything about. But clearly there is a rise in inflation expectations, which we observe. If the ECB doesn't react to that, is effectively lowering real interest rates, and that would support demand into a supply crisis, which really can't be the ECB's intention at the moment.
Hey, Christian, thank you. Christian Schultz there of Citi. I want to go back to the earnings from Caterpillar out just moments ago. Third quarter adjusted EPS $3.95, the estimate $3.18. This was a number that jumped out for me, Tom. Machinery, energy and transportation revenue, $14.28 billion year over year. That is plus 22%.
Yeah. And you see that in the organic revenue as well. We've had out here, and this is a busy day with 20% of the market cap, Apple, Amazon later, Honeywell, Southwest Air, Caterpillar, picking them out randomly as well. John, add them all together, they make up 11% of Apple's market cap. I never would have guessed that.
Okay, but something's changed with Facebook. Did you notice that Chevron and Exxon have bigger market caps now with Facebook? That's a change, Tom. That's a big change. And if you think about where the excess has been...
Many would say they should.
Where the excess investment has been for the last 10 years, it's been in technology. So if you think about where the recession might be, it's going to be the investment made in the last 10 years in places like that. Where hasn't the investment been? The CapEx hasn't been there in the same way in the energy names for the last decade.
Paul Sankey's led on that. Paul Sankey,
Jeff Curry, Javier Blas, they've all made the same point.
And you wonder with the durability of energy. I'm hearing most of the sell side, the zeitgeist, Sam Stovall as well, saying energy is something still that's underinvested, even with the rush to 120 earlier.
Even in the face of recession risk. Lisa, that's what's remarkable about that energy call, even in the face of recession risk.
Yeah, there's a structural need to invest in some of these areas. Your point, though, about the fact that tech was the leader. Tech were the names where people would actually invest. Now we're seeing that really punctured. Just to give you some sense of scope with Meta, right? Facebook. Their market value has collapsed by $520 billion just in the past year alone. And they're now below the level of the 20 largest U.S. companies, trading at a 50% discount to the NASDAQ 100. Just to give you a sense, that is the most ever with respect to the discount.
I believe that drop is almost double the value of Cat, Honeywell, in a small Southwest Air company.
So, John, this is a reason why I wonder, can these things happen in isolation? Or is there a broader market ramification that we might not have felt yet, especially if it's not alone? It might be idiosyncratic features for each of these tech companies, but the investment was done during a time of much cheaper financing and much greater ambition for some of the tech names that are finding themselves in a new environment.
And cheaper labor, too. Think about where the capital was going. It was going to food delivery.
$30 salads.
Cheap car drives. Cheap taxis, Tom. I mean, sure, it's ridiculous. But, Tom, that's where the investment has been. This is why Jeff Curry of Goldman came out months and months ago and said this is the revenge of the old economy. Underinvested And this is the revenge right here on the screen. You see it play out. Look at the year-to-date performance of tech. Look at the year-to-date performance of, say, energy.
What I see, I don't have it in front of me, but those organic revenue, remember organic revenue was a GE thing, was a Jack Welch thing. Now we're seeing it everywhere. And the nominal GDP pop we've seen with inflation gives you buoyant organic revenue. And the question is what happens? And the answer is like Coca-Cola the other day. Pricing power is in place, at least for now.
Still an inflationary world, Tom? Not a disinflationary bust yet? Is that
well,
one for next
don't
year?
tell that to the housing market, but
I know, that's brutal. We'll talk about that later. Futures right now unchanged on the S&P. On the Nasdaq, we're negative by about 0.6%. Coming up, Gene Tenuto, 7:30 Eastern Time. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Central Bank set to look past growing fears of a recession today. It's expected to raise interest rates by 75 basis points for the second time in a row. The ECB is trying to quell inflation that's running at almost 10%, 5 times the ECB's medium target. The Biden administration has been forced to scale back a plan to impose a cap on Russian oil prices. That follows skepticism by investors and growing risk in financial markets. Instead of strangling the Kremlin's oil revenues by imposing a strict lid on prices, the U.S. and EU are likely to settle for a more loosely policed police cap at a higher price than once envisioned. Meta CEO Mark Zuckerberg asking investors for patience. The parent of Facebook is spending billions to pay for its version of virtual reality at a challenging time for digital advertising companies. Meta's shares fell more than 20% after it gave a disappointing quarterly revenue outlook. Samsung Electronics has named J.Y. Lee executive chairman of South Korea's largest company. Lee has been expected to take over the post after his father died in 2020, but the move was delayed by corruption investigations and 2 stints in jail. Among other things, Samsung is the world's biggest chip maker. And going into the midterm election, the American middle class is facing the biggest hit to its wealth in a generation. Still, it's also richer than it's ever been, thanks to a decade of cheap money. That's a conclusion of a Bloomberg News examination that paired new wealth data with an exclusive Harris poll of 100 million adults. Hear more on that story with Bloomberg's new Big Take podcast. There's new episodes every weekday morning. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We're not going to get the full capitulation from companies on 2023. We think it's just going to take longer. We've written about that quite a bit when we read our research. So you know how we're thinking. We're still bearish in the intermediate term. We don't think the bear market's over, but we do think this tactical rally is going to be big enough to try and pivot and trade it. You know, for those clients who can do that.
Awesome to catch up with Mike Wilson and Morgan Stanley just yesterday on this program, live from New York City this morning. Good morning. Here's the price action for you on the S&P 500. Futures unchanged. A defining characteristic of the last couple of days is that you get big tech, some names getting absolutely hammered, and this market's still holding up, particularly if you go equal weight and strip out the big weightings of big tech. Positive yesterday on the S&P 500, despite the fact that the likes of Alphabet and Amazon and Microsoft got absolutely hammered, Tom. Microsoft down by almost 8%, Alphabet down 9% yesterday, and Facebook this morning, if you want to look at Meta in the pre-market, down more than 20%. Just a brutal morning for Meta, and you wouldn't guess it, would you? looking at the equity market this morning?
No, you wouldn't, because we've seen some good industrial earnings, people that are not techie and not VR and the rest. I don't really understand it. I'll let you go there. What I'm going to go to now, and we do this with Mandeep Singh, Senior Technology Analyst at Bloomberg, really, really encyclopedic on this, is Mandeep, I looked up at Home Depot, and if I want to go out and buy a sink and walk into Bloomberg surveillance with a Kohler Memoir sink today, it'll cost me $271.13. Why is Elon Musk carrying a Kohler's Memoir sink into Twitter?
Well, I think what he's trying to suggest is, look, he's ready to close the deal, and probably, he will be part of how this thing shakes out eventually. No one knows, what sort of changes he's going to make, but clearly he has highlighted, things around cost structure and where they could go with the product. So Sync was just a symbol of him trying to suggest that, yes, he's moving ahead with it.
How distant are Amazon and Apple from the follies of Facebook?
Well, so Facebook was self-inflicted. If you look at the print last night, that was okay, in line with consensus. The earnings wasn't bad. It was just the guide around CapEx and the OpEx spend. And what's surprising to me, and to an extent irresponsible on the part of Mark Zuckerberg, is, with any new technology or product, you have an initial launch, you get some market feedback around product fit, commercial success, where are the areas you want to double down on. In this case, he is just doubling the CapEx. Facebook used to have $19 billion annual CapEx. Now he's talking about 34 to 39 billion. And to me, it's just baffling at a time when your top line is decelerating, your business is challenged because of competition from TikTok. I think it's just irresponsible.
When you say competition, this is the key, right? That Facebook is known as the place where grandparents post pictures of their grandchildren for their friends. It's not known as basically the TikTok of the new generation, or even the Instagram, which has been basically fueling them. But even that is losing some of the clout that it used to have to competitors. So at what point is this an existential crisis that really calls into the question the size of this company? And Mark Zuckerberg knows that and is basically burning money to try to figure out what's next.
Well, so I will give them credit that they're trying to, leverage a lot of AI to catch up to TikTok, and a lot of that CapEx spend is going towards data centers. So granted, they're trying to narrow that gap that TikTok has through CapEx investments. That is okay. The problem is, the younger demographic has already moved off the platform, to your point about, Facebook and Instagram losing some of the audience. And with any, social network or a consumer internet company, once you lose your critical users, which the younger demographics are, the others will follow, and then it's it's very hard to stop. So that's why he's doubling down. But I still think, the fact that he kept highlighting metaverse and AR, VR, and adding more product SKUs around VR at a time when unit sales are declining for VR is just surprising.
Yeah. And I would say that just from personal experience, it seems like it's TikTok and Snap of the younger cohort. On a broader level, though, how much is Facebook really representing something deeper here about how much money was thrown at certain tech companies that might become obsolete or out of style at a time when they still carry massive clout in the index? Is this the tip of the iceberg in terms of investors withdrawing?
I don't think so. I do think, investments in AI will pay off eventually. You look at a Microsoft or an Amazon AWS, these are secular growth kind of companies. I mean, yes, you will have a digestion phase in terms of cloud spend coming down, but in terms of the runway, this is huge. We will need the cloud infrastructure, for the foreseeable future, 20, 25 years, and until something else comes up. But AI investment isn't going to go waste. The problem is, where do you focus when it comes to those AI investments? And in this case, if it was autonomous driving or something that was more proven or further ahead in terms of commercializing, it's like Alphabet pivoting completely to Waymo and, saying we will double down and we will add. And it just doesn't make sense. You have to do it in, steps. And that's the part that I think Meta is getting it wrong.
Mandeep, do you get the feeling that Sheryl Sandberg knew what was coming?
Anytime, a top executive leaves, a CFO or, somebody like Sheryl Sandberg, they're kind of, suggesting to you that
that's a yes.
Yes, they're not. Yeah. and so I would agree with that interpretation.
Yeah. Just to the chart, John, Facebook down 43% since June 1st.
Oh, it's ugly.
Down 43% from Sandberg Day.
And Mandeep Singh there. You're calling it Sandberg Day?
Sandberg Day. Yeah, I'm making it up as I go.
June, just brutal.
People know where I am on this. I mean, the day they went public, day they went public, I had David Kirkpatrick and Paul Kudrowski on together. What an honor that was.
Yeah.
And David Kirkpatrick absolutely nailed the success of Facebook. I was wrong. Kudrowski was wrong. Kirkpatrick, the Facebook Effect author, nailed it. I wonder what he would say now.
A lot of people enjoying its failure now, Tom.
Yeah.
Talk a lot about TikTok's success. Have you seen how many people are getting their news from TikTok now?
Yeah.
I mean, we're slightly concerned about that, given this company's association with the Communist Party in China.
We're going to stop the show here.
Americans are getting their news from.
We're going to have an internal Bloomberg surveillance show. Welcome all of you to an internal meeting. Should we be on TikTok?
No.
I have people at Bloomberg suggesting to me I should be on TikTok, and I'm like, no.
That app is not going on my phone.
No, I just don't get it.
No interest.
Is it branded destruction? Seriously, Lisa, for us to be on TikTok, hi, the yen is up.
Well, but it's not just about that. And to John's point, it's about the ownership of a company at a time of steepening strains between the U.S. and China. It's discussion about, where the data is coming from, where it's being hosted. And there's this real insecurity about that around one of the main and quickly growing platforms. I will say about Snap, because that's the other one that the kids use, and I will say my kids use. And I see that,
It makes us sound so old now, doesn't it?
I can't even say it. I can't take it.
The kids.
I know. I feel like that guy. What's his name? The guy coming in being like, hey, kids, how's it going?
That's Tom these days, isn't it?
My kids are not on Snap. They're not on TikTok. They're
Congratulations.
Not on Instagram.
Oh, you're having a great parenting situation.
Tom calls me young Pharaoh. Every time he says it, I'm just like, that really shows your age.
Well, I will say, young Pharaoh is not on Snap, I don't think. But the question is, Snap didn't report earnings that were that good. They're not getting the ad revenue either that people were expecting.
Don't get me going.
You thinking of going on TikTok?
No, I'm not thinking of going on TikTok. I got people telling me I should be on TikTok.
Who?
No, thank you. Who's telling you that?
Part of my entourage,
Your agent.
I'm sorry. フリーランス必見。入金が遅い請求書をペイトナーが1万円から現金化。報酬の先払いならペイトナー。
Rightly or wrongly, the Fed views the labor markets as the conduit to achieve their inflation objectives.
I think the whole inflation fear is way overdone, and it's starting to leak into the data.
We've not yet seen that turnaround in US inflation that will really get the Fed to actually cut rates rather than just pause the hikes.
Now, the odds of recession are very high, but we haven't seen the whites of the eyes of that recession yet.
I think there's an argument you're starting to price in a mild recession, but you're certainly not pricing in something severe.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The ECB decision coming up later this morning. Big earnings after the close from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equity futures on the S&P essentially unchanged. TK, Credit Suisse in focus. The ECB as well.
Yeah, there's a big day here and big day for earnings as well. But let's sit on ECB right now. We're going to go on TikTok. I got people telling me I should be on TikTok.
Who?
No, thank you. Who's telling you that?
Part of my entourage,
Your agent.
I'm sorry.
Rightly or wrongly, the Fed views the labor markets as the conduit to achieve their inflation objectives.
I think the whole inflation fear is way overdone, and it's starting to leak into the data.
We've not yet seen that turnaround in US inflation that will really get the Fed to actually cut rates rather than just pause the hikes.
Now, the odds of recession are very high, but we haven't seen the whites of the eyes of that recession yet.
I think there's an argument you're starting to price in a mild recession, but you're certainly not pricing in something severe.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The ECB decision coming up later this morning. Big earnings after the close from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equity futures on the S&P essentially unchanged. TK, Credit Suisse in focus. The ECB as well.
Yeah, there's a big day here and a big day for earnings as well. But let's sit on ECB right now. We're going to go to the statement. And I take it, John, again, I'm not expert on this, but this is not just about, folks, what's the rate, 75 beeps or that. Far more than the Fed. This is about a balance sheet analysis.
We need to talk about QT, the potential to wind back that balance sheet. And Tom, I think things get harder as the year progresses for this ECB. 75 basis points today, potentially. But then talking about balance sheet unwind as well. Potentially all of this going into a recession. And again, I've said this repeatedly all week. They are set to do this on a week that we've got PMIs in the 40s in the Eurozone.
And you've got energy, as you mentioned, down as well. I mean, and frankly, you've got stability within the United Kingdom, as witness sterling. I haven't looked at it here, 115.61 on sterling, euro, a little bit. It's just a changed landscape from 2 weeks ago.
Without a doubt. The dollar's weaker. Bond yields have backed away from just a week ago. That's given people a little bit more faith in this equity market. But I go back to the ECB. Lisa, 75 basis points into a recession potentially with double-digit CPI. Not pretty.
Well, although I wonder if the weakness is actually going to be, if it comes quickly, a benefit to them to be able to hike, have a recession, and then perhaps a clean slate with respect to some of the inflationary pressures, rather than stop and then let inflation run hot and let the bond vigilantes come in and penalize them on the long end and wreak havoc in the bond markets. This is not the same market that it was when the ECB had the luxury of being at negative rates and just sitting there tight.
Outside of the trading floors of Frankfurt, the City of London, Wall Street, trading floors worldwide, if you're tuning to a show like this, what do you think this sounds like? When we start talking about central banks causing recessions, what do you think that actually sounds like? Central banks trying to get unemployment to go higher so they can get inflation lower.
It sounds like a political liability, and it sounds like
massive.
A conversation that's feasible, maybe, on the peripherals of academic esoteric discussions until there's some greater weakness. We're seeing the earnings roll in, and they continue to show strength, at least around the margins. So if you see that strength, that resilience, it's more feasible to say, okay, we still have perhaps the hopes of a soft landing. Maybe we can get to something where everyone doesn't lose their jobs, or a lot of people don't. As you say, as we get further toward that, it gets a lot harder.
I think we're here right now. I think central bankers have got to do a much, much better job of explaining all this. For years, always said it, if you just tuned in and we were talking about bad news being good news, if you were outside of the market, that kind of thing drove you nuts. And this kind of thing, I think, drives a lot of people nuts too. This Fed in the news conference next week, if it's not next week, in the months after that when unemployment's climbing, if it's climbing, needs to explain why that is a price worth paying to get inflation lower. And Tom, I think a lot of people are going to struggle with that concept. And that's why politically, this is a real problem.
Politically, as you mentioned earlier, it's about labor. And there's been any number of essays out on this. Do the theories that they have work? Richard Clarida, with us on the last Fed Day, made clear the theories aren't there.
I'm going to be controversial here and defend the central banks.
Oof.
I think, yes, I know. And I'm going to say that they have picked up the slack for fiscal policymakers for many, many years. Now nobody has the ability because we have inflation, and that's crimping both of their abilities. And now everyone's throwing it at the Fed. So that's what's happening.
In support of that, Jean Bovin at BlackRock was heated. This is a supply side analysis, and all of their theories steeped on demand side. Speaking of demand, we were in London for the Queen's funeral, and I was trying to be responsible with my expenses, so I popped up at Liverpool Station.
Yeah.
Liverpool Station, the McDonald's there, Liverpool Street.
How much was McDonald's?
It was not as bad as Zurich, because when I go to Zurich and Davos, I want to be responsible there for number 2 value meal.
$15.
We've been talking here about the anti-tech.
I know.
McDonald's, seriously, McDonald's is anti-tech as you can get. They've got a blended organic revenue in America up 6%, and I think they got a blended international up nearly 9% of sales. They're getting pricing power.
Using a smartphone to order McDonald's, Tom.
Well, yeah, I was doing that.
Are the kids doing that?
No, I was at the Savoy, and you could
You were doing that at the Savoy.
Trafalgar Square.
It's a good look.
I was doing, and bring the bag in from Trafalgar Square.
I can actually the ugly American order at the Savoy.
Yeah, that would be true.
McDonald's coming in on a tray.
They charged a small stocking fee to bring it up to the 24th
I'm sure they
floor.
did. I'm going to whip through the price action.
Please.
Futures unchanged on the S&P. Going into the ECB a little bit later this morning. Lisa's going to run you through that. That's the equity market on the S&P 500. Need to talk about the bond market too. Yields are higher by 7 basis points, almost close to 4.1%. Need to talk about foreign exchange as well, Tom. The dollar's been weaker. Last few weeks, last few sessions, last week. Euro dollar to see it back with a one handle on euro dollar. That's something, Tom.
And you see it in Damien Sassar's world as well. EM has pulled back here a little bit from crisis levels. One I mentioned is not as Turkey. That's its own story. Renminbi 7.24 yuan per dollar, it's a little better, but these are small movements within the continuum of grim EM.
Well, I can tell you the dollar biting back this morning. The dollar's stronger right now. Euro dollar negative 0.5%. Lisa, going into the ECB a little bit later.
Yeah, let's see what happens about an hour time when we get the ECB rate decision. 8:15 a.m., 8:45 a.m. is the press conference with Christine Lagarde, the president of the ECB. 8:30 a.m., a bunch of U.S. data, including the first read on the third quarter GDP. Do we start to see some strength come back into the market after 2 consecutive quarters of declines? Also, initial jobless claims expected to remain near historic lows. And after the bell, Apple and Amazon and Intel all reporting earnings, a massive day of reporting results. How much do we see some sort of confirmation of what we saw from Meta and some of the other tech names that have reported so far, John?
Lisa Abramowitz, thank you. Sharon Bow joins us now, the European equity strategist at Goldman Sachs. Sharon, I want to start with this call from the ECB. We're looking for 75 basis points. There's a big conversation about maybe a recession taking place. Is that an equity market that you want to own?
Yeah, I probably not, actually. In the near term, I think European equities have bounced a little bit. As per earlier comments I heard from Tom, we have seen some of the kind of tail risks related particularly to UK volatility and rate volatility come down. That is great, and I think that's helped with the bounce. But I think more medium term, it's not really a market I'd look to own into a recessionary environment. And we do think there will be a recession next year, along with these tightening rates.
Okay, tightening rates in a recession, how does that lead into your guesstimates forward on what I'm going to call a broad European organic revenue growth? Can companies still deliver not 1%, 2%, 4% organic revenue, but can they do better a year, 2 years out?
I think actually revenue growth will probably be okay because inflation will probably be staying sticky and high. And companies will pass some of that through, pass some of the cost through. In fact, that's exactly what inflation is companies passing some of that cost through. Probably won't be able to pass all of it through. And of course, not only have you got higher costs coming through, you've also got higher interest rates, you've got higher taxation as well. So I think revenue probably okay, but margins is probably where the squeeze will be.
How much are you getting bullish on European banks? And this is sort of the pain trade always, just simply because rates are finally going up, and that's what they've been asking for a long time.
Yeah, and I think actually banks are, if I'm talking about a European recession, and we are talking about Europe seeing a contraction in GDP next year, you would ordinarily say that's dreadful news for the banks. They're domestic, they're levered companies. And they would obviously be very badly hit if there's a rise in non-performing loans. But I actually think this time around banks could do a little bit better. Interest rates are rising, as you point out, and the last few cycles, interest rates have been very low, often negative in Europe, and that's not the case now. So higher interest rates, I think, really helpful for the net interest margins. But also banks themselves have got better capital now than they've had in the past. Also, I do think unemployment perhaps will tick up a tiny bit in Europe. But the labour market's pretty strong. So even if you get a downturn, a contraction in GDP growth, largely because sort of industrial output, supply starts to come down, etc., I think the employment side of things will look a little bit rosier. And for banks, people generally continue to pay their loans, their mortgages, etc., as long as they have jobs. So they will see a squeeze in their real income, so that's going to hit them for sure. But for the banks, what really matters is whether people are still paying off their debt. Now, on the flip side, of course, people probably won't take out new loans at higher cost, or they'll try and avoid that. So it's not all rosy for the banks, but I think that relative to previous cycles, yes, I agree, higher rates is helpful.
Sharon, on net, you've said they can be more defensive in this downturn, in this cycle. You and I talked about that last time. Have you seen clients become more receptive to that message? You've seen stocks behave that way?
So the banks have outperformed again recently. Well, they've outperformed the bounce recently. They've been outperforming sector year to date, even though we've seen GDP slide. We've seen, as you mentioned earlier, PMIs in the mid-40s now. You would never have expected banks to have been an outperforming sector into that type of environment. So I do think that shows you can see banks behave a bit differently this time around. Clients, they are naturally sceptical about banks, and absolutely, banks tends to be more of a trade than something you want to hold longer term. But I think the fact that they are paying reasonably good dividends and the fact that they do benefit from higher interest rates, results so far look reasonably okay for the banks. That all provides some reassurance.
That's true of the whole of Europe, I think, not just the banks over the last 10 years, Sharon. Wonderful to hear from you. Sure. As always, Sharon Bow of Goldman Sachs on the financials, going into the ECB a little bit later. TK, I keep saying it because I'm still surprised by it. We're talking about another 75 from the ECB. With the data where it is, I get it, double-digit CPI, but the data's pretty weak in Europe right now on the other side on output too.
I just don't get it. I don't get it on a nominal GDP basis and also a technology overlay. Does Lagarde come out and say, okay, we're going to dutifully do 75 beeps and that's it? Does she say that?
They're worried about the second round effects, Tom. You know that from the inflation story. Yes. I get it too, and Lisa, they're worried that this becomes even more entrenched because of the supply side dynamic in the energy story.
Yeah, and not just that, but also some of the potential supply chain disruptions with respect to China and what's going on there. I mean, there are a lot of issues. This is a nightmare for central banks, is this stagflationary environment, and that is what they're all facing off with.
I think Mohammed called it a quagmire of stagflation.
It's like a toxic brew.
A toxic brew.
It's a toxic
brew. I tell you what, that sounds deeply depressing, doesn't it?
Well,
a quagmire of stagflation.
Yeah, toxic brew. Nodes of concern.
Bramo is becoming more constructive. You noticed that, Tom?
Notes of depression.
A whisper
before she
of
said
optimism.
That. Jeremy Stretch coming up later over at CIBC. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Central Bank set to lift its main interest rate to the highest in more than a decade. It's trying to lower record high inflation. Almost all economists surveyed by Bloomberg predict a second straight 75 basis point hike today. President Xi Jinping says China is willing to work with the U.S. to find ways to get along. The comments came before a possible meeting with President Biden next month at a Group of 20 summit. It signals an effort on Xi's part to maintain ties despite disputes over everything from Taiwan chips to the invasion of Ukraine. Meanwhile, U.S. Secretary of State Antony Blinken is accusing China of undermining the status quo that has kept both nations from going to war over Taiwan. Blinken spoke to Bloomberg in Washington. He said Beijing was trying to speed up its seizure of the island. China and Taiwan downplay the likelihood of an invasion anytime soon. Credit Suisse is planning a sweeping overhaul. It includes a $4.1 billion capital raise, a carve-out of its investment bank, and thousands of job cuts. It's the most urgent attempt yet to repair Credit Suisse after huge losses and management chaos. In breaking up the investment bank, the firm will create a separate advisory and capital markets business that will revive the first Boston branding. And the world's richest man told Twitter employees he does not plan to cut 75% of the staff. Bloomberg's learned that Elon Musk denied the numbers in an address to workers at the company's San Francisco office. Still, the billionaire is expected to cut staff when he takes over the company, causing anxiety among workers. The $44 billion deal set to close Friday. I'm Lisa Mateo. This is Bloomberg.
高血圧治療。病院で1時間待ち。診察は5分。ならばスマホで診療。もう通院しなくていいんだ。薬待ちしなくていいんだ。家にいながら診療、薬も届く。高血圧に少しでもお悩みの方、まず検索を。高血圧 E メディカル。
What's changed is this: a decision by the government in Beijing that status quo was no longer acceptable, that they wanted to speed up the process by which they would pursue reunification.
That was Secretary Blinken, Antony Blinken, sitting down for an audience with Peggy Collins down in DC, TK. Bloomberg's very own. Very, very cool. Just yesterday, an audience with. Do you like that?
Yeah. I think it's important, and he's taking, obviously, the international view, but right now in Washington, based on the zeitgeist I see this morning, you click inside 2 weeks to an election, it's sort of like the United Kingdom, maybe. We're becoming as focused as the United Kingdom becomes focused.
You mean we're concentrating things a little bit more?
The mind is
not
concentrating
for
both
a few
sides.
Months. Yeah. Don't we start the presidential race at the start of the year?
You guys do it better. That's all, well,
it's 2 years long.
Are you just trying to rub it in?
No, I'm trying to wind him up
it.
because I know that he finds it ridiculous.
But he could push back and say you chose to live in this, so here you go. 2 years of joy.
I love it here.
Oh yeah.
You know I do. I'm very thankful for being a guest of this great country. I've said that repeatedly.
How's the rent search going?
I can talk about the rents in a very different fashion. Rents in Manhattan. Nuts, honestly, Tom, absolutely insane.
Explain the difference between rents here and rents in London.
Well, the fee model's ridiculous. The idea that you'd pay 1 month rent on a 12-month lease as a fee is insane.
Yeah.
And I see a lot more no-fee rentals coming on Street Easy and Zillow. You see much more of that. But the fact that's still a model in New York I just think is unreal. Foreign to me, Tom, foreign. But I am foreign. So
well, that's okay. Personal Finance today on Bloomberg, and we welcome all of you. She's familiar with the rents across the nation. Anne-Marie Horton joins us now, Bloomberg Washington correspondent. Anne-Marie, I know the territory along the Erie Canal of what was industrialized America. Coming out of the Mohawk River Valley, there was Carrier in Syracuse. There was a company called Kodak in Rochester, and they are gone, gone, gone. The president will visit that shell of industrial America, and he will try to paint stark relief within the panic. How panicked is the White House? How panicked is the president?
Well, just quickly to John's point, I think rents in London actually are cheaper. To the president's point today, it's pretty astonishing. Less than 2 weeks ago to the midterm elections, they're going to deep blue New York, and he's going to be joined as well with Governor Kathy Hochul, who also had a very contentious debate this week with her Republican challenger. Crime is really becoming a focus in New York. And the Washington Post has a great piece out this morning about talking about the fact that over the last 48 hours, it's become very difficult for the Democrats. They called it a defensive crouch right now. What did you have yesterday? You had the First Lady Jill Biden in Rhode Island. They are really starting to send out these surrogates in places where normally they would have this support already shored up. And also advertising campaign in congressional districts in New York and New Jersey. So that really says to me that they are a little bit nervous, not about maybe flipping some seats, but about holding or potentially flipping some of the seats that were held by moderate Republicans that they thought a month ago they would have easily had in the bag.
Oh, come on. Dr. Biden's in Rhode Island. Dr. Biden's in Syracuse. You know, whatever. Why are they in the states that are a layup?
Well, there are states that laid up because, one, they are nervous, and then, two, some of these other states that are very, very close neck and neck. You think Nevada, where it really does look like Adam Laxalt has a very good chance of winning that seat from the Democrat incumbent. They do not want the president there because many still view these midterm elections. The president would say it's not, but they are, as many view, a referendum on the current administration. So they want to keep a very large, wide distance from the president and some of his surrogates coming out of the White House.
Anne-Marie, what is the message that Treasury Secretary Janet Yellen is among those campaigning for this administration, given that she is currently, I believe, in Ohio, talking about electric vehicles of all things and economic development?
What the administration is going to try to do is point to the legislative wins they've had. And that started back last summer with the hard infrastructure package. The president recently was talking about it today, how with the prior administration, the Trump administration, it was almost a running joke in Washington, D.C. that every week was infrastructure week. And he was able to cross party lines and get that done. And then this summer, of course, they were able to pass what they're calling the, quote, Inflation Reduction Act. But really that has a lot to do with health care and also climate and EV credits and things like that. So she is going to go out and tout that and probably try to make the case that when you have these kinds of bills, whether the U.S. government could then go on behalf of the American people and negotiate your pharmaceutical companies and get drug pricing down, it will help ease inflation. But it'll be interesting because obviously in a place like Ohio, things like inflation, the economy, these are the #1 issues people plan to go out and vote on.
Did you watch the president drive cars really fast with Jay Leno, AMH, last night?
I watched about 20 minutes of it. The cars were very cool. I'll say that.
Jay Leno's very cool. Did you watch that, Tom?
No, I missed it.
There was no mission. The car's cool. Jay Leno's cool. What are you trying to say, John?
I didn't say anything. Were you trying to get me in trouble this morning? I didn't say anything. I said Jay Leno was very cool.
The president has a cool
Oh, you're asking me
Corvette.
if President Joe Biden is cool?
Yeah.
Anne-Marie, thank you. Down in PC. I mean, what do you want me to say to that? What do you want me to say to that?
What cars were they driving?
I think a 67 Corvette or something.
That was
sure.
called a Pivot, Tom.
Yeah.
No, it's true.
And I think it was an old Ford SUV that had been converted into an all-electric or something like that.
Can we get back to the election?
Oh, no, please.
With our team
Unless
coverage,
you want to weigh in on whether the president
night.
is cool or not. I mean, by all means.
The president's not cool for Democrats. I'm looking at the map of the giant Greg Giroux, who's brilliant on this. And they're in New York. They're in Rhode Island. They're not on the Giroux maps. That's not where the tension is for his party. It's the usual ones, California, New Mexico, blah, blah, Maine.
What's the race you're focused on, Tom? Let's get to it. What's the race you're focused on?
I think the race I'm focused on is a broader Senate race. I don't have any narrow ones that I really, I'm like everybody else. I don't want to be a pundit on this. We got the nation's drowning in punditry. Does the UK get like that?
They're drowning in punditry too in the UK.
Yeah.
I mean, how many little elections have we had over the last few years, Tom? Not general elections, though.
I just listened to somebody like Greg
Conservative Party
Jerome.
leadership contest, to be specific.
I'll be pundit. I think the Fetterman and Oz debate's going to be the debate, but how the outcome of that is going to be really interesting, considering that Fetterman's the incumbent. But it's really sad. I mean, he's recovering from a stroke.
I found that immensely sad as well.
I would agree.
I found that so sad to see him like that.
And how does this really represent the Democrats trying to go up against someone who they're painting as extremist with a candidate who's dealing with his own personal issues that are pretty obvious to people in the audience?
Really sad, Tom, and no doubt it's going to be a focal point for the next couple of weeks as well. In the next couple of hours, we'll catch up with Gene Tenuzzo of Columbia Threadneedle. Looking forward to doing so in the next couple of minutes, actually. And looking at this equity market on the S&P, futures lift, Tom, by a tenth of 1%. Yields up by 6 basis points.
Had a good day.
That member weighting of the Dow probably helps the Dow out.
Yeah, well, Anaconda Copper helped out.
Of course.
Sword fighting. I love this.
No,
this is verbal sword fighting.
Best of friends.
Dow has outperformed SPX over the last
Love each
because it's equal.
How many people are invested in that, Tom?
Tons.
キューボ、今すぐ稼ぎたい方へ。工場、製造業の求人ならワールドインテック。
Take a look at equity futures this morning and start with the S&P, positive a tenth of 1%. Go to the Nasdaq, tech heavy, down about 0.4%. Could you guess that Facebook is down by 22%? And that's a feature of the story the last couple of days. Single names, big tech, Alphabet, Microsoft getting absolutely hammered. And it's not showing up in the index in a major way. In fact, if you look at the equal weight S&P, Tom, I think that's been the story the last couple of days.
Absolutely the story, and it comes down to buoyant revenue growth and ability to raise prices. We've heard that. Gina Martin-Adams says maybe that will end at some point with Bloomberg Intelligence. But for the meantime, these are good organic revenue growth numbers across a broad section of non-tech companies. And, I don't compare these companies to Apple and Amazon. A guy like Ives will tell us that.
Sure.
Bloomberg Intelligence. Mandeep Singh will tell us that. We'll see this afternoon.
The bear market in tech continues. Resilient somewhat elsewhere for the last couple of days. Let's see if that continues. In the bond market, 2s, 10s and 30s shaping up as follows. 444.51 on a 2-year. Yields high by 4 basis points. Everybody talking about the step down in rate hikes. Citi talking about a step down too.
Yeah.
Ellen Zentner's talking about that as well. I think most people are on board with this idea that you get 75, you come down to 50 and maybe 25 after that. That's what Ellen Zentner and Morgan Stanley are talking about this morning. Hollenhorst at Citi said this.
I love this.
If anything, we see hawkish risk as officials will look to avoid a re-loosening of financial conditions. And that's the interesting point from the team over at Citi, Tom.
How do you do that on Bloomberg Surveillance, folks? You go to the Bloomberg Financial Conditions Index, which shows you a Hollenhorst-like number. John, negative 1.06, make that one standard deviation, and that is more accommodative than where it was 10 days ago.
I want to finish on the euro just briefly and look at euro dollar going into the ECB, looking for a 75 basis point hike. 8:15 Eastern time is when we get that decision.
And the pressers when?
About 30 minutes after that time.
30 minutes.
Euro dollar negative a third of 1%. And I was just looking at Italian-German spreads. The 10-year Italy
the Italian
trading 222 basis points over Germany on a 10-year maturity. The wide of the year 252. So we've come in, but I think that's probably still an uncomfortable level, Tom, for a lot of people in Europe at about 220-ish.
Yeah, we'll have to see. I stepped on. Don't get me going.
Step down.
I don't like it. It's just, come on.
What don't you
it's
like
a
about
slow
it?
down and a rate of change. It's just another marketing thing. Where did it come from? Who do we blame?
Who do you want to blame?
McKee?
I mean, I've been saying
did he invent this?
I can't remember where I got it. I think Jim Bianco maybe said it out on Twitter as well. I think others at Morgan Stanley are saying it this morning. Citi's saying it. Would you like to rebrand it? We can rebrand it if you want. It's a change to the rate of change.
Just call it a Newtonian move. Something everyone would understand.
That's fantastic on the south side, Tom. Lisa, what do you make of that? A Newtonian move. You going to open that one?
Happy feeling rates? I don't know. I will say a slowdown is not a pivot. That's the Hollenhorst this morning, which is, and then he uses step down, but it's because he doesn't want to take responsibility for it. We could have him on and hopefully rebrand it. When you were talking, John, about some of the tech names, I want to dig into some of the scope of the moves that we have.
This film is presented by Sky Exchange.
ये पृथ्वी के सबसे पहले स्वतंत्र लोग थे। खाना, शक्ति और ज्ञान का केंद्र था। सदियों तक ये फैला फूला। मगर फिर आया राजा अकबर। उसने अपनी फौज के दम पर सत्ता छीन ली और
could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl.
impact it has on the near term and the impact that it has on our compatriots in Europe. Because we know that the burden is first and foremost borne by those who are most vulnerable, most exposed, and who face the day-to-day hardship of having to put up with higher prices. So I can assure you that that concern was across the board and around the table in equal numbers. So we had a very thorough and in-depth discussion about inflation precisely. And we're focusing on the latest information we have, but also the impact that it will have on our medium-term outlook. And that is clearly something that will be examined in more depth at the time of our March Governing Council meeting, when we produce more projections, which we have not on this occasion, when we can harness all the latest data that we have, where we can also have more information about the job markets, about wages, and where we can really analyze in depth what the impact is on our medium-term projections. We are all driven by the same mandate, which is price stability. And we are all concerned to take the right steps at the right time. And I think there was also a concern and a determination around the table not to rush into decision unless we had proper and thorough assessment based on data and the analytical work that will take place in the next few weeks.
求める人材を採用するならビズリーチ。こんな中途採用の
Peter, great to have you on the show. Thank you very much indeed for your time today. We always appreciate it. The market is now pricing in 2 rate hikes from the ECB this year. That would take the deposit rate back to 0. How realistic do you think that is?
I think it's a possibility. There have been 2 major changes in recent days, actually. The first is when you watch TV, the prime news.
And the bears. The bulls think that you're starting to see, the bulls for the market, not necessarily the economy, think that inflation is starting to roll over a little bit faster than people think. And the bears say this is a structurally higher inflationary regime, that you're going to see the bond vigilantes and the currency vigilantes come out in
My
force.
surveillance correction of the month, John, was the head of the Dutch Central Bank leaning over in the middle of the interview and saying, hey, stupid, inflation in the Netherlands is not 11%, it's 17%. But is that 17% old news?
Well, let's talk about the Eurozone at the moment. Double-digit CPI. So 10%. We'll get some inflation data a little bit later this week. Can you say we've seen the peak in Eurozone inflation? I think a lot of people on core, Tom, are not comfortable with that call just yet, and that's the problem the ECB has. This was always going to be the dilemma. It was the classic EM dilemma for these central banks in DM. A dilemma, Tom, they haven't faced for a long, long time. That's upside risk to inflation and downside risk to growth. And they've got a preference here, and that's to attack inflation, and that's the mandate of this ECB.
Lisa, what do bonds say? They're the price, they're the thermometer of the system and in parity on euro. But what do bonds say in Europe, and how do you roll that over?
My favorite thing is that bonds are trading like Bitcoin. I mean, not quite like that in Europe, but you have seen bond yields get tempered a bit, and I wonder how much the Bank of Canada decision yesterday, where they came in with a smaller rate hike, how much that's going to end up setting the tone for central banks around the world, that they can step down.
Let's get to the data right now and step down to a red and green on the screen. John, I'm going to go the more industrial, the bigger, and the uglier names like the Dow Jones Industrial Average have a lift the last number of days versus the NASDAQ.
Cloud is back because the lights about leverage down 9%. Microsoft was down 7 or 8. Meta this morning, you want to know where Facebook is? Facebook's down almost 23%.
Which is worse than 2 hours ago. The trend's in the wrong
And it's getting worse right now. Euro dollar is negative 0.4%. Dollar making a little bit of a comeback. Some dollar strength going into the ECB. That decision 11 minutes away. And yields are higher on a 10-year in American Tom, up by 7 basis points to 4.07%.
Stay with us on Credit Suisse through the morning as well. A reorganization, the belief of the Swiss bank. Right now, Jeremy Stretch joins to get you out 12 minutes to the ECB decision out of G10FX at CIBC. Jeremy, what will you watch for in 10 minutes?
Well, you're absolutely right. You've just been previewing it, and I've just been listening to your comments. Well, clearly, it's very much about the decision itself in terms of that.
山与江山不同，乾坤无。5年不肯声动，并肩看苍穹，岁月比岁月浓稠。
你受了很严重的伤，心口处有一个大洞，那就证明你的心脉早在进将起营之前就已经毁了。
我上哪匹马？
上朕的马。
是。
精致有机，连续7年销量遥遥领先。 季经期怀孕育儿好帮手，美柚 APP 提醒您正片即将开始。
是。
喂，你又搞什么呀？
谢谢陛下，又救了我一次。
结了婚？
是。
夏子渊。
Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl again. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that